Okay, hi friends. Welcome to day 3 of your CA final marathon for paper 1 financial reporting. We have done many standards. Now, which are the standards which are pending today? Today, the most important standards are pending. Your IND AS 115, that is your revenue from contract with customers. IND AS 116, leases. IND AS 109, your financial instrument. IND AS 101. 101 is your first time adoption, and we are also left with IND AS 108. So these are the 5 standards which are left today, which will be completing it today. And I hope you have enjoyed our marathon sessions. In case you liked it, please recommend it to all your friends. It will be helpful to them as well. Now, just tell me one thing. Is my audio, video proper? Those who are watching, just reply, is audio, video fine? Okay, thank you. Now, before I move ahead, I'll just talk about the new batch which we have launched at Unacademy. Now we have came out with a subject-wise subscription. Earlier you had only group-wise subscription. Now you can get an individual subject also. Now that individual subjects lectures will not be a live classes. It will be a high-quality studio recording like this only. The high-quality studio recording will be there. Now sir, what about our doubts? You'll have a dedicated doubt-solving sessions. Printed books will be available to you if you choose an iconic subscription. Plus you are also having a evaluated test series. Now see, earlier evaluated test series was only for iconic subscription. Now in plus subscription also we are giving an evaluated test series as well. So this is a QR code. You can just scan it to get a glimpse of how your video appears. That high quality studio recording will be there. You can just scan a QR code to understand the quality of video recording. And the subscription charges subject wise FR. If someone is choosing a 3-month subscription for FR regular, it is 7199 the price including all GST, and 6-month subscription is 7999 and 12-month subscription is 9799. These are very competitive rates. Plus you can use the code CA Niket. Yeah, CA Niket. You will definitely get some special discounts. Chalo, let's do today's work. Coming to first of all IND AS 115. First 115, 116. 109. So I'm focusing first on that 3 standards. Okay, now IND AS 115 is revenue from contract with customers. So whenever I have a contract with customers, how do I record my revenue? It talks about that thing. So if I just directly go to the recognition, the core principle, what they're telling. The core principle is the entity should recognize the revenue in a manner that depicts the transfer of goods or service. As in when you transfer the goods or service, revenue should be recorded, and it should be at an amount. It should be at an amount which an entity expects to be entitled. So I should be recording revenue as in when I'm giving goods, revenue as in when I'm giving goods and services. And number 2, I should be recording revenue at what amount? Amount which I expect to be entitled to be receiving for exchange of goods or services. Now, under your IND AS 115, for revenue recognition, there's a 5-step model. There's a 5-step model. This is important. Which are the 5 steps? First of all, we need to identify whether there's a contract with a customer. Okay, once you identify there's a contract, what are your performance obligation under the contract? What you need to do. Number 3, you determine the transaction price. Number 4, you allocate the transaction price between various performance obligation. And number 5, you record revenue as in when the performance obligation is fulfilled. So can I say over here, the revenue recognition is based on fulfillment of performance obligation. As in when you fulfill the performance obligation, that revenue gets recognized. Okay, now let's understand all these 5 steps in detail. Coming to first one, whether there's a contract with customer. Okay, whether we have a contract or not, for that there are 5 conditions or 5 criteria, and all the 5 criteria needs to be satisfied. So whether contract is there or not, 5 criteria, all of them needs to be satisfied. Now see, if this 5 criteria are not satisfied, there's no contract only. If there's no contract with customer, there cannot be a revenue recognition. For revenue recognition, there were 5 steps. First step only is not fulfilled, there cannot be there. Okay, so step number 1 is identifying the contract. For that, do they have an approved contract and are the parties committed to perform? Approved doesn't mean in writing, it can be oral also. Next, whether each party's rights are kind of basically identifiable, whether the payment terms are identifiable, contract has commercial substance. The contract is having commercial substance. And last one, the most important. It is probable that entity will collect substantially all of consideration. It is probable that entity will collect substantially all of consideration. Now, if suppose you feel substantially all of consideration will not come, on day one only you're feeling that substantially all of consideration will not come only, then there is no contract. Then the problem is we can't move ahead under IND AS 115. Okay, so now, if any of the criterias are not met at the inception date, we don't record revenue inception date pay, then we'll reassess this criterias. We'll reassess the criterias later on, and whenever the criterias are met, then in that case we'll be recording revenue later on. Okay, fine. Now check over here this point. This is important. A contract may not pass step 1. A contract may not pass step 1, but still you may have transferred certain goods or services, and you might have received some non-refundable consideration. You might have transferred some goods or services, and you might have received some non-refundable consideration. So now question, I have received some consideration now. Sir, can I record that as a revenue? Imagine they gave me certain advance. So can I record that as a revenue? Now pay attention. Now the point over here is they are telling the contract doesn't pass step 1. Means I feel substantially all of collection will not come. Substantially all of collection is not going to come. So can I say that point number 5 is not satisfied? So now that step 1 is not satisfied, but now I have got some money. So jitna paisa mila, can I record that as a revenue? So they are telling, if you have fulfilled all your obligation, there are no remaining obligation. And consideration received is non-refundable. If you have fulfilled all your obligation and consideration received is which type? Non-refundable. Then in that case you can record it. So all or substantially all consideration is received and it is non-refundable. All or substantially all consideration is received and it is which one? A non-refundable. Plus your side say obligation is over. Or step 2, yahan pe second one, you can record that part revenue which you have received as a revenue if the contract has been terminated. Kab likh sakte hai? If contract has been terminated and the consideration is non-refundable. So one is you have finished all your work, substantially all consideration is received. But wo to hua hi nahi hai. Because substantially all consideration is not yet received and we have a doubt will not be receiving. So I can record the part received as a revenue. The part jo mila tha, that can be recorded as revenue only if the contract is terminated and the consideration received is non-refundable. Are you clear with this? Reply fast. Now check this question. We sold a machine to a company. They are starting a food industry. Now food industry is highly competitive. If they do well, they'll be able to pay. So can I say on day one, can I say substantially all of collection will come? It is not probable. Substantially all of collection will come is not probable in this case, because if they don't do well, they will not be able to pay. Now, the cost of machine is 12 lakh, but they have given you a non-refundable deposit of 1 lakh. So can I record that 1 lakh as revenue? Jitna mila utna. Can I record 1 lakh as revenue? See, I have given full machine. So my side obligation over, but substantially all revenue has not been collected and the revenue is doubtful. So that step, identifying a contract, that step is not getting fulfilled. So the thing is, I can record revenue only when the contract is terminated and this 1 lakh is non-refundable. So I got 1 lakh, now I cannot record 1 lakh also as revenue. So sir, 1 lakh also I can't record. What do I do? I'll record this 1 lakh as a liability in books. I'll record 1 lakh as a liability and it will go in revenue only when the contract is terminated. So check over here, yahan pe the last point, like ability to pay is lacking. It is not probable you will collect substantially all of the collection. ठीक है, तो you can record only when it has been terminated, then only you can record it. Okay, next is contract term. What do you mean by the word contract term? Contract term is the period over which both the parties have enforceable right. Contract term is a period over which both the parties have which right? Enforceable right. Okay, now if any of the party can cancel the contract, if any of the party can cancel the contract without the contract being started only, abhi contract start hi nahi hua, but before that we can cancel it, then there is no contract at all. Then there is no contract at all. Now imagine customer comes, he takes a gym subscription. Customer comes, he takes a gym subscription of 1 year. So you might feel contract is 1 year. But if customer can cancel the subscription after 3 months, if customer can cancel the subscription after 3 months without penalty, okay, then you don't take contract period as 1 year, then you take the contract period as 3 months. But if customer can cancel subscription after 3 months upon payment of penalty, so I need to see penalty kitna hai. Is it a small penalty or big penalty? If the penalty is substantive, then he will not cancel. And as he will not cancel, then the contract period will be 1 year. Okay, next is combining the contract. Okay, now 2 or more contract, can I combine and account it? So if they are entered at or near the same time, what is the word written? If they are entered at or near the same time and it fulfills one of the following criteria. So they're entered at or near the same time and it fulfills one of the criteria, then you can combine and account it. One, they're negotiated as a package. Price of one depends on price of others, or they are a part of a single performance obligation. They're a part of what? A single performance obligation. So when can I combine the contract? Kab kar sakte? 2 contract, even though they are separate, they are entered at or near the same time and one of the criteria is fulfilled. They are negotiated as a package, price of one depends on price of others, or they are a part of a single performance obligation. Now sir, what is performance obligation? I'll come to it later. It's there in your step number 2. Okay, now contract modification. Modification means there's a change in scope, like quantity to be given is increased or quantity to be given is reduced or rate is increased or rate is reduced. That's contract modification. Now, how do I account for contract modification? They say that if the modification leads to increase in scope, earlier you ordered 100 units. Now you say, sir, please add 50 more. Earlier you ordered 100 units. Now you're telling, please add 50 more. So can I say it's leading to increase in scope? And now for that 50 unit, I'm charging a standalone selling price of that 50 unit. For that 50 unit, I'm charging what? The standalone selling price of that 50 unit. Then in that case, that modification will be accounted as a new contract. So when do I account it as a separate contract? If it increases the scope and the extra quantity you want, I'm charging is the standalone selling price of it. Then they are accounted separately. But if they do not constitute a separate contract, if there's not increase in scope, there's a decrease in scope. So then it doesn't fall over there. Or there's an increase in scope, but what I'm charging is not the standalone selling price of that. Because you ordered earlier 100, you're getting some discount on this 50. So then in that case, we don't account it as a separate contract. So how do we account? If the goods which I have to give extra, are distinct goods, then they are accounted, then it will be accounted prospectively. The modification is accounted prospectively. If goods to be given are distinct. But if goods to be given are not distinct, then we'll follow a cumulative catch-up. Now, sir, what is this cumulative catch-up? We'll see example, it will be more clear. The point is, when do I record it as a separate contract altogether? When is modification a separate contract? When there's an increase in scope and what I'm charging is a standalone selling price. Okay, when it is not a separate contract, there might be a decrease in scope or there's an increase but I'm charging is not the SSP, then it is not a separate contract. Okay, if it is not a separate contract, how do we account? Okay, if goods which are to be given extra things, it is distinct, then in that case, it is accounted prospectively. हाँ, तो वट एवर सर्विसेज आर डिस्टिंक्ट, पेंडिंग वन आर सर्विसेज आर डिस्टिंक्ट वन, मॉडिफिकेशन के कारण, देन it is prospectively. But if the services are not distinct, pending services are not distinct with the earlier one, then in that case you go for a cumulative catch up. Let's see example of both. Now KLC company is there, you have sold some machine and there's 1 year maintenance. For maintenance you will charging 55,000 per month. Now you decided October say you will charge 45 per month. Okay, now there's no increase in scope. There's no increase in scope. So can I say it is not accounted as a separate contract? It is not accounted as a separate contract. Increase nahi hai, sirf rate is changed. Okay, now maintenance which I already provided till October and maintenance which I have to provide after October, can I say they are distinct? Maintenance jo already provide ho gaya, wo alag hai. And maintenance which I have to provide now, that is also different. It's distinct. As it is distinct, we have to follow what? Prospectively. So till now you recorded revenue 55,000 per month. October onwards you record a revenue 45,000 per month. So October, November, December, January, February, March. 6 months. 6 months into 45. 6 months into 45 is 270. The 270 will be booked in the remaining 6 months. I hope you are clear. Keep replying. Keep replying. More you engage yourself, more you reply, more you'll enjoy the classes. Okay, next one. This is a kind of cumulative catch-up example. Let's see what is this cumulative catch-up example. You are customizing the infrastructure for a client. Approximate 200 hours were required and the charge is 150 per hour. So can I say you are charging 200 into 150, total is what? 30,000 rupees. But after 100 hours are done, customer wants some extra changes also, and now you feel there's an increase in labor hours by 50. Okay, there's an increase in labor hours by 50. Hours are increasing. Now you will charge only 100 per hour for that. Okay, are you charging SSP? See, earlier was 150. Now you are charging only 100. So what you are charging is not SSP. So it is not to be accounted as a separate contract. So there's an increase in work, but you are not charging SSP. It's not a separate contract. Okay. So now if you just try to understand, total will be 250 hours. Here 200 and here 50. Total will be 250. And now the revenue will be 200 into 150 and 50 into 100. The total revenue is 35,000. 35,000 for 250 hours. So can I say per hour you should have recorded 140. 35,000 for 250 hours, per hour 140. But see, we have already finished 100 hours. How many hours we already done? 100 hours. And for that 100 hours, we already booked revenue as per 150. For the 100 hours, we already booked revenue as per 150. It should be as per 140. So 100 hours pay, we booked 150. It should be as per 140. So 100 into 10, you have to remove from revenue. This is a cumulative catch-up. So now it should be 140 per hour. We have already recorded 100 into 150. It should be 100 into 140. So 10 rupee into 100, 1000 revenue is to be removed. I hope you are clear. Because यहाँ पे the goods are, मतलब services, goods and services are not distinct. We have to do basically some interior. वो interior ही है. Hours extra लगेंगे. It's not a distinct goods or services. Okay, next is identifying performance obligation. So step 1 is identifying a contract with customer. Now in a contract, what are your obligation? Now imagine I tell you, I'm selling a car and you will get some 3 free services. I'm selling a car to you and you will get 3 free services for the first year. So don't think that we are just selling car. There are 2 performance obligation of ours. One is car I have to give you. And second, I have to give you 3 free services. For you, it is free. मेरे लिए free नहीं है ना. I have to give you that also. And that free services are over a period of 1 year. So whatever you are paying me is not just for car. It's for car and the 3 services. Whatever is for car. When I give car, I can book revenue. For the free services, I can book revenue as in when I do your services. So understand what are your performance obligation. Understand what are your performance obligation. So check over here, performance obligations, a promise to transfer to customer some goods or services which are distinct. Okay. Now just going down, When do I say it's a distinct goods or services? When do I say it's a distinct goods or services? When there is no integration, no significant modification, standardization, or no interdependent or interrelated. Okay, imagine I'm selling you software also, and I'll do some modification to software also. I'm selling software and a customization service, but if they are linked, if they are very linked, then in that case they are not two separate performance obligation, then there is only one performance obligation. Okay, so check over here. Question number 4. There is a software engineer. You are a software developer and you are giving which services? The entity sells license, installation service and tech support separately. Okay, 3 things. Installation service includes some changing web screen for the users, etc, etc, etc. So how many performance obligations are there? So 1, I'm giving you license, 2nd, I'm doing installation, 3rd, I'll give you some software updates and technical support. So software license, installation services plus software updates and technical support. So day when I give you software, I cannot record full revenue. Reason, whatever you're paying me is not just for one thing, it's for all things. The day when I give software, I can record first wala revenue. The day when I do installation, I can record second wala. Software update I have to give over 2 years. So that will be recorded over 2 years. Tech support I have to give over 2 years. That will be recorded over 2 years. But in this question, in above illustration, if at all they are telling the software is to be substantially customized, which cannot be basically done very easily outside. So can I say now customization is kind of linked over here? Now it is kind of linked. So installation service and license are basically kind of linked. They will be treated as one thing. So installation including license, they are treated as one performance obligation if at all they are linked. Okay, next, non-refundable upfront fee. What is this non-refundable upfront fee? You took a Netflix subscription. You paid 999 rupees per year. It's not per year, it's basically very higher than that. But suppose it's 1000 rupees a year you are paying for Netflix subscription. Non-refundable upfront fee. Can Netflix record it as revenue on day 1? How to account for this? So we need to see this non-refundable fees for what? Whether Netflix has to provide you certain shows for it. Yes, the Netflix will allow me to watch some content. So generally this is for the services to be given in future. As this is for the services to be given in future, it will be recognized as a revenue as and when the services are given. But sometimes it may not be for the services to be given. For example, when you take a SIM card, they charge a non-refundable upfront fee. So when you take a SIM card, 100 rupee non-refundable fee is charged. This is to set off against the infra expense which the telecom company has done. This is to set off against what? The infra expense which they have already done. So if you take a SIM card, you paid 100 rupee. Now, yahan pe, they don't have to give you any service in future. To get service, you have to do a recharge. So now in this case, that 100 rupee they can record in revenue immediately. So I need to understand this is for what purpose. Next, determining the transaction price. Okay, the step 1, identifying contract with customer. Step 2, you determine your performance obligation. Step 3, what is the total transaction price? Total transaction price for all performance obligation. The transaction price is the amount which you expect to be entitled. Very important word, which you expect to be entitled. Now, if I tell to my customer that if you pay within 15 days, I'll give you 2% discount. If you pay within 15 days, you don't have to pay 100, you have to pay 98. And if I'm expecting customer will pay within 50 days, I repeat, if I'm expecting the customer will pay within 15 days, so can I say I'm expecting a revenue of not 100, I'm expecting a revenue of 98, sales will be booked at 98. Clear? Clinic all clear? Okay. Now, your transaction price will include some fixed amount, variable amount or both. ठीक है. Now few points which are related to transaction price. One, variable consideration. Variable consideration. If you normal price of contract is 1 crore, but if you finish early, you'll get some bonus. So you'll get not 1 crore, you'll get 1 crore 10 lakh. If you finish late, there will be penalties. You'll not get 1 crore, you'll get 95 lakhs. That's a variable consideration. Now, variable consideration, should I include? So should I take the transaction price as 1 crore or 1 crore 10 lakh? You need to see what you expect. If I'm expecting I'll able to finish it in 30 days, then you take transaction price not at 1 crore, you take it as 1 crore 10 lakhs. So what you are expecting, that is to be seen. But you need to ensure what? There's a one word written, that is, I'll just go down, I'll come back then. Yeah, constraining estimates of variable consideration. What is this constraining estimates? It is highly probable that significant reversal will not come. ऐसा नहीं होना चाहिए you currently took 110 and majority of time you are not fulfilling deadline, you are not getting 110, you are getting 1 lakh 1 crore only. So you booked 110 and later you are getting 1 crore, so can I say reversal will come? ऐसा नहीं होना चाहिए. So the thing is, it should be highly probable. What is highly probable? That significant reversal will not come. So you include the variable consideration only when you feel that बाद में reversal will not be coming. Okay, just come back. How do I estimate the variable consideration? There are two options. Expected value, most likely amount. Expected, and second is what? Most likely. Expected is, if you finish within 30 days, 10% bonus. If you finish in 30 to 60 days, 5% bonus. If you finish after 60 days, 0 bonus. So can I say either bonus can be 10% or 5% or 0%. Do one thing. Multiply that bonus amount with each of the probability and then you get amount. That's known as expected value. It's a sum of weighted probability amount. The probability weighted amount. Second one, most likely. Most likely is whichever has a highest percentage. That's most likely. Now, which one to use? Whenever there are range of outcomes, whenever there are more than two outcomes, range. More than two outcomes, go for expected value. But whenever there are only two outcomes, you receive bonus or you don't receive bonus. You receive bonus, you don't receive. There are only two options. Then you can go for most likely wala thing. So this is appropriate only when there are two outcomes. Check question 6. Normal transaction price is 25 crores. Normal transaction price 25 crores. Okay, there's a bonus for early completion. 15% bonus if you complete by 30th month. 10% bonus if you complete by 32nd month. 5% bonus if you complete by 34th month. Can I say 3 options? With the probabilities are given, you multiply and find out what is the expected value. But there is one more thing. There's a quality bonus. Okay, this you get that 2 crore. Gold star rating not there, you don't get the 2 crore. And यहाँ पे 60% likely. So can I say 60% chance will get, 40% will not get. So यहाँ पे you use most likely method. So what will be the transaction price? ये 25 plus ये bonus वाला early completion bonus, you find amount based on probability, and plus you include 2 crores. Plus you include 2 crores. So this is 2.125 and plus will also include 2 crore. The total transaction price will become 25 plus this 2.125 plus 2 crores. Clear? And variable consideration you include only when it is highly probable, not just probable, highly probable that significant reversals will not be coming. आ गया तो ठीक है, reverse करो, but you account when highly probable that significant reversal will not come. Next one, you have to reassess the variable consideration at the end of each year. Prompt discount. If customer pays early, I'll give 2% discount. I need to see what I'm expecting. If I'm expecting he'll pay early, record revenue directly at 98, not at 100. Volume discount. Now this is important. Pay attention. Volume discount. Just a reminder, lots of water keeps you fresh. Warm water more healthy. a simple way to keep yourself fresh, keep drinking water. Every 15-20 minutes, one sip of water. Now, what is volume discount? If the total number of units in a year which you are buying crosses 10,000, if a total number of units which you are buying in a year crosses 10,000, you'll get some extra discount. That's volume. Now, isme there are two things. One is, if total number of units crosses 10,000, so from 10,000 first unit, 20% discount. Okay, from which 10,000 first unit, 20% discount. That is prospectively, future mein. And second option is, okay, whenever your total reaches 10,000 unit, retrospectively 20% discount. For the first 10,000 also, even though you paid 100, I'll refund you 20 rupees. तो फर्स्ट वाले में फ्रॉम 10,000 फर्स्ट यूनिट 20% डिस्काउंट, सेकेंड वाले में फ्रॉम फर्स्ट यूनिट 20% डिस्काउंट. तो now if it is prospective from 10,000 first unit, then in that case, so when you're selling today, you're not just selling these goods, but you're also selling a right to get some discount in future. I'm not selling only goods today, but I'm also selling a right to get some discount in future. That is treated as a separate performance obligation. How to account for it, we'll come to it later. It will be accounted like loyalty points if it is prospectively. But if it is retrospectively, today I sold you at 100. But if your total unit will cross 10,000, can I say this price 100 will become 80? I have to refund back 20. So I need to see expectation. If I'm expecting the total sales of yours will cross, 10,000 unit, don't record revenue 100, day 1 only record revenue 80. Sir, but I received 100, extra 20, show it as liability. Okay, check, this question is important, 7th one. If your sales is this, price will be this. If your sales is this, price will be this. Now, we sold currently 7 lakh. But we are estimating total will be 2.8 million. Okay, total will be 2.8 million. Can I say it falls under the second category? Okay, so price has to be what? 90. Okay, day 1 you just bought 7 lakh. You have paid 100. Day 1 you bought 7 lakh. You have paid 100. But I'm expecting your total quantity will range in the second one. I'm expecting that the total revenue will be 90 rupees. Today you paid 100, extra 10 I'll show it as a liability. So check, transaction price is 90, extra 10 I'll be showing it as liability. Next one is refund liability. Now what is a refund liability? If you feel that client has paid you money, but you will be required to refund it. Like client paid you, last question only, client paid you 100, but can I say I know I will have to refund 10 rupee, then you show that extra as always a liability. Okay, so this is fine. Now sale or return. Sale with a right of return. Now whenever sale is done with a right of return, I should record revenue only for the portion which I feel will not be returned. When you buy goods from Myntra, remember they give you 30 days return period. And yaar, kitna return aata hai? So much return comes. So actually my wife keeps on trying new clothes. If it doesn't fit, return. Order kiya online, doesn't fit, return. So I can tell you in my house, out of 10 units which are ordered online, 4 or 5 will be going back. So can I say 40-50% return is happening? So when Myntra sold you, should they record on day 1 only the sales for all 10? Nahin. I know out of 10, 4 will come back. If I know out of 10, 4 is going to come back, rather than recording sales of 10, you record sales only of 6. Okay, so the revenue is only for what amount the entity expects to be entitled, which you feel will not be returned. For the thing which you feel will be returned, you record a refund liability. So day 1, okay, customer paid you for 10 items. Record revenue only for 6 items. For remaining 4 items, show it as a liability. Clear with this? Okay, and now, if I have not recorded sales for 10, I have recorded sales of only 6. The remaining 4 of mine are lying with customer. They will appear as stock with customer. So bank debit to sales, which are not to be returned, to refund liability, which is to be returned. Okay, check over here. Next point, penalties. Now, how do I account for the penalties? See, penalties are accounted based on substance of contract. Penalties are accounted based on substance. Okay, if you deliver late, there is a penalty. If you complete early, there is a bonus. So late delivery pe penalty. So if I feel I'll be delivering late, I know penalty will come. You can include this under variable consideration. This you can include under what? Variable consideration. But if quality of product is not good, he will file a case, I will have to pay penalty. Quality of product is not good and I'll be liable to pay some penalty. That you make a provision as per IND AS 37. You have to go based on substance, whether it should form a part of variable consideration or whether it should be done provision as per IND AS 37 based on substance of the contract. Under IFRS 15, all penalties are included under variable consideration. So there's a carve out over here. Under IFRS 15, all are a part of variable consideration. Okay. Next, warranty. Warranty. Whenever you purchase a goods, you get some warranty. 1 year warranty is free. So now how do we account for warranty? Now, one, if warranty is just an assurance that the product will work as specified. If warranty is just an assurance that product will work as specified. I am giving warranty, but I know nothing happens during warranty period. I give warranty, but I know nothing happens during what? Warranty period. So that I know I don't have to do anything. Just for the sake of giving assurance, I have given you. For the sake of giving assurance, I have given you. Then in that case, that warranty is not a separate performance obligation. For the sake of assurance I have given you, I know nothing will come back, no problems will happen, then there is no separate performance obligation. But I know some products will get damaged or some products will not work properly and I'll have to do repairing during that warranty time. I know, मुझे मालूम ही है based on experience, some product will not work properly, I'll have to replace or I'll have to repair for free. So can I say now I have to give some service? Then out of the revenue, some revenue should be allocated towards that warranty service which is to be given in future. If warranty is just an assurance of the goods, nothing is going to come, no repairing will be required, then there is no separate performance obligation. But for the warranty period, I know pakka something will come back, I have to give a free repairing, this, that, something is to be given, then there is a separate performance obligation. So out of your total revenue, something towards goods today and something towards the services under warranty which I have to provide over that next 1 year. Plus, they have clearly said if warranty is being sold separately, agar alag se warranty bech rahe hain, then it's always a separate performance obligation. So if customer has option to purchase separately, it is a separate performance obligation. So it is a distinct service, but they don't have an option to purchase it separately. It is just a assurance. If it is just a assurance wala thing, no services will be required, it's not treated as a separate performance obligation, but rarely something may come up, so I may do a provision as per IND AS 37. Are you clear? Are you clear? Okay, fine. Now check this RTP May 21 question. Manufacturer give warranty for the goods, will repair it if defect happens. Okay. 30th April, a defect was detected. 30th April, a defect was detected. 30th April, can I say after year end? After year end, a defect is detected. Okay. This were the goods manufactured between 1st March to 30th April. The goods which were manufactured in March were defective. Okay, we came to know about it in April. But goods manufactured in March were defective, means the circumstances existed. जो March में goods manufacture हुए, they were defective. So circumstances existed. Okay, I came to know on which date? 30th April. Doesn't mean that circumstances were not there. Defective goods were there. I came to know today. So it's an adjusting event. Fine. How would you deal with it? First, defective goods sold on or before 31st March 1. Okay, if I have already sold the goods, the goods produced in March, I've already sold it. I know डिफेक्टिव है वापस आएंगे, तो आई नीड टू क्रिएट अ प्रोविजन फॉर दैट डिफेक्ट इन डेज 37. Second one, defective goods which are held on 31st March. Okay, defective goods अगर हमारे पास पड़े हैं तो can I say how to rectify and sell it? So now they are treated as kind of WIP. And now if you remember NRV of a WIP, estimated selling price minus estimated cost to complete the product. So if they're still lying with us, so we have to repair and then sell it. So they will be included in inventory like a WIP. So they will be included in your inventory like what? WIP. ठीक है? Manufacturing defect in inventory, तो उसमें we need to take care. And third one, if defective goods are manufactured in next year, April में, remember they were manufactured in March and April. Okay, so how to account for those defective goods which were manufactured in April? If they were manufactured in April, uske related cost will also come in April because that goods were not there as of 31st March. Done. This was a good question. Next, sales base or usage base royalty. Okay, if I get a sales base or usage base royalty, for example, I have my book published. So there's a publisher who has published it. Upon sales, I get a royalty. So I should book the income only when that sales happen. So जब तक sales नहीं हुआ, तब तक I cannot record revenue. Next one, significant financing component. Now, what is a significant financing component? Imagine, I'm selling you goods today. Pay attention. Pay attention. I'm selling you goods today. If you pay me today, you have to pay 100. But if you want to pay after 1 year, you have to pay 110. If you pay me today, you have to pay me 100. But if you want to pay after 1 year, I'll allow. But then you have to pay 110. So that extra 10 is not revenue. That extra 10 is what? Extra 10 is not revenue. That extra 10 is what? Interest. If there's a significant financing arrangement, then in that case, that should be accounted separately. Same way, I will give you services over 2 years. I'll give you services over 2 years. Your option to pay at the end of first year, at the end of second year. Your option to pay at the end of first year, at the end of second year. You can do that. There's another option. You can pay upfront. Okay, if you pay upfront, instead of 100, you pay 90. If you pay upfront, instead of 100, you're paying 90, or else you have to pay 50 and 50. So either you pay 50 first year end, 50 second year end, or you pay right now 90. Now, so wahan pe if right now someone pays 90, doesn't mean my revenue is 90. If right now someone pays 90, doesn't mean my revenue is 90. Revenue is 100 only. Revenue is 100 only. If a customer is going to pay late, there will be interest income. But if customer is paid early, there will be interest expense. If customer will pay late, so revenue is 100, extra 10 is interest income. But if customer is paid early, so he paid 90 plus 10 is interest expense, revenue will become 100. Are you clear? Okay, now I have a question. I sold a machine to someone, they paid me 90%. I sold machine, they paid me 90, 10% they have kept on hold, which they will pay after 1 year of satisfactory performance. 10% they kept on hold, that they will pay after 1 year of satisfactory performance. Okay, so is it held up to get some significant financing benefit? No. It is held up just to ensure there are no defects in machine. That 10% they hold, why? Not to have some financing benefit. That 10% they hold, why? This is just for understanding there are no defects in machine. So then in that case, there are no significant financing benefit. Nothing will be interest over there. Okay. Going ahead. Okay, now check this question. Check this question. You are selling equipment. The price is 1 CR. The price is 1 CR plus 10% interest, which you have to pay in 60 months. Okay, so 1 CR plus 10% interest you're paying over a period of 60 months. And the installment amount is coming 212470. Okay, how much did the interest I charge? How much is the interest I charge? 10%. How much is the interest I charge? 10. This was significant financing component. How much is interest element? That interest element should be based on discount rate which will reflect a separate financing transaction between us. If I were to give you a loan, I would have given at what rate? If I were to give you a loan, I would have given at what rate? Suppose I would have given at 10% only. What you are paying is principal plus 10% over a period of 60 months. If I would have given at 10% only the loan, then the revenue will be 1 crore. So if discount rate reflects the separate financing transaction rate, if the discount rate reflects the separate financing transaction rate, then in that case the revenue will be 1 crore only. The cash selling price is 1 crore. But if you would have came for loan, I would have given you loan at 14%. Okay, so if you had come for loan, I would have charged 14. Currently, I gave you at what? 10. What you are paying me is 10%. I would have charged, remaining will be treated as interest. Did you understood this? So, how much is interest? It is the rate based on which I would have given you a loan. The separate financing arrangement, what would be the rate? So, many times you buy a car, you might have seen when you buy a car, they say that you get interest at 1.99%. So, car low, to 2% per interest. Now, car low to 2% per interest, really interest is not 2% in that. Can I say car is sold at a discount? Really the interest is not 2%. Really what is there? The car is sold at a discount. So now, if at all I'm giving you car at 10 lakh and interest I'm charging 2%, market rate is 8. Market rate is 8. So what you are paying, I'll discount it by 8% and the car value will not come 10 lakh. The car value will come less than 10 lakh. The car value comes 850 and remaining extra 150 is interest. I hope you are clear. Next, question 11 is fine, nothing different. Now, non-cash consideration. If you are getting a non-cash consideration, customer gives you not cash, customer gives you some asset. Customer gives you not cash, but customer gives you what? Asset. So then in that case, the revenue will be recognized at the fair value of the non-cash consideration received. The revenue is what? The fair value of the non-cash consideration which is received. That becomes the transaction price. Now pay attention. I sold you goods. You are going to give me shares. I'm selling you goods or I'm selling you machine. You are going to give me what? Shares. Okay. So I gave you goods, you gave me shares. Okay? So revenue the transaction price is the fair value of the shares received. Now fair value of share received today. Now the fair value of shares will keep on changing. Remember every second the shares ka price changes. So the day when you are giving, I gave you machine, you gave me shares, or when I gave you machine, I'll record the revenue. I'll record revenue based on the fair value of shares going on today. Later, if the shares ka fair value changes, it is not accounted as per 115. You got shares of some equity, other company, it's investment in equity, that becomes a financial asset. Later, it will be accounted as per Ind AS 109. Later, it will be accounted as per Ind AS 109. Ashwath, are you clear? Okay, now check. AT Limited agreed to pay 350 crore to you plus 10 lakh equity share as bonus. If you construct within 1 year, the fair value of share is 100 at contract inception. So contract inception time, the transaction price is to be determined. The transaction price will be 350 plus 10 lakh shares into 100. 10 lakh shares into 100. 10 lakh into 100 is what? 1000 lakhs, it is 10 crores. So 350 plus 10 crore become 360 crore. Now later when I'm actually getting shares, the price of shares would have changed. I don't care for it. For me, the investment in equity will appear at what? First of all, 10 crores only. Later on, it will be measured as per Ind AS 10 of water. We are manufacturing that distillery water. Now, the thing is, we sell that distillery water to DMart. Okay. So, DMart is our customer. So, DMart will pay me. Now, I'll not pay them. But now I want a distillery's holding in DMart. So DMart के अंदर एक distillery का holding लगाना है. And now DMart is charging me. So can I say that distillery holding I put and DMart is charging? So can I say it is for a separate service? They are giving me some separate service. So if it is for a separate service, If I pay to customer towards a separately, it will be treated separately. But suppose I tell them that, sir, you keep my Bisleri bottles like this, and for keeping bottles like this, they have to change their shelf. For changing the shelf, I pay them. I tell them to keep Bisleri bottles in this way, to keep in that way, they have to change the shelf. For changing the shelf, I'm paying them. Okay, am I paying for getting some separate service? No. When they put my hoarding, I'm getting a service. But when they are not putting hoarding, they have to change shelf and I'm doing it, I'm paying for it. Then that gets reduced from our transaction price. If at all you're not getting any separate goods or services, it is reduced from your transaction price. If you're getting goods or services, it is accounted separately. Okay, this is basically thing. Now check over here. 15 crore ke they will buy goods from you. And you are paying 1.5 crore to change the shelves. To change the shelf, I'm paying 1.5 crore. Now, do I get any goods or services? No. So, यहाँ पे transaction price is not 15 crore. Transaction price is 13.5 crore for the goods which I'm selling you. Transaction price is 13.5 crore for the goods which I am selling you. And do one thing, 13.5 I have to give divided by 12 months. So, every month it is 1.125. But suppose this 1.5 I paid, that is for some advertisement board which you have to put it. Then that is separate. Now the transaction price remains as 15 crores. Now the transaction price for the goods which I am selling is 15 crores transaction price. Extra I paid 0.3, that will be deducted from transaction price. Next, so step 1, identifying contract with customer. Step 2, क्या था? Step 2, determine your performance obligation. Step 3, determine the transaction price. Now, allocate the transaction price to the various performance obligation. I have an obligation to give goods also. I have an obligation to give some services also. So, bifurcate your total transaction price between the various performance obligation. कैसे? On the basis of respective standalone selling price. On the basis of what? The respective standalone selling price of each of the items. ठीक है? Now, sometimes the respective standalone selling price are not available. Suppose entity does not sell that goods or services separately, the respective standalone selling price not available. Then, remember we did yesterday, IND AS 113. So, you determine uska fair value. Try to maximize the use of observable data. Second, cost plus margin approach. Cost plus some margin you charge, that is cost plus margin. Third is a residual approach. Now, what is residual approach? Imagine, I am selling you product ABC. I am selling you product ABC. Out of product ABC, total transaction price है. SSP of A is known, B is known. So, balance becomes the standalone price of C. तो आपको A का मालूम है, B का मालूम है, balance becomes the standalone price of C. Is there a lag still? Is there a lag still? Is there still a lag? Okay, I think it's fine now. Okay, now it's fine. Let's move ahead. Okay, now allocation of discount. Coming to allocation of discount. Now you are selling 2-3 products together. So you are selling not just the car, you also will be giving some 3 free services. So now suppose some discount is given. So can I say discount is also to be allocated between both of them? And normally the discount will be allocated between both of them. How? Based on the standalone selling price. So standalone selling price of A is 100, B is 50. A is 100, B is 50, total 150. We charge only 140. Total is 150, but we charged only 140. So now in that case, what will happen is that total 140 will be divided between that two in the ratio of 100 is to 50. Okay, is there a lag coming still? Is again a lag coming? Let me just check my internet. Yeah, still lag, just 1 minute. Huh? I'll be back, just 1 minute. Okay, now tell me, is it fine? I think now there should not be a problem. Sorry for this technical issues. Okay, let's move ahead. Okay, thank you so much. Abhijit says still there is a lag. I feel now it's fine. Fine now, perfect, chalo. Now, normally I sold product A, product B, product C. Total A was 100, B was 50, C was 50, total 200. But I didn't charge total 200, I charged only 180. So can I say 20 rupee discount is allocated between all three on the base of their SSP? Normally. But, pay attention. Entity can allocate a discount entirely to one or more, but not all. अब ये क्या है? Now imagine, product A 100, B 50, C 50. Total 200, you sold at 180. Now if someone buys product A and B, A is 100, B is 50, instead of 150, they can buy A and B at 130. Okay, so A and B they can buy instead of 150 at 130. So can I say that 20 rupee discount is only for A and B? Can I say that 20 rupee discount is only for A and B? That extra 20 rupee discount is only for A and B. No discount will be allocated to C. So check, entity shall allocate a discount entirely to one or more, but not all of the performance obligation if all these conditions are fulfilled. You regularly sell each of these goods on a standalone price. You also sell a bundle, only A and B. Bundle of some of the goods. Bundle of some means only A and B. And A and B are selling at a discount, and now the total discount with ABC is the same as the discount which you give in A and B. Okay, to check over here, I go to the question, not 16th one, 17th one, check. There's a product X, Y, Z, 50, 25, 45. Okay, you sold, total is 120. Now let's see. In addition, you regularly sell Y and Z at 50. Okay, Y and Z you sell at 50. So Y and Z together as such is 70. But you sell them at what rate? 50. So when I say 20,000 discount in Y and Z. And now what happened is you sold XYZ together for 1 lakh. Instead of 120 you sold for 1 lakh. Can I say you give 20,000 discount in XYZ together? So normally Y and Z also can be available at 20 discount. यहाँ पे XYZ is also available at 20 discount. The 20 discount is only for Y and Z. Did you understood? 20 discount is only for whom? Y and Z. No discount will be allocated to X. Next, residual approach, what they are telling. Imagine, you enter into a contract to sell X, Y, Z, plus you are selling alpha. X, Y, Z and alpha. Total become 130. Now, standalone selling price of alpha is variable. Alpha is variable and alpha ka price ranges between 15 to 45. Now in our case, suppose what happens over here is we know anyways that XYZ was sold at 1 lakh rupee and now with alpha is total 130. So can I say remaining 30 can be allocated to alpha. XYZ is 1 lakh. XYZ is 1 lakh. 30 remaining can be allocated to alpha and is it falling in the range? Yes. तो चलेगा. तो यहाँ पे residual method for alpha is fine. But now suppose third case में the transaction price is 105. Transaction price is 105. I cannot have 1 lakh for XYZ and balance 5 for alpha. nahi. If I take balance 5 for alpha, can I say it doesn't fall in the range? If I take balance 5 for alpha, it doesn't fall in the range. Then in that case, your residual approach is not proper. You need to find the SSP of everyone by some other method. Next one is customer option for additional goods. Okay, next one is customer option for what? Additional goods. Okay, if you are buying goods today, I'm selling you goods plus you get some loyalty points. Okay, you get some loyalty points or getting some discount voucher which you can redeem in future, which you can redeem in future. So today, I'm not just selling this goods to you, I'm also selling a right to buy a goods at discounted price in future. I'm selling actually how many things too? I'm selling goods also, and I'm selling a right to buy the goods at a discounted rate in future. So they are two separate performance obligations. So today if you pay me 100, it's not full sales 100. So today if you pay me 100, I have to bifurcate how much is towards the goods which I'm giving you right now and how much is towards the right to get the goods at discounted price in future. TK, how to allocate? It's based on the relative standalone selling price. Check the question. Check the question. An entity enters into a contract for sale of product A for 1,000 and the contract gives customer a 40% discount voucher for future purchase. So I'm giving you goods today, plus I give you a discount voucher to purchase goods at 40% discount in future in next 30 days up to rupees 1,000. Okay, the maximum you can buy goods of 1,000 and you will get a discount of how many percentage? 40%. Now, normally you get 10%. 10% everybody gets. 10% everybody gets. So when I say you will get extra 30%, and up to maximum of 1,000 rupee goods. But you think that customer likely will take only 500 rupee good. The customer will take 500 rupee good in future. They will get extra 30% discount. 500 ka extra 30%. What is 500 ka 30%? 150, and there's a 80% probability that customer will come and redeem the voucher. So all customers don't come. The voucher ka value. What is the value of voucher? First of all people will not come. Okay, 80% will come. 80% will come. They will buy goods of 500. Okay, the 500 ka goods lenge 80% people, and they will get extra 30% discount into 30%. So voucher ka value is 120. So goods ka value is 1,000, voucher ka value is 120, but I am charging a combo. How much did I charge? Did I charge separately for voucher to you? No, I charge a combo 1,000 only to you. I did not charge extra. The combo is charged at rupees 1,000. So this combo I have to bifurcate between goods and that discount voucher separately. Goods I gave you today, that much revenue I'll record today. Discount voucher is basically to be redeemed in future. That revenue will come in future. The today revenue to be booked is total revenue 1,000 into 1,000 by 1120. So today the revenue will be 893 rupees. So check. Today the revenue is 890 and discount voucher will be recorded as revenue in future. Okay, next one. KK Limited runs a departmental store. You give 10 points for every 500 rupee purchased and 1 point is worth 50 paisa. 1 point is worth 50 paisa. So can I say indirectly you are getting for every 500 rupee 10 points, 1 point is 50 paisa. So can I say 5 rupee benefit? For every 500 rupee you get 5 rupee ke loyalty points. For every 500 rupee you get 5 rupee loyalty points. So can I say sales, if at all the sales is 100, so loyalty point ka value will be 1. For 500 rupee it is 5 rupee, for 100 it is 1 rupee. For 100 it is 1 rupee, but I am not charging 101 from you, I will be charging only 100 from you. Okay. Now during the accounting year we awarded some 1 crore points. During the accounting year we awarded 1 crore points and 18 lakh points remained undiscounted. And they can use the point within 3 years. They can use the point within how many years? 3 years. Okay. Give the journal entry for a sale of 10 lakh done on a particular day. If 10 lakh rupee sale is done on particular day, I will not record sale as 10 lakh. Because one is I did sales. Now I also have given you a right to buy goods in future at some discount. The loyalty point is given. If sale was 100, loyalty point was 1. See, on 500, 5 rupee loyalty point. 500 pe 5. So can I say 100 pe 1? So I'll be booking a sales how much? I'll be booking a sales how much? So 10 lakh into 100 by 101. 10 lakh into 100 by 101. The sales is 990099 and revenue deferred will be 10 lakh into 1 by 101. 10 lakh into 1 by 101 is 9901. So bank debit 10 lakh to sales is this, and to liability under customer loyalty is 9901. Are you clear? Next, how should the redemption transaction be recorded? Okay, how should the redemption transaction be recorded in 1718? Total sales this year is 5,000 lakhs. So 5,000 lakhs when you sold. So 5,000 lakhs into 100 by 101 was sales, and 5,000 lakhs into 1 by 101 was the deferred. 5,000 into 100 by 101 is sales, and 1 by 101 is deferred. Okay? Now, this 49 lakh 50,000 which is deferred, 49 lakh 50,000 which is deferred, it's not 50 lakh, it's 4950. It is 5,000 lakh into 1 by 101. It's not 5,000 into 1 by 100, it's 5,000 into 1 by 101. Okay. Now, this is for the total loyalty points. Now, check the total loyalty points which were given were 1 CR. Out of the total loyalty points 1 CR, can I say they've exercised currently how many? 18 are remaining undiscounted. So 82 lakh points they've already redeemed. 82 lakh points they've already redeemed. So can I say for that 82 lakh I should book a revenue? Abhi point redeem kar liye, so I should book that revenue. They would have taken the goods, I would not have charged. But now earlier we had not taken revenue, now it will be taken in revenue. Okay, but now pay attention, and you expect only 80% of remaining will be discounted in future. Out of 18 lakh, we are expecting 80%. Can I say 1440? So 82 plus 1440, 96 lakh 40,000 points will be redeemed total. So you assume, जो revenue differ किया ना, the revenue deferred is for 96 lakh 40,000 point. The revenue deferred is for how many points total? 82 lakh taken, 18 remaining. 18 ka 80% will be exercised. So this 4950 is for 96 lakhs 40,000 points. Okay, for 96 lakhs 40,000 points, revenue is 4950495. How many are exercised now? 82 lakh. So for 82 lakh, how much is the revenue which I should take? So I should take a revenue of 4211. Check karo, it will come 4211. Did you understood? For 96 lakh 40,000 point, revenue is this. Now 82 lakh are exercised, so for 82 lakh it will be how much? And now the remaining will still appear as a liability. So for 9640 it is this, so for 82 it will be how much? This is to be booked, remaining will appear as liability. The liability is this. Now what happened next? What happened next? Check fourth question. 60% of outstanding points were discounted. Outstanding is 18. Outstanding is 18. 18 ka 60%. What is 18 ka 60%? 1080. Outstanding is 18 lakh. Outstanding 18. Now, expected to be discounted was different, but outstanding is 18. 18 ka 60 percentage. So 1080. Now I know 9640 was this much. So now 1080 is how much? 9640 was this much, so 1080 is how much? This much revenue will come, and still the remaining will appear as liability. Any doubts? Anybody with this question? This is a good one. Please make sure you are doing it properly. Next, step number 5. So step 1, contract with customer. Step 2 was basically your performance obligation. Step 3 is transaction price. We allocated the transaction price to various performance obligation. Now, as and when you fulfill the performance obligation, record revenue. As and when you fulfill the performance obligation, you record revenue. As and when you're giving goods or services, record revenue. Now, there are two concepts over here. Revenue to be recorded at a point of time, or revenue to be recorded over a period of time. What are the two concepts? Revenue to be recorded at a point of time, or revenue to be recorded over a period of time. I'll come back to that. Before that, when do I say I fulfilled my performance obligation? When control is transferred. When control is transferred, I say I fulfilled my performance obligation. Okay, that's okay. Now, if you just go down, there's a concept called bill and hold. There was a question on this May 22 exam. There was a question on this May 22 exam, bill and hold. Now, what is this bill and hold? Imagine, the thing is, goods are ready of yours. I can give it to you right now. but you told me to keep the goods at my place. The customer is requesting you to keep the goods at your place only. And he's telling, sir, please don't deliver right now, deliver later. I'm paying you right now. The customer paid you. But he says, sir, don't deliver right now, you deliver it later. So now control is not transferred. They are with me only. So can I record sales? Yes. If the criteria of bill and hold is fulfilled. Which are the criteria? Reason must be substantive. Customer requested. Second, that goods you keep it separately. Ready for physical transfer. That goods you keep it separately, ready for physical transfer, and you should not be using that goods. You cannot have the ability to use it. If all these criteria are met, the customer told me that's why I'm not delivering. The control not transferred, still he has paid me money. He has requested not to send right now. He has some issues going on at his place. He doesn't have a storage space. So now in that case, I've kept the goods separately for him, ready for transfer. Whenever he wants, I can give it. I'm not using it. I can record revenue. I hope you're clear. So Abhijit has a question, sir, will the concept of transfer of risk and reward apply? Normally, yes. Control goes, wo risk and reward hi ho gaya kind of. But bill and hold mein the goods are not yet transferred. Still we can record sale provided these conditions are satisfied. But now the thing is, when exam mein question comes, you need to write this condition. As a student, if you give just the correct answers, marks will not be there. You just have to ensure the theories are also written properly. Okay, now check over here. This was the question which was actually asked. You enter into a contract, you have to give machine and you're also required to give spare parts in 2 years. So spare parts also is to be given. Okay, they took the machine. So they came, they checked whether they are fine or not. So giving machine and giving spare part are different performance obligation. Okay, they took physical possession only of machine and they inspected the spare part. Customer says, I'll take it later. They inspect and accept the spare part, but customer request that, sir, your factory is nearer to, your warehouse is nearer to my factory. So rather than keeping at my warehouse, you keep it at your warehouse. Now what you have done, you have kept it in a separate section, ready for immediate shipment, and now you feel that company will ask for the spare parts after 2 to 4 years. Okay, so he did not took the delivery of spare part. They paid and they told me, sir, keep it with you. So I have kept it separate, ready for dispatch, but I expect they will take after how many years? 2 to 4 years. Would I use in that 2 to 4 years? No. So can I record sale? Answer is yes. Now over here, how many performance obligations are there? 1, sale of machine. 2nd, sale of spare part. And one more. I have to keep your spare part for 2 to 4 years. Nobody keeps for free. So there's a custodian service. There's a one more, that is custodian service. The total revenue what I'm getting, I have to bifurcate between sale of machine, sale of spare part and the custodian services. Custodian services are given over a period of 2 to 4 years. That revenue will go over 2 to 4 years. Now I told you revenue can be recorded. Basically the transfer can happen at a point of time or a period, over a period of time. So point of time, over a period of time. So when, okay, now Abhijit has a question, sir, what will happen if the spares are destroyed? Abhijit has a question, what will happen if the spares are destroyed? Now see, I kept it normally at customer's risk. But whether risk will be mine or not, insurance I have to take or customer will take, that depend on agreement with the customer. I repeat, that will depend with what? Agreement with the customer. So Abhijit, yahan pe they don't say risk and reward wala word only. They say the reason was substantive, customer requested, they have paid you the money also, you have kept it separate, you are not using for any other thing, it is ready for dispatch anytime customer asks. So you can record the revenue. Okay, now when do I say revenue? Well, basically the control is transferred over a period of time, or when do I say control is transferred at a point of time? If control is transferred over a period of time, revenue is recognized over a period. I repeat, control transferred over a period, revenue recognized over a period. Control is transferred at a point of time, the revenue is recognized at that point of time. Okay, so we say it is over a period of time if any of the following criteria met. Customer simultaneously receives and consumes the benefit. Customer को simultaneous benefit मिल रहा है. Okay, you took a Netflix subscription 1 year, you're watching 1 month, you got benefit, again you watched, again you watched, again you watched, so you're getting benefits simultaneously. They will record over a period of 1 year. Second, my performance, what I'm doing, creates an asset which a customer controls. So because of my performance, asset is coming which customer is controlling, then the revenue is again over a period of time. And third, my performance does not create an asset with alternative use. So what I'm doing now, like suppose you appointed me to construct a house in your plot. You appointed me, I'm a contractor. You appointed me to construct a house in your plot. So in your plot, I'm constructing a house. In your plot, I'm constructing a house. Now suppose if you say, sir, I don't like it, can I take back the house? Can I take back the house? No, plot is yours now. I cannot take it now. So it creates, I'm creating an asset which has no alternative use for me. No alternative use to the entity, and I have an enforceable right to collect the money till date. Like in between you say, I don't like your work and you want to cut it out. In between you say, I don't like your work, you want to cut it out. See, I am creating an asset which has no alternative use for me because it is your house. And if I have a right, enforceable right to collect the payment, so agreement mein likha hai, I can collect payment for the work which has been done. I can collect payment for the work which has been done. Then in that case, again, the revenue is to be booked over a period of time. As in when I'm working, automatically the revenue is getting, control is getting transferred. So that is no alternative use to me, and I have a contractual or basically enforceable right to collect the payment for the work which has been completed. If any of these three criteria are not met, then the revenue is recognized at a point of time. Okay, next. Now, if at all control is over a period of time, if a control is transferred over a period of time, revenue is recognized over a period of time. Now, over a period of time, kitna? Okay, now how much till date? How much till date? So I need to understand how much work is completed till date. I need to understand how much work, how much performance obligation is satisfied, how to measure the progress, how much work you have done. Two methods. One is called output method, based on survey of some engineer. And second is input method. Input method is cost incurred till date divided by total estimated cost. So I have to spend 100, out of 100 I have spent 30. I have to spend 100, I have already spent 30. So can I say I have completed 30% of your work? So I should record a revenue of 30%. So how much work I have completed? One is output method, survey of some engineers. Second is input method, cost incurred till date divided by total estimated cost. Now check over here in this. When applying input method, this is important. When applying input method, we need to take care about what? One, sometimes costs are incurred, but they do not contribute to progress. Sometimes costs are incurred, but they do not contribute to progress, like abnormal losses. So that should go, can I say, directly to P&L? Abnormal losses. So that you don't consider. So you spend total 30 rupee, but 30 may say 5 rupee was kind of abnormal. So don't count only. The 25 out of 100 you spend, you count the percentage completion 25%. Did you understood? So cost which do not contribute to progress, wasted material. And second, cost you have incurred, but that do not contribute to progress in that proportion. Cost you have incurred, but that do not contribute to progress in that proportion. For example, you're constructing a building. You're constructing a building for someone. In a building, a lift is also required. Now, can I say lift can be fitted only after the structure is done? Lift can be fitted only after the structure is done. Now, I purchase the lift, put it over there. Structure itself is pending. So, just by purchasing the lift, don't tell that, oh, 30% work is done. So you might say out of 100, I have already spent 20 on lift, 20% work completed. No, 20% work is not completed. The building is actually not started. So don't take in that way. So there is, you have purchased the lift, you put it over there. Now still I can't use the lift, the structure is not ready. So cost is incurred, but can I say it does not? It does not basically show the proportionate completion. Really that much work is not done. वो तो just lift ला के रख दिया. So don't say 20% work khatam. No, 20% work is not khatam. So then in that case, whatever you spent on lift, you can record revenue equal to the cost of lift. Whatever you have spent on lift, you can record revenue up to what? Cost of lift. So when cost incurred is not proportionate to the entity's progress, in such case, the best way is to recognize revenue only to the cost. So for that lift, record revenue only to the cost. Check question number 21, important. Okay, you are asked to renovate a building including installation of elevator. Total price is 50 lakhs. Elevator cost is 15 and other cost is 25. Your total cost will be 40. Total cost 40, revenue 50. Now you purchase the elevator and you deliver it to the site 6 months before they will be installed. So can I say elevator, I put it, but is it to be installed right now? No. So don't say that, sir, I've already spent 15 out of 40, that much work completed. Nahi. Nahi. So for that elevator, I have spent money, I'll book revenue only equal to cost. So can I say for elevator, I'll book revenue only for what? 15 lakhs. Now coming to other cost. Other cost, how much I have done? The entity has actually incurred other cost 5 lakh. Okay, out of 25 lakh, I incurred 5 lakh. Can I say 20%? Out of 25 lakh other cost, I incurred what? 5 lakh. Okay, so now this revenue 50 lakh. इसमें से 15 is for lift and 35 is others. 15 is for lift, 35 for others. For lift, I'll book 15 only. Because अभी install नहीं होगा तो उसमें cost is only to be used. But for others, 20% work done. Can I say 35 into 20%? I can book a revenue 7. The total revenue to be booked is 15 plus 7. Answer is 22 lakhs. 15 plus 7, 22 lakhs. Done? Okay, repurchase agreement. If I have a repurchase agreement, I'm selling goods to you, but I have a contract, I'll buy it back from you after 2 years. I'll buy it back from you after how many years? 2 years. So this को बोलते हैं repurchase agreement. So can I say in that case, the goods will be coming back to me? If the goods will be coming back to me, don't record sales today. If goods will be coming back to you, what you should do? Don't record sales today. So now, sir, goods will be coming back to me. I don't record sale. But sir, they have paid me money. What should I do? They paid you 100 rupee. They have paid you 100 rupee. And suppose after 2 years, you have to pay them 110. After 2 years, you have to pay them 110. So treat 100 rupee as loan taken. Treat 100 rupee as loan taken. And in this 2 years, interest will accrue 10 and then you pay 110. So if the goods are going to come back, I should not record a revenue. I should not record a revenue. But now, sir, I got money. I got money. Okay. So selling price is 100. I have to give back more. If I have to give back more, money received is treated as a loan. Okay, but I got 100. I have to give back 90. Okay, I got 100. I have to give back only 90. Only 90. So क्या करेंगे? Then treat it as a leasing arrangement. Treat it as what? Leasing arrangement. So if I got 100, I'll pay you 120, 110, 100 received is treated as a loan. But if at all I received 100, and I have to pay you back how much? I have to pay you back how much? 90. So then 10 rupee is basically the rent which I have charged from you for using my asset. आपने मुझे 100 दिया, I'm giving you back 90 only. So 10 rupee I'm charging a rent for the goods of mine which you used. Did you understood? Question over here only related to financing wala, that loan wala is important. 1 million and right to repurchase is 1.1 million. So can I say today 1 million you give me, I have to give back 1.1. I will not record sale because goods are anyways going to come back. I'll not record sale. I'll book 1 million liability and then 1.1 million I'll pay you. The extra 0.1 million is a interest. Okay, other thing is fine. Now come to next one, intellectual property. Come to the next one, intellectual property. Okay, now license of intellectual property. Now there are two types. They say one is called access to IP, second is right to use IP. If it is access to IP, it is recorded as revenue over a period of time. If it is right to use IP, it is recorded as revenue at a point of time. Now, sir, what is the difference? Imagine, there is a cartoon called as Tom and Jerry. Okay, so can I say there is someone who has came out with a Tom and Jerry cartoon? You took a right from them. You took a right from them to make a soft toy, Tom and Jerry. Tom and Jerry के आप soft toy बना सकते हो for a period of how many years? 5 years. So can I say they gave you a license? They gave you license. So can I say they will have a revenue? Now question is, do they have to do anything with your manufacturing of soft toys? No. Do they have to do anything with manufacturing of soft toys? No. But okay, do you expect that they will continue to run that Tom and Jerry ka cartoon? Or if they shut down Tom and Jerry cartoon, can I say my sales will be impacted? So I expect that that guy, the one who has given me license, that guy will continue to have the Tom and Jerry cartoon. And if cartoon does well, my sales will also do well. And number 3, running a cartoon is not as per the agreement. Agreement mein nahi hai, they are not doing for me. Are they doing it for me? No. So check over here. The entity is required or reasonably expected to undertake activities. So they have to continue to run that program. Okay. Because of running the program, my sales will be affected. If cartoon does well, people will ask for Tom and Jerry soft toys. And third, they are running program not for me. So it is not a part of performance obligation here. So if all these 3 conditions are met, it is access to IP. So can I say indirectly for giving that license, they gave me the license, they're charging something, but they have to run program for certain years. So they'll book also the revenue from IP over certain years. But now imagine Kishore Kumar's songs, the intellectual property right is with his son. Kishore Kumar's songs, the intellectual property right are with his son. Now his son sells the intellectual property right of Kishore Kumar to T-Series. His son is selling the intellectual property rights of Kishore Kumar's song to whom? T-Series. Now whether his son has to do anything else? Whether his son has to do anything? नहीं, मैंने आपको right दे दिया, finished. वहां पे the cartoon was to be continued. यहाँ पे कुछ नहीं है. यहाँ पे कुछ नहीं है, तो it is basically a right to use the IP. यहाँ पे I gave you IP, I can record revenue. वो first वाले केस में I gave you right to that soft toy, I cannot record revenue immediately. I'll book revenue over a period because I have to run that cartoon. Are you clear? Right to access, right to use. Next, come to contract cost. Next one is come to contract cost. Now see, there are 2 types of cost. One is called as cost to obtain a contract and second is cost to fulfill a contract. Okay, cost to obtain a contract. If any specific cost is incurred for obtaining a contract, like I got this contract, I paid commission. The commission paid on successful receipt of contract. Can I say it's a specific expense for that? That you capitalize. Now capitalize ka meaning, if contract ka revenue is over 3 years, that commission expense will also go over a period of 3 years. The incremental cost for obtaining a contract, incremental is specifically for that. That can be capitalized. That can be capitalized, and capitalize karke if revenue is booked in 3 years, that commission cost also is spread in 3 years. That is cost to obtain a contract. Next is cost to fulfill a contract. Okay, to fulfill a contract, I have to manufacture goods, I might use my PPs, etc. So if it falls under any other as IND AS, if it falls under any other IND AS, you record it as per other IND AS. So if cost to fulfill वो inventory में जा रहा है, record as per IND AS 2. But if it doesn't go under other IND AS, then it is coming over here. ठीक है. Now I spend money. I spend money to fulfill the contract, but the thing is, revenue is recorded over a period of time, and I spent money right now. I bought material right now, which will be used in next year. I bought material right now, which will be used in next year. It will appear as an asset in your book. It will not appear as an expense in your book. The cost which are directly related to contract, that you can take it, And if the costs are going to be recovered in future, then you are required to capitalize it. But if at all we get a revenue right now, related cost will also come in your P&L right now. Next is presentation and disclosure. Next is presentation and disclosure. Now tell me one thing. Can I say revenue recognition is based on fulfillment of performance obligation? I fulfilled my performance obligation, I book revenue. So as per this Ind AS, I can book a revenue of say 100. This is as per Ind AS 115, I can book a revenue of 100. But as per the agreement, as per Ind AS, the work completed is somewhat 100 rupee I have done. But as per agreement, I have already billed is 80 rupees. Billed is only 80. Now, I have completed work as per the Ind AS, I can book revenue 100. The contract asset is 100. Contract asset is 100. The contract asset is nothing but where you have transferred the goods and services. Okay, what is a receivable? Receivable is an unconditional right to receive payment. Okay, as per this standard, I can book a revenue 100. But as per our contract, I can bill only 80. So can I say I can demand payment of 80? I can demand payment of only 80. So 80, if the payment I can demand, so 80 is receivable. The receivable is something which is unconditional, right? And total actually sales I have done is 100. So extra 20 rupee. Receivable is your asset and that extra 20 rupee will appear as your contract asset. So in your balance sheet, receivable will not be 100, receivable will be 80. Extra 20 revenue which you have booked will appear as a contract asset. And if at all I booked the revenue 100, customer paid me 110, extra 10 rupee will appear as a liability in books. Customer paid you 110, extra 10 rupee will appear as a contract liability. Now check this question. This was asked in November 19. There are some two contracts, you have done some work, all that thing is given. Now check the sales value 40 lakh, second year ke liye, and the expected cost is 32. Second contract, the expected cost is 34. And there's some additional rectification 2 lakh required. Additional rectification 2 lakh required. Now, if you feel like additional rectification 2 lakh required is a normal cost, it's a normal cost. So then the cost is borne within the project. But if it's abnormal, it will go separately in P&L. Okay. Now, already independent surveyor ka report is there and they say contract is 30% complete. Second one, the contract is 20% complete. If they already gave you 30% complete, 20% complete, so simple. Record 30% revenue for first one, record 20% revenue for second one. Same way, record 30% expense for first one, total ka 30%, record 20% expense for the second one. So this is already given. Don't try to find the percentage completions. Okay. So actually over here we have booked some revenue. The revenue booked is 12 and 6, 18. Revenue booked is 12 and 6, 18. Now how much we have received? Check karo, receive kitna hua hai? Check how much we have received. Payment received yahan pe 9.5. And in this, the payment received is 13. 13 received, 9.5 received. Okay, 13 received, 9.5 received is 22.5 received. 13 received and 9.5, 22.5, revenue is only 18. Can I say extra received 4.5 will appear as a liability in your balance sheet. It will appear as a liability in your balance sheet. Plus, you might have bought some materials which are not yet used. So material le liya, not yet used, that will appear as your WIP. And revenue 18, cost 15 ho gaya. So this is how basically presentation is done. So again I'm telling, as per this Ind AS I can bill you 100 rupee. As per this Ind AS I can book a revenue 100. But as per agreement I can make a bill of 80. So receivable is 80, extra 20 is a contract asset. And if you have paid me more than the revenue, then that will become a contract liability. Last point of this standard. Last point of the standard, service concession arrangement. Now what is a service concession arrangement? Pay attention. This is basically government gives a contract to construct the road to the companies. Now, which is the company which construct road for government? Remember L&T. The L&T has got a contract from the government to construct a road. Now construct करने के बाद they have to maintain the road and they can operate a toll booth over there. You might have seen toll plaza, toll booth. So they are telling you construct a road, you maintain for 10 more years. So can I say you're doing two work? One is construction, one is maintaining for 10 more years and operating the toll booth. Now what is the revenue you are getting? What is the revenue you are getting? You're constructing road for government, you're basically maintaining it and operating the toll booth. Now government told you, you can collect toll for next 10 years. Okay, the government is not paying anything to you. Government says you can collect toll for next 10 years. If they say you can collect toll for next 10 years, can I say I got a kind of intangible asset, right to collect the toll? So intangible assets will be debited. But if government says you can collect toll up to 500 crores, okay, government says you can collect toll up to 500 crores or government says we will pay you 500 crores. So can I say now amount to be received is fixed? So what happened over here? I have a contractual right to receive a fixed amount, cash or cash equivalent. So now it becomes a financial asset. So what I will debit? If they tell me I just have a right to collect toll, intangible asset debit. If they tell me I can collect toll up to 500 crores, or if they tell me they will give me 500 crores, then in that case, financial asset debit. Now you are doing two activity. One is constructing, then is operating, maintaining. Operating, maintaining. Constructing activities revenue will be booked over the period of construction. I repeat, construction activity ka revenue will be booked over a period of construction and you will book the revenue at fair value of construction. You will book the revenue at what? Fair value of construction. And operating, maintaining ka revenue will be booked over the period of operating and maintaining. Okay, check question over here. Important. You got a project called as Bhilwara Jabalpur project. Okay. In this Bhilwara Jabalpur project, what happened? The total expense is 50 crores. Total expense estimated is 100 crores. And you have done that expense under old IND AS, you recorded intangible asset, old AS. IGAP is old accounting standard, you record intangible. Okay. Expense estimated is 100. Fair value of construction service is 110. Government has guaranteed you 200 crores. Okay, so do you have really intangible asset? Do you really have intangible? No. Government has guaranteed me I'll be getting how much rupees? 200 crores. So contractual right to receive some fixed amount. So this is a financial asset. Finance revenue over the operating phase is 15. Other income will also be there. Now see, total is 200 crores. Over the period of construction, I'll book revenue equal to fair value of construction. What is the fair value of construction? 110. Okay, so I did some construction. I repeat, I did some construction. The expense will be incurred. Construction, cost of construction to bank. Okay. Now over the construction period, I'll book a revenue 110. The financial asset to construction revenue 110. Now they're given over operational phase, finance income is 15. Over operational phase, finance income is 15. The financial asset to financial revenue 15. Okay, so 110 is this, 15 is this. Remaining 75 will be that other incomes. वो maintaining करने के लिए they are giving me. So financial asset to revenue, this is 75. So 110 is for construction service over a period of construction. 15 is finance income, it's over a period of that operating phase ka finance income, and operating phase ka income will be balance 75, which is over that operating phase. This is revenue relating to operating phase. This is revenue relating to construction. Now come to the second one. We have a contract or agreement with government of Maharashtra. Construction cost is 110. Fair value of construction is 200. And we have a right to collect the toll. We have a right to collect toll. Right to collect toll, it will be shown as intangible. It will be shown as intangible. Okay, so I spent 110, entry, cost of construction to bank 110. Fair value of construction is 200. I'll record revenue of 200 over the period of construction. The revenue 200. What should I debit? What should I debit? Did I got cash? No, I'll debit intangible asset. Intangible asset will be amortized. Intangible asset will be amortized. And while operational phase पे there might be some revenue coming, but question is silent. That's why यहाँ पे we put up question mark. So in the first one, we had a right to collect 200 crores. It's a financial asset. Second, we have a right to collect toll, which is a intangible asset. Did you understood this? Did you understood this? Done. IND AS 115 is over. I'm not taking a big one. I'm taking a smaller one now. I'm taking one smaller one, IND AS 108. And then we'll take a small break. So come to IND AS 108. The one big is over. Now we are left with two big standard. Which are the two big standard left? 116, 109. Okay, in between I'm just taking a smaller one, then we take a 15 minutes break. Okay, what do you mean by the word operating segments? Now see, when I prepare a balance sheet P&L, it is for a company as a whole. Now company might be doing 2, 3, 4, 5 businesses. But we don't get the profitability from each and every businesses because it is for a company as a whole. But the shareholders, do they want to know how each of the business is doing? Like Reliance Industries Limited, they are into refinery business. They are into textile business. They are into basically your, this nowadays, this, what we say, Jio wala, telecom business. So many businesses they are doing, but the balance sheet will be Reliance Industries Limited, everything total. So we have a segmental reporting which is done in your notes to accounts. Okay, now what is the core principle of IND AS 108? What is the core principle of IND AS 108? Entity should disclose information. You should disclose information to enable the users to evaluate the nature and financial effect of your business activities in which you are engaging and the economic environment in which you operate. So you should give information business wise as well as you should give some information geographical area wise. So one is you give information to evaluate nature and effect of activities which you are engaging, and you also give information related to economic environment in which you operate. Now Diksha is having a question that, sir, you please do IND AS 21 also. Diksha, we already done IND AS 21 yesterday. So this is the part 3 of marathon. IND AS 21 was done in part 2 of marathon. You can watch it later. Okay. Now what do you mean by the word operating segment? Operating segment is a component of entity. It's a component, a kind of division, component of entity, which is engaged in a business activity from which it earns revenue, incurs expenses. It's a component which is engaged in business activity from which it earns revenue, incurs expenses, and whose results are reviewed by CODM, Chief Operating Decision Maker. Chief Operating Decision Maker. CODM need not be one person. एक person नहीं है. So those people who are taking decisions, they review the result of that component, and for which the discrete financial information is available. We have a separate information available, so we can disclose the information. So it is a component of entity which is engaged in business activity, which generates revenue, does expenses, whose result is reviewed by CODM, and for which the discrete information is available. So this is definition of operating segment. Now it is possible in a business, we might have 10 operating segments. In a business, in a company, we might have how many operating segments? 10. If I have 10 operating segments, should I give the disclosure for all 10 operating segments? If I have 10 operating segments, should I give disclosure for all 10 operating segments? No. This was operating segment. Now, if you just go down, there's a word called reportable segment. There's a word called reportable segment. Now, what is a reportable segment? Reportable segment, first, it has to be an operating segment and it meets the quantitative threshold. So, one, it's identified as operating and it meets what? Quantitative threshold. So, all the operating segments don't need disclosure. Chote segments, you can club it, na? So, which one meets the disclosure? Which exceeds the quantitative threshold? Which are the quantitative threshold? This is important. 1. The revenue. Revenue from the segment, internal plus external. External revenue is that segment sold to outsider. Internal revenue means that segment sold to other segments of the company. The internal plus external revenue exceeds 10% of the total internal plus external revenue of all segments. Either this And see, any criteria satisfied, it's a reportable segment. Number two, the profit. The profit or loss of the segment exceeds 10% of profit or loss combinedly of all the segment, but in absolute term. So what I should do? Do one thing. You ignore the brackets. Positive, negative figure you ignore. You do one thing simple. Total of all the profits of all segment, total of all the losses of all segment, usme se whichever is higher. Total of all profit is say 100 and total of all losses is say for example 120. So ye 100 hai, ye 120. Can I say whichever is higher is 120? Okay, so any segment which has a profit or loss 10% or more of this, so 120 ka 10% is what? 12 or more, it becomes reportable. The total of all profits, total of all losses, उसमें से whichever is higher in absolute terms हो गया. तो 100 is total of all profit, 120 is total of all loss, whichever is higher is 120. Now what is 10% of 120? 12. So any segment having a profit or loss 12 or more becomes a reportable segment. And third one, asset. The assets of the segment. The assets of the segment is 10% or more of the total assets of the combined all segments. Now, the three criteria, one is revenue wala, one is profit wala, other is asset wala. Any criteria satisfied, it becomes a reportable segment. Plus, your reportable segment may, you found out by this way, who are the reportable segment. Reportable segment has to cover an external revenue of 75%. If reportable segment does not have external revenue 75%, few more segments are added under the reportable segment. And a management may additionally add something in reportable, even though it doesn't fulfill criteria, they feel it will be better for user, they may add it. Okay. Now check this question. Sales internal, external, total if I want to see, sales internal, external. Yes, segment A, B, C, D, E. This is 50, this is 50. So can I say internal plus external total become what? 1 CR. Okay, what is 10% of 1 CR? 10 lakh. So any segment having a sales 10 lakh or more, internal, external together, 10 lakh or more is reportable. So this is reportable. This is reportable. This is reportable. So A is reportable, D is reportable. C is a new business, management expects this will do well. So can I say they may add C also. So actually A exceeds threshold, D exceeds threshold. B and C do not exceed. But I need to check the reportable segment has to have external revenue 75%. Ye 30 lakh, ye 5 lakh, 35. 35 out of 50. Can I say external revenue is not 75%? External revenue is coming only 70%. So now we need to add someone under reportable one. So either B or C, management can put anyone under reportable one. If C is added as reportable, the external will become 87. Alternatively, if B is added, the external will become 83. Next question, check over here. Now asset wise, this is 200. Asset wise total is 200. So anywhere 20 or more is reportable. So M, N, O, P, Q. Oh, all these are reportable. यहाँ पे sum of all profit check करो 50, 10, 10, 30. 50, 10, 10, 30 is 100. Sum of loss 190 and 10, 200. So sum of profit is 100. Sum of loss is 200. Absolute term में whichever is more loss. 200. 200 का 10%. 20. 200 का 10% is 20 or more. So this is reportable. This is reportable. This is reportable. Okay, third wala case, revenue total 1200, so 120 or more, this is reportable, this is reportable. So if you check out, asset mein 5 are reportable, result mein this R is also reportable, so indirectly all are reportable segments. So check over here, all segments are reportable. One or the other place it gets connected. Okay, now Abhijit has a question, sir, is it mandatory to report discontinued operation? See, discontinued operation will not be reported over here. Disclosure for discontinued operation will be as per your IND AS 105. So Abhijit, it is not covered under segmental information. वो 105 की तरह उसका disclosure will happen. Next, we have the disclosures. So we understood which are reportable segment. Okay, first we understood what is operating segment. उसके बाद भी अंडरस्टूड विच आर रिपोर्टेबल वन, रिपोर्टेबल पता चला। अब रिपोर्टेबल है तो व्हाट आई नीड टू रिपोर्ट, क्या डिस्क्लोज करना है, what I need to disclose. So one, I have to give general information about the segment. Second, I have to give data about the profit loss, segment asset, segment liability, and basis of measurement. And third, some reconciliation. That is things to be reported. Like general information mein what? Factors used to identify reportable segment, the judgments made by the management, type of product, etc. Then information about profit, loss, assets, liability. What I need to report? Check. So I need to report one, the revenue from external customer, revenue from internal, interest revenue, interest expense, depreciation, some material items जो exceptional है, kind of. Then share in associate JV which you are getting. Then income tax expense, material non-cash item other than depreciation. Sir, why other than depreciation? Depreciation is already covered above. Why other than depreciation? Depreciation is already covered above. That's why. And one more thing. At what values they will be disclosed? They will be disclosed at the values which are reviewed by CODM. Now pay attention. What is which are reviewed by CODM? Imagine in your books for inventory, you follow weighted average method. In your books for inventory, you are following a weighted average method. But for the purpose of going through, the CODM reviews the inventory based on FIFO. If CODM reviews inventory based on FIFO, so in your note of operating segment, the inventory will be put as per FIFO. So books may they follow weighted average, but the CODM reviews it for decision making purpose based on FIFO. तो यहाँ पे in notes to account segmental reporting it will be based on FIFO only. Now this inventory and the book inventory doesn't match, put it under reconciliation. This inventory and book inventory doesn't match, put it under reconciliation. Fine. This is just a illustrative disclosure. So how illustrative disclosure? These are all your different segments. And see, those which are not reportable, they put all others. So you might have 3-4 which are not reportable, they're all others. Okay, the revenue from external, internal, interest revenue, interest expense, net interest, depreciation amortization, reportable segment profit, material non-cash item other than depreciation amortization, segment asset, segment liability, and expenditure for reportable segment on non-current asset. So expenditure for reportable on non-current asset, like we have a capital work in progress, so that is on non-current asset. I'm spending some money, that. So this is basically illustrative disclosure. Now measurement, at what value it will come in disclosures. The notes to accounts mein kaun sa value aayega? The value which is reviewed by CODM. What value it will come? It value which is reviewed by CODM. Now, if that value and the balance sheet value are different, you are required to give reconciliation. If that value and balance sheet value are different, then you are required to give reconciliation. I just now gave you example inventory wala. Okay, next question number 3, same. Check books may we follow weighted average, but CODM reviews based on FIFO. So IND AS 108 disclosure will be as per FIFO, but it will not match with balance sheet. Will be giving a reconciliation. Now, next point. This is basically the last point of this chapter. Entity-wide disclosure. Now, what is this entity-wide disclosure? These are some disclosures which you have to make if these disclosures are not covered above. I repeat, these disclosures you need to make if these disclosures are not covered above. ऊपर जो ये disclosure था ना, उसमें अगर ये cover नहीं हुआ, then you give it. Which are there? One, information about product and services. So if you already covered it under general information, no need to put again. If you already covered it under general information, no need to put again. And you should report revenue from external customer for each of the product and services. Revenue from external customer for each of the product and services. Second, information about geographical area. Now, if your operating segment was a business activity, तो आपने report किया था business wise. Check करो illustrative disclosure. Can I say car parts, motor vessels, software, electric, finance? So this was business wise, not geographical area wise. So separately you also give as per geographical area wise. What? What you give geographical area wise? 1. Revenue from external customer. India say how much, abroad say how much. Revenue from external customer, India how much, abroad how much. Non-current asset, located in India how much, abroad how much. Non-current asset, PPE, etc. Located in India how much, abroad how much. So geographical data is also to be given. Revenue from external customer in India and abroad, non-current asset which you're having in India and abroad. And plus you have to give information about major customers. If a single customer is 10% or more of total revenue, single customer is 10% or more of total revenue, detail about that customer is to be given. So this is entity-wide disclosure. You add this disclosure if they were not provided above. Okay, now we have this question number 4 which was asked in May 18. Check the question. They're given 2 segments, quoting and others. 2 segments, quoting and others. External sales, GST, other operating income. Result is profit loss, assets, liabilities. Okay. Unallocated revenue is this. So whatever is allocated, I'll allocate. Unallocated directly goes in total column. Unallocated directly goes in which column? Total column. Interest and bank charges, they are not allocated. I'll put it in total column. Income tax expense, they are not allocated. I'll put it in total column. Investments are 1 CR in total. Unallocated asset is also in total. Unallocated liability, reserve surplus capital. Depreciation, quoting and others. Quoting and others. Capital expenditure, quoting and others. Quoting and others. Revenue from outside India. Revenue from outside India, so balance will become in India. So external revenue ये है, rupees are in lakhs. Rupees are in lakhs, remove this 5 zeros. ये 5 zeros निकाल दो, rupees are in lakhs. So total 270, out of 270, 30,000. Out of 270, 30,000 are abroad, remaining will be in India 240. Segment asset outside India. Segment asset outside India 10,000. Segment asset outside India 10,000. In India, the asset will become 70,000. Remember wo entity-wide disclosure. In your entity-wide disclosure, we had to give information about geographical area, external sales in India, outside India, non-current asset in India, outside India. Okay, the check how this will be disclosed. First, you give the general information. Then information about revenue, results, other information. External sale, उसमें से GST deducted, net sales. Operating income are added, this is the total revenue. Result में segment result is given. Unallocated incomes are added. So profit before interest tax, interest deducted, profit before exceptional item, exception is profit before tax, tax deducted, profit after tax. Now asset में allocated ones were already given. Investment and other unallocated, these are total asset. Liability में allocated was there, unallocated in total, share capital, reserve surplus total, this is total of liabilities and shareholders. And this is some other information. ये geographical information was required. Revenue in India, outside India. Segment asset in India, outside India. Non-current asset in India, outside India. Did you understood? Any doubts? Anybody? Khatam IND AS 108. We are done with 115. We are done with 108. Okay, now there's a question. Rishabh has a question, but sir, disclosure can help competitor attract our key suppliers. See dear, you are not giving information about your suppliers, you are giving information about your key customers. And I tell you, your key customers, those who are 10% or more of your total revenue, if they are key customers, your competitor already know about them. So don't try to make a fool, they already know who are your big customers. Okay, that is done. Ashwath sir, shall we need to add our subsidiary associate JV? Dear, you don't have to add subsidiary associate JV, but imagine you quoting business mein you have a subsidiary. So can I say if I have a subsidiary, there will be a share of profit coming from subsidiary also. If I have an associate JV, तो उनमें हमारा share of profit I'll add. So if quoting business mein we have a subsidiary associate JV, तो उनका profit would have came yes CFS में. If in other business I'm having, to that also I have to show it separately. Did you understood? Okay, now Rohit has a question that's a revenue including GST in geographical area I should take or excluding GST. Now let's see what they have done. Probably it will be net of GST. So 262 is the total sales. What they have taken over here is 262 or 287. Okay, 317 is the total revenue. In India, 287 and this. What is 317? Kahan se aaya 317? Okay, they have taken basically this net sales and the other operating income. Over here, Rohit, they have taken the net sales and the other operating income. This total they have taken. Net sales and the other operating income. Done. Chalo, so we are done with two standards. Which are the two standards done? 115 done and your 108 done. We take a break of 15 minutes. And after 15 minutes, we'll start with IND AS 116. So it's 5 o'clock and 5 minutes. We are meeting back at 5:20. I repeat, we are meeting back at 5:20 and then I'll start with IND AS 116. Enjoy your break. Okay, now let's move it. We finished IND AS 115 and IND AS 108. Now we are going to IND AS 116. Now see, IND AS 116 is on leases. Now as per IND AS 116, in the books of lessee, one who takes on lease, in the books of lessee, they always record a ROU asset. The entry in the books of lessee will be ROU asset debit to lease liability. So earlier, in your accounting standard 19, in your AS 19, we had to classify the lease as operating lease, finance lease. If it's an operating lease, we do not record asset in book. If it's a financing lease, then only we are recording asset in book. Remember all these things? In operating lease, we are not recording asset in book. But in finance lease, we are recording asset in book. But that was only for what? AS 19. Under your IND AS 116, in the books of lessee, every time a ROU asset will be recorded, right of use. So ROU asset debit to lease liability. But there is an exception. What is the recognition exemption? Entity can elect, the lessee can elect not to apply 116. There's a voluntary exemption available to you not to apply IND AS 116 for what? Short-term lease. Short-term lease are lease which are for a period 12 months or less. And second, lease for which the value is lower. It's a low value item lease. The lease for which the underlying asset is of which value? Low value. So if it's a short-term lease or if it's a low value asset wala lease, then in that case you don't follow IND AS 116. You account it in a manner what you want. So in that case, you don't want to book a ROU asset, you want to book an expense as in when you pay rent, you can account it in that way. Otherwise, all your lease in the books of lessee, you are required to have ROU asset. Okay, going down. Now there's a word written. When do I say it's a short-term lease? If it's a commencement date, the lease term is 12 months or less. So now question is, what is commencement date? Commencement date is a date on which the asset is available for use to the lessee. When they make me available, that's called commencement date. Okay, inception date is the date when we agreed. So we made an agreement. Agreement is inception date. We might have done an agreement today. Agreement is done today, 18th of October, 17th October, telling that the asset will be given to you from 1st November. Agreement is done today, 17th October, telling that I'll give you asset on rent from 1st November. So inception date is 17th October. Commencement date will be 1st of November. Fine. Lease term is the non-cancellable period. What do you mean by the word lease term? It is a non-cancellable period, but it will include the period of renewal if the renewal is certain. It will include the period of renewal if the renewal is certain, and it will exclude the period of termination if termination is certain. Like I know after 3 years they can terminate and they will terminate. So total we did agreement of 5 years. But after 3 years they can terminate, and I know termination is certain, then the lease term will not be 5 years, lease term will be 3 years. The renewal period will be included if the renewal is certain, and termination period will be excluded if the termination is certain. Fine. Check over here. Low value item is okay. Now, what do you mean by the word lease? What do you mean by the word lease? Definition. Lease is a contract or a part of contract. It's a contract or a part of contract that conveys the right to control the use of an asset. That conveys what? Right to control. Just the use. Ownership is not passed. Right to control the use of an identified asset for a period of time in exchange of information. So now whether a contract is a lease or whether a contract contains a lease or not, we have this table. So whether a contract is a lease or whether a contract contains a lease or not, we have this table. Okay, for a lease, there is like we are granting you a right to control the use of an identified asset. So first of all, there has to be identified asset. If there is no identified asset, it's not a lease. First of all, it has to be identified asset. Imagine you took a car on lease. They have given you Maruti Suzuki Swift car number 5000. Maruti Suzuki Swift car number 5000. So that is an identified asset. But you took a car on lease. They say that, sir, you come to our store every day. Whichever car is free, will give you. You come to our store every day. Whichever car is free, will give you. So can I say there is no identified asset? That is not okay. If there is no identified asset, it's not a lease. So for a lease, first, there has to be identified asset. Second, you should be getting a right to control the use. Now, how do I say right to control the use? All the economic benefit related to use should come to you. Whether the right to obtain all of the economic benefit from the use, is it coming to you? If all economic benefit related to use, not our sale, use से जो benefit होगा वो मेरा. If answer is no, again it's not a lease. Third, if there is an identified asset, economic benefit related to use comes to you. But when I say right to control the use, so can I say you should be able to direct the manner in which the asset is to be used? So how to use the asset, for what purpose to use the asset, you should be taking a decision. So right to direct how and for what purpose the asset is to be used. Right to direct how, what purpose the asset is to be used. If they take the decision, they tell me don't ride above 80, don't take the car outside the city, you can drive only in this road, you cannot drive outside. If they put all that condition, then it is not a lease. If that right to direct how and for what purpose the asset is used, if that is with supplier, then in that case it's not a lease. But if that thing is with you, then yes, it is a lease. So not just the economic benefit of use should come to me, I should be able to direct the manner, how and for what purpose the asset is used. Now sometimes asset ka purpose and how to use is predetermined. Imagine a solar panels are already fixed. If solar panels are already fixed, for what purpose to use solar panel? Predetermined. How to use, it's already fixed now. So that all is predetermined. Then in that case, how do I say that I direct how to use the asset, all that thing? So you should be operating the asset or you should have designed the asset. Okay, so first of all, they're telling there has to be identified asset. Economic benefit related to use should come to you. You should be able to direct the manner, how and for what purpose the asset are being used. And if how and for what purpose is kind of predetermined, then you should have been involved in operating the asset or designing the asset. Then only the contract contains a lease. Okay, next, identified asset is fine. We already did it. Practical substitution right is also fine. Now, segregating lease and non-lease component. Segregating lease and non-lease component. Suppose I am giving you a car on lease with a driver. I am giving a car on lease to you with what? A driver. So whatever rent you are paying me, it's one for the car and second for the driver service. Whatever you are paying me is not just for the rent of car, it's also for what? Driver service. So there is a lease component and there is some driver service, a non-lease component. Two things are there. So whenever there's a lease component and non-lease component, we are required to segregate it, to separate the lease from non-lease component. You supplied a truck with a driver, truck is a lease component, supplying a driver service is a non-lease component, and accounting will be done separately. Now, sometimes some lease may reimbursements are there. Now, what is the lease may reimbursements? Pay attention. Pay attention. One is, I gave a house to you. I gave a house to you on rent. House is a kind of a house, full bungalow kind of. I gave a house to you on rent with a security guard service. So now you are paying me a common amount. Common amount is not just for house, it's house plus the security guard service. So one is a lease component, other is a non-lease component. Now second thing is, for the house I pay municipal tax to government. Remember house pay municipal tax? So lessee reimburses the municipal tax to me. Okay, the lessee is giving me a municipal tax. So whenever he is reimbursing a municipal tax, okay, is he getting any extra service? Is lessee getting extra service for municipal tax? No. But a security guard ka service was extra service which he was getting. So whenever that reimbursements are made by lessee which does not give you any separate services, they are not to be accounted separately. They are not to be accounted separately. They will be apportioned between the other only, the other lease and non-lease component, whichever are there, वहाँ पे वो आ जाएंगे. So suppose the lessee pays for municipal tax, that is not a separate service which lessee has got, तो वहाँ पे that is not to be accounted separately. But bungalow on rent, security services got, that too will be accounted separately. Fine. Now, there's a practical expedient. There's a practical expedient given wherein it permit the lessee, only lessee are permitted not to segregate the lease and non-lease component. So you can have like not to segregate lease and non-lease component, you can account it together only. Normally for lessee, paying rent is another and paying for that security guard service is separate. It should be accounted separately, but a practical expedient is given. You may not account it separately. You account it single like a lease. But this practical expedient is only for lessee, not for lessor. Okay. Now, how to determine and allocate the consideration? So, I am paying rent plus I am getting security service. I am also paying for security service. How to allocate? Based on the relative standalone prices. Same thing which was there under IND AS 115. Based on the relative standalone pricing. Okay, now contract says 80,000 for lease, 10,000 for maintenance, and you pay total 90. What contract says is not to be seen. Total you are paying 90. Total you are paying 90. Now, what is the relative standalone prices? 85.15. Total is 1. The standalone prices are 85.15. Divide the total 90 which you are paying in 85:15. Divide the total 90 which you are paying in 85:15. 85 by 100. This is 76,500. And balance will be basically minus 90. 13,500 will be this. So 76,500, 13,500. So what we have written in contract, that is not the lease and non-lease component. It should be based on relative standalone price. So 90,000 you divided in the standalone selling price of 85:15. Are you clear? Okay. Inception date is when we agreed. Commencement date is when the asset is available for use. Inception date, commencement date. Okay. Lease term is the non-cancelable period. It will include the renewal term if the renewal is kind of certain, reasonably certain, and it will exclude the termination period if the termination is again reasonably certain. Fine. This is done. This all is okay. Come directly to lease payment. Come directly to the word lease payment. Any doubts? Anybody till now? Keep smiling, keep answering, and have lots of water. Okay, now word lease payment. What do you mean by the word lease payment? Can I say these are the payments which are made by lessee to lessor during the lease term? payment made by lessee to lessor during what? Lease term. One, it can be fixed payments or in substance fixed payment. In substance fixed payment is kind of, if at all you use for this many hours, this much rent. If you use for more than this many hours, this much rent. But generally I'll never use more. Generally I'll never use more. So can I say in substance, it will be the lower slab applicable. That's in substance fixed lease payment. So fixed payment or in substance fixed lease payment less any lease incentive receivable. Now what is this less any lease incentive receivable? Now someone had a house to be given on rent. I have someone who is ready to get my house, but he's telling, yeah, sir, the problem is your house is furnished. I already have my furniture. Now, because of this, I might be required to sell my furniture at loss. Your house is furnished. I already have a furniture with me. I might be required to sell my furniture at loss. So I said, do one thing. You sell your furniture. You have a loss of 50,000. I pay you. You sell your furniture. You have a loss 50. Now, I'll pay you that 50. So यहाँ पे lessor is paying to lessee. Lease incentive is incentivizing the lessee to take up the lease. The lessor pays to lessee. Okay. One guy said, sir, I like your house, but your house is a bit far. And for me, it will be kind of bit complicated for transportation. I am giving him, the lessor gives some amount to lessee for incentivizing him to take up the lease. So lease payment are normally what lessee pays to lessor. But if I am giving some lease incentive, that will be deducted from the lease payment. Okay, number 2, variable payments. Number 2, just a minute. I think, just 1 minute. There's one call coming, urgent one.
Hello.
Yes. Okay, now, chalo. So, lease payment includes one, the fixed payment, less any lease incentive receivable. Second, variable payment, which depend on index or rate. Okay, variable payment, which depends on index or rate. For example, if I tell you, the lease payment will depend on inflation index. So, that is dependent on some index. But if I say the lease payment depends on sales ka 1%, then that is not covered here. The lease payment includes a variable payment only which depends on index or rate. Third, I've given you an option to purchase the asset at end. And if you're reasonably certain to purchase it, then whatever amount you will pay for that is also included in lease payment. So exercise option of purchase, the exercise price of the purchase option if the purchase option is reasonably certain to be exercised. Acha. Fourth, penalties. If you want to cancel the lease, you have to pay penalty, and it is reasonably certain you will cancel. If it is reasonably certain you will cancel, then can I say lessee has to pay penalty? That is also included in lease payment, provided that basically termination is reasonably certain. Okay. So what does lease payment include? One is fixed payment as well as in substance fixed lease payment less the lease incentive receivable. Second, variable payment, but which are based on what? Index. If variable payment are based on sales, turnover, something, they are not included. Third one, the exercise price of a purchase option if the purchase option is reasonably certain to be exercised, and penalties for terminating if the termination is reasonably certain to be exercised. Fine. Plus for a lessee, if you are given a residual value guarantee. What is a residual value guarantee? Now see, I'm using your car, and now the thing is, like, you are concerned about my driving habit. I'm using your car, but you are concerned about my driving habit. You are telling, sir, I give you the car, but problem is you don't use properly. And at the end, after you use the car, I will not get the proper guaranteed residual value. Normally, I'm expecting a residual value 3 lakh. If you use the car, roughly I'll not get 3 lakh. I guaranteed that if you don't get 3 lakh, difference I'll pay you. Imagine if you expect to get 250, I have to pay other 50. So that other 50 which I have to pay is the guarantee which I have given you, the amount payable under the residual value guarantee. So I have guaranteed you that you will ensure you will get 3 lakh. If you are getting from market 250, I'll give another 50. Okay, so this is also included. For lesser, okay, this is for lessee. For lesser, the lease payment will include the guarantee by. For lesser, the lease payment will include the guarantee by the lessee or the third party, whichever is higher. The lease, the residual value by lessee or the third party, whichever is higher. For lessee, amount payable under guarantee program, that only is included. But for lesser, guarantee by lessee or third party, whichever is higher. Okay. Lease payment do not include the amount allocated for non-lease component and variable payment which do not depend on index or price. Now, what do you mean by fixed lease payment? The amount which I have to pay fixed. Now, suppose our lease rentals are first year 1 lakh, second year 1 lakh 5, third year 1 lakh 10, fourth year 1 lakh 15. So they are still fixed only because वो पहले से fixed है. So that is fine. अच्छा, if it is based on inflation index, still it is covered. If inflation index में 5% inflation, still it is covered under this. Okay, in substance fixed lease payment which are substance wise fixed. For example, if I use your building this much, because COVID came and I can't use it, yaad hai? So now we have a contract. If I use the building, rent is this. If I don't use, the rent will be half. If I don't use, the rent will be half. Now, not using, the probability is negligible. Not using, the probability is negligible. So mostly it will be used only. So can I say in substance the rent is fixed. Lease incentives are the payment made by lessor to lessee in order to incentivize to take him the lease. Fine. Variable lease payment. Now variable lease payment which vary based on some inflation index, etc. If there is a variation only of time, first year 1 lakh, second year 1 lakh 5, the variation is just due to time ka variation hai, then that is considered as fixed lease payment only, not the variable one. Okay? Now question, if there are variable lease payment, lease rental is 1 lakh, every year it will increase as per the inflation index. Every year it will increase based on inflation index. So we will see the inflation index kab ka. We will see the inflation index at the commencement date. The date when asset is available. I'll see the inflation index when the asset is available to me. The day when you gave me the inflation index is 7%. I'll start with 1 lakh. Then first year will be 1 lakh plus 7% is 1 lakh 7,000. Year first actually tha. Year second year will be 1 lakh 7. Third year will be 1 lakh 7 plus 7%. Sir, in between if inflation index changes, to kya karenge? I'll come to it later. In between really the inflation rate changes, I'll come to it later. But currently all your lease payment will be based on the inflation rate which was there at the date of commencement. Commencement date is the date when the asset is coming to you. Okay. Next, variable payment which do not depend on inflation, rate or index are not covered here. They will be recognized directly in P&L as and when they occur. So they are not covered here. They will be recognized directly in P&L as and when they occur. Now coming to discount rate. If you just recall, I told you, under your IND AS 116, lessee will always record a ROU asset to lease liability. Now lease liability will be recorded at what amount? Whatever lease payments are to be made, the present value. I repeat, at what rate it has to be done? Whatever lease payment are to be made, uska present value. How to find present value? Which is a discount rate to be used? For lessee, one you use the implicit rate of interest in lease. That is IRR, and this implicit rate of interest is from lessor's angle. Implicit rate of interest is always from whose angle? Lessor. Now imagine. Lessor, can I say one, he will get the lease payment? And our lease payment includes your guaranteed residual value. So it includes GRV, already includes. Plus he will get some unguaranteed residual value. Guaranteed was 3 lakh, but he's expecting 350 from market. Guarantees is 3 lakh, but at the end he's expecting 350. So can I say this is what a lesser will get? This is what a lesser will get. Okay. Present value of this, if it equals the fair value of asset plus the initial cost of lesser, initial direct cost of lesser of lease. So the rate at which ये जो present value लिया ना, lease payment he will get, UGRV he will get, unguaranteed residual value. Lease payment includes GRV. Wherever the present value of this equals the fair value of asset plus the initial direct cost. So what is spending? If I am giving asset on lease, I would have bought the asset and I have some lease related direct cost, agreement cost, etc., etc. So this is what I am spending. This is what I am getting. Wherever the present value of this equals this is nothing but a implicit rate of lease. This is basically the implicit rate under your lease. So implicit rate is always from whose angle? Lessor's angle. Now they are telling lessee should use this, but here I might not know the implicit rate of him. I am a lessee now. I might not know the return which a lessor is getting. The second option, if it cannot be determined, lessee can use lessee's incremental borrowing rate. If you want to borrow this much extra fund, what rate it will be available? Implicit rate, the present value of lease payment plus present value of UGRV equal to the fair value of asset and initial direct cost of lessor. We already discussed. Next, lessor has to use only the implicit rate because lessor, he knows what is his margin. Now, lessee can use either the implicit rate of lease, which is from lessor's perspective, or if that is not available, then he can use the incremental cost of obtaining the finance. Okay. Now going to the lessee accounting. Now comes the accounting. This all was theory. Now proper accounting starts. Pay attention. I told you lessee will always record what? ROU asset and lease liability. They will always recognize ROU asset, lease liability. Okay, lease liability will be at what amount? Lease liability will be at what amount? Whatever lease payments we are required to make, uska present value. Whatever lease payment we are required to make, the present value. That commencement date. Commencement date is the date when you are getting asset. That commencement date, whatever lease payments you are required to make, uska present value. So it is present value of remaining lease payment to be made over the lease term, discounted as per the implicit rate of lease. If implicit rate of lease is not available, you can use your incremental borrowing rate. Whatever I have to pay, uska present value is the lease liability. Okay, the check over here. Check over here. There is a 9-year lease. Annual lease rent is 70,000. 9-year lease. Annual lease rent is what? 70,000. And you can also use some other facility. Other facilities such as passenger lift, DG set, power supply, parking, etc. And annual service charge is 1 lakh for that. And both the agreement are coexistent coterminants. Now see, I cannot use the lift without a building. I cannot use the lift without the building. So coterminous hai, so account them together. Account them together. Now entity has assessed the standalone price of lease is 120 and standalone price of facility is 80. Okay, DG set, BG set, etc. Standalone price is 120 and this is 80. And you have not elected to apply practical expedient. If you apply practical expedient, lease component, non-lease component, no need to segregate. But यहाँ पे lease component is 120, non-lease component is 80. Now lease component 120 for how many years? 9 years. So what will be the lease liability? 120 coming for 9 years. Now अच्छा, one more thing. ये 120 and 80 total becomes 2 lakh. ठीक है, total 2 lakh. But we are paying is 170. We are paying is 170. Total actually 2 lakh hai, but we are paying 170. So 170 you bifurcate between two. So 170 is to be bifurcated in the ratio of SSP 120 is to 80. In the ratio of SSP 120 is to 80, so it becomes 102 and 68. So lease component is 102 and that DG set other facilities is coming your 68. Fine. So lease is 102. I have to pay for 9 years. Uska present value is nothing but your lease liability. What is the lease liability? Whatever you have to pay over the lease term, uska present value of the lease payments. Now, how to measure ROU asset? Pay attention. Lease liability pata chala, whatever I have to pay, uska present value. Now, they have written clearly the word at commencement date. Commencement date is the date when you are getting asset. Okay, now, is it possible you might have entered into agreement before that? I entered into agreement today. Asset comes to me on 1st November. I entered into agreement today. Asset comes to me on 1st November. If asset comes to me on 1st November, lease liability I'll find on 1st November. So from 1st November onwards, whatever I have to pay in future, the present value. But now what is ROU asset? ROU asset is one amount equal to lease liability plus if I already paid something before that. So before commencement date, upon agreement, I already paid. वो भी उसी के लिए था. So check over here. Your ROU asset is the initial measurement of lease liability. Any payment which you already made before the commencement date, less any lease incentive which you have received. If lease incentive received, आपका asset will go down. Then initial direct cost of lessee. Initial direct cost of lessee will be added to the asset, ताकि it gets spread over the life. And last, estimate of cost of dismantling. Okay, today I got asset on lease from you. Suppose machine, I fitted the machine. After 5 years, I have to give it back. I have to dismantle. Whatever will be the expense on dismantling, uska present value will be appearing as a liability. Yaad hai? Provision for dismantling. And opposite, it will be added in ROU asset. Opposite, it is added in ROU asset. Now, Ujjwal has a question, sir, why not recognize the amount paid for DG set also as ROU asset? Ujjwal, if you just see, यहाँ पे it is one park, passenger lift, DG, infra, parking space, etc. which are there, for which an annual service charge given is 1 lakh. As they are using the language like annual service charge, it is assumed to be some services which you are taking from them, which are to be booked as and when the services are received. So they are treated as not the lease component, they are treated as non-lease component. So driver's salary, as and when driver gives service, I'll record. Now I cannot record an asset for the driver's salary wala thing. Same way. Okay, now, so one was basically lease liability, whatever I have to pay, uska present value. Second is your ROU asset. ROU asset is one equal to lease liability plus amount already paid before that, or lease incentive received before that, that is there. Third one, basically dismantling ka cost, whatever is going to come, uska present value is also included in ROU asset. Fine. Now check this question. This is just a normal question covering everything. 12-year lease. ठीक है. Entity must pay monthly rental 10,000 upon execution of the lease. Okay, 10,000 is upon execution of lease. 50,000 is cash incentive. Can I say वो cash incentive is nothing but your lease incentive है आपको? And you incurred 1,000 rupee for initial direct cost. And the lease liability is initial lease liability 850. Initial lease liability 850. So ROU asset will be first 850 plus what I paid upon execution before commencement date 10. Add 10. Deduct lease incentive received 50. And plus your initial direct cost 1,000. This is your ROU asset. Now subsequently, what happens subsequently? You book the lease liability at present value. I booked the lease liability at present value. So can I say unwinding of discount will happen? So on the lease liability, interest accrues. We pay something, closing. On your lease liability, interest accrues, we pay something, closing. Interest accrues, we pay something, closing. Interest accrued, we pay lease rental every year end, closing. And what happens to ROU asset? The ROU asset will be depreciated over the life. Now which life? Either the asset's life or the lease life, whichever is lower. If asset ka life 10 years hai, lease ka life is 6 years, so it should be depreciated over 6 years. The asset life or lease life, whichever is lower. So ROU asset will be measured as per cost model unless you are following a revaluation model, and ROU asset will be depreciated. Fine. Lease liability, what will happen? Will increase for the interest and will reduce for the payment what we do. The interest accrued, we pay something, closing. And lease liability may change due to some remeasurements, which will cover up later. This will change due to some remeasurement, which I'm covering it later. Fine, check this question. You are required to make this payment 20, 30, 50 and the rate given is 12%. So first, how do I find lease liability? Whatever I have to pay, uska present value 77364. Whatever I have to pay, uska present value. First year end, second year end, third year end. Now accounting on that 77364, interest accrues, we pay something, closing. Interest accrues, we pay something, closing. Again, interest accrues, we pay something, and now closing. This is how it will be there. And for ROU asset, it was again 77364. ROU asset is initial lease liability. Uske pehle nothing is paid, no lease incentive, no direct cost, so that all is ignored. The same will become ROU asset. And ROU asset is depreciated over 3 years evenly. So first year depreciation, this balance. Second year depreciation, this balance. Third year depreciation, now balance becomes nil. Did you understood this? Did you understood this? Journal entries are fine. It's a simpler one. I'm not going into that. Question number 5 is a good one. Now, there's a company EFG. Initial lease term is 10 years with a 5-year renewal. Okay, so should I take lease term 10 years or 15 years? If renewal is reasonably certain, take it 15 years. Fine. And fair value of the property is 50 lakhs. There were option to purchase at the end for 30 lakh. Okay, option to purchase at the end at 30 lakh. So should I include 30 lakh in lease payment? If that option is reasonable to exercise, if the option is reasonably certain to exercise, include 30 lakh also in your lease payments. The lease payment are 5 lakh with an increase 3% every year. An important thing is payable at beginning of the year. I said, no, this is not payable. Lease incentive is 2 lakh, payable at beginning of second year. Okay, so now normally my lease payment, how it will be? Normally my lease payment, how it will be? So check over here. I'll have first of all 5 lakh plus 3333333% every time. Okay, first of all it's 5 lakh and 333% every time. And now say question, यहाँ पे says lease incentive payable at beginning of year 2. So it is assumed the lease rentals are also at beginning of each year. I repeat, it is assumed the lease rentals are also at beginning of each year. So beginning of each year I am paying 5 lakh say, so year 0 pay. Year 1 beginning is 5 lakh. Year 2 it's 515 I pay. 5 lakh plus 3%. 5 lakh plus 3%. 515, but usme se 2 lakh is lease incentive. That's why they've written 315. 2 lakh is lease incentive. That's why they've written 315. Then the first year was 5 lakh plus 3%. Again plus 3% is 530 plus 3% plus 3% plus 3%. This is what you are paying. Now, yahan pe, whenever lease rentals are at beginning, so if you just see over here, when I do PVIF, the first one is at year 0 only. So PVIF of year 0 is taken. First year beginning hai. Second year beginning, PVIF of year 1. And this is what we need to do. So our total is 3739. But this 3739 is only 5 lakh wala thing. Option to purchase at the end is there. If it is reasonably certain, that also you include. An option to purchase at the end is end of 10th year. Okay, 10th year ka lease payment is, this is beginning of 10th year. This is beginning of 10th year. But option to purchase is end of 10th year. That's why the PVIF of both are different. One is beginning of 10th year, other is end of 10th year. I hope you are clear. One is beginning of 10th year, other is end of 10th year. That's why यहाँ पे 0.46, यहाँ पे 0.42. And they say it is certain, that's why it is also to be included in your lease payment. So lease payment include 3739 plus 1260. Total lease payment 3739 plus 1260. 3739 they've taken rounded off. 3740 plus 1260, it's 50 lakh rupees. Now, interest will accrue, we pay something, closing, but यहाँ पे interest doesn't accrue first, we pay on the first day. Out of 50 lakh, 5 lakh I paid. Out of 50 lakh, 5 lakh I paid. Now 45 lakh pay interest will come. Out of 50, I paid first day pay 5. On 45 lakh, 9.04 percentage, it's 406,800. Normally what happens? Opening interest accrued, we pay something. यहाँ पे we pay something, then interest. So interest will not be on 50 lakh, it's 50 minus 5 lakh. Okay, this is interest accrued. Now this is the liability now. Now liability is this day, first day I pay 315. So now interest will not be on 4906, it's 4906 minus 315 into 9.04%. So whenever it is lease rental at beginning, you need to take care while calculating interest. Did you understood this? That was the only point. You need to take care while calculating interest. Now, next one is important. Realme has a question, sir. Today, is it the last day? Answer is yes. Today is the last day. This is a part 3 of your marathon. We already done part 1 and 2. So 10 and 8, 18 hours are already over, dear. So better is you start with part 1 if at all it is pending from your side. Now, lease denominated in foreign currency. So can I say I'm paying the lease rentals in foreign currency? I'll be paying $10,000, $10,000, $10,000, $10,000. Okay, so do one thing. The lease liability, first you find it in dollar term. Lease liability, first you find it in which term? Dollar term. Dollar term में whatever 10,000 euro pay, discount it, present value मिला. तो dollar term में present value, multiply it with today's rate, commencement date का. So that's the lease liability in your book. That's the lease liability in your book. हो गया ये? Now interest accrues, we pay something, closing. Interest accrues in dollar, we pay in dollar, and then comes closing. So first lease liability is recorded at commencement date foreign exchange rate. Interest will be at average rate. Payment, if you are doing on last day, it will be the last day's rate. So now you already have opening up का मतलब था lease liability, then interest accrued, you paid something, now closing is there. And your lease liability is a monetary item. Remember? Yesterday we did AS21. If it's a monetary item, they are to be brought to which rate? Closing rate. So check this question. There's a 10,000 rupee lease payment every year and it's in arrears. Arrears means end में. $10,000, not rupees. $10,000. How many years के लिए? 5 years. So 10,000, 10,000, 10,000, 10,000, 10,000. I find out the present value. So total $43,300 is the present value of lease payment. So this is a lease liability. This is the lease liability. Today I'll record at today's rate. Today I'll record day 1. Day 1 I'm recording at 68. Commencement date 68. When asset comes to you, you record the lease liability day 1 68 pay. So now this is the lease liability. Now interest accrues not on 2944. Interest accrues basically in dollar terms. So 43,300 tha, interest accrues 5%, we pay 10,000 and then closing. Interest accrues 5%, we pay $10,000 and closing. Now this we have already converted into INR. Interest will be converted into INR at average rate. Payment is done at the end of the year. This will be at closing rate. This will be at what rate? Closing rate. So if I just try to understand over here like this, opening was, this is 43,300 liability, then plus interest. Interest is how many dollars coming? 2165. This 2165 minus you paid how many dollars? 10,000. ठीक है? Now this is at 68. This will be at average rate. What is the average rate given? Check in the question. What is the average rate given? Check in the question. You will find average rate is 69, closing is 70. Okay, so this, yeah. This will be at 69, this will be at 70, closing. And now I'll get some value. And this is in dollar term also. This value is there. Now whatever is dollar term, may bring it to the closing rate. Difference is your exchange gain or loss, which goes in P&L. So this came fine. Now then the total foreign में closing is to be brought to 70. Difference will be exchange gain loss, which is going in P&L. Did you understood? So interest is at average rate 69. Payment is at 70. Done. Now closing is 35465. I bring to closing rate 24,000, 24, 82, 550. In our book is something different. 88,765 is the exchange impact coming up. Exchange impact coming up. Now ROU asset. See, lease liability is monetary item. Yaad rakho, lease liability is a monetary item. I have to pay some fixed amount every year, 10,000. ROU asset is not a monetary item. ROU asset is a non-monetary item. It will continue at its historical rate. So ROU asset day 1 pay 29, 44, 400. ROU asset day 1 43, 300 into 68. This is not to be remeasured. This is remaining same. You just depreciate over 5 years. So 29, 44, 400 divided by 5. Depreciation is 58880. So depreciation is 580. This is the balance. So every year depreciation will be 58880. This is not remeasured. The point is ROU asset is non-monetary. Lease liability is monetary. Monetary items are brought to closing rates. Are you clear? Okay, next one we have the remeasurement. Next one we have remeasurement. See, there are two separate words. One is called as a remeasurement, second is called as a modification. One is called as a remeasurement, other is a modification. Now, what is a remeasurement? Remeasurement is there was something there in agreement. The agreement has a renewal option. You thought, you had earlier estimated they will go for renewal. And that's why you took a lease term 10 years, not 5 years. And lease payment also you took 10 years wale. But now you feel they will not go for renewal. So there was something there in the contract. Renewal option. We thought they will exercise. Now we think they will not exercise. Or earlier we thought they will not exercise. Now we think they will exercise. Same with termination option. It was there in contract. Earlier I thought they will not exercise. Now I feel they will exercise. Or a purchase option. Remember purchase? Earlier I thought they will go for purchase, so that amount was included in lease liability, but now I feel they will not purchase. So that is something there in contract, but now estimate changes. It's something there in contract, but now the estimate is changing. That's basically your remeasurement. And whenever you remeasure, whenever you do remeasurement, so can I say liability will change? So pehle it was based on 10 years lease term, now it should be based on 5 years lease term. Whenever there's a remeasurement, liability changes, opposite effect will come in ROU asset, no gain loss. Opposite effect. For remeasurement, they recognize the amount of remeasurement as an adjustment to ROU asset, no gain loss. So there's no gain loss coming on remeasurement. Fine. So remeasurement may arise due to change in lease term because now we feel they will not go for extension or now we feel they will go for termination, something like that. Or purchase option may change. In substance fixed lease payment may change. Residual value guarantee, what we thought. We thought they will get from market 250 and I have to pay only extra 50. Now I feel they'll get from market only 220 and I'll have to pay 80. Earlier I thought I'll have to pay 50 under guarantee program. Now I feel I have to pay 80 under guarantee program. And last, the future lease payment may rate or index is changing. Remember that rate or index, we took the inflation index of commencement date. If later the inflation index changes, uske karan. So now if this thing happens, the lease liability is to be remeasured. Okay, now if remeasurement is due to A and B, purchase option, termination option, renewal option changing. So there was a renewal option, termination option, or there was a purchase option. This is changing. So in this case, the new liability will be found out using a revised discount rate. So if it is remeasurement due to A or B, if remeasurement is due to A or B, now the new liability you found out based on a revised discount rate. But if it's due to CDE, the new liability will be based on the original discount rate only. तो A and B में it is new discount rate, C, D, E में it is the old discount rate. Let's check the question. Let's check the question. Entity W entered into a contract for a retail store. January 1, initial term is 5 years with a renewal option 3 years. The payment for initial term and renewal is 1 lakh and 110. So can I say initial term में you'll pay 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh. Renewal में you'll pay 110, 110, 110. ठीक है. The annual payment will increase based on increase in consumer price index. If consumer price index increases, the annual payments will also increase. तो 1 lakh नहीं होगा, बढ़ जाएगा. ठीक है. तो payment due on 1/1/18 will be based on CPI of 17. Payment due on 1/1/18 will be based on CPI of 17. This means lease rentals are at beginning because payment due on 1/1/18. So can I understand the lease rentals are at beginning of each year? ठीक है. Now W का incremental borrowing rate inception time and today is 5 and 6%. CPI inception time and today is 120 and 125. Fine. Now at commencement date when you started, there was no significant economic incentive to exercise renewal. Okay, so commencement date there was no incentive to go for renewal, so I thought renewal will not happen. As I thought renewal will not happen, can I say I took a lease term of 5 years, not 8? So lease liability was based on the payment to be done in that 5 years, 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh, uska present value. ठीक है. First quarter of 2020, you did some improvement in the building. Building में आपने थोड़ा furniture डाला. And now you feel you will go for renewal also. And because of that, if we exercise renewal, then only it makes sense. So now we feel we'll go for renewal. How to measure in the first quarter of 2020? Okay, we took lease on 1/1/17. We took lease on 1/1/17. Today is 1/1/20. We took lease on 1/1/17. Today is 1/1/20. 1/1/17. 17 gone, 18 gone, 19 gone. Can I say 3 years already gone? ठीक है. And CPI index has changed on 1/1/20 only. Today CPI index changed. Till today CPI index had not changed. So don't worry about it. So our rentals were 1 lakh, 1 lakh, 1 lakh. So whenever CPI was 120, rental was 1 lakh. I repeat, whenever CPI was 120, rental was 1 lakh. If CPI becomes 125, rental will increase. CPI becomes 125, rental will increase. So actually CPI 120, rental 1 lakh. CPI 125, rental will become how much? 125 into 1 lakh divided by 120. This is coming 1,04,167 now. ICI is rounded off to 1,04,000. ICI is rounded off to 1,04,000. Fine. But this is from 1/1/20 onwards, it is changing. Okay, the till 1/1/20, we follow the earlier thing. So earlier what we had done? Earlier what we had done, the lease rental taken was 1 lakh for 5 years. Extension was not taken. Extension was not taken. And it is payable at beginning of year. So यहाँ पे for the first one PVF is 1. It is for year 0. For second one, its PVF is for first year. So this is beginning of the year. So this was the lease liability which we had created, day 1 pay. Okay, on the lease liability, 454. Now, not interest accrued. We paid first 1 lakh. So interest will accrue on 454 minus 1 lakh. याद करो. If it is at beginning of year, we have to take care while finding interest. Interest accrued, we paid something, then for the balance amount interest accrues, and now closing. Again we paid something, then for the balance amount interest accrues, closing. Again we paid something, for balance amount interest accrued, and closing. Now 3 years over. So this is the liability on 1/1/20. This is the liability in your books on 1/1/20. Did you understand? Now we feel we'll go for renewal. Can I say remeasurement of lease liability to be done? Okay, how to remeasure? Now whatever I have to pay Now whatever I have to pay, but now I feel will go for renewal. So now it's not just the 4th and 5th year. It will also be 6th, 7th and 8th year. Okay, and now CPI has changed. CPI has changed. So now this will not be 1 lakh, 1 lakh. No. So now this becomes 1 lakh 4,000, 1 lakh 4,000. And renewal was normally 110. CPI 120, it was 110. CPI 120, it was 110. So CPI 125, it will be how much? 110 into 125 divided by 120. This coming 114,58333. ICI is rounded off to 114,500. ICI is rounded off to 114,500. So now this is what we have to pay in 4th year, 5th year, 6th year, 7th year, 8th year, and we are at beginning of 4th year. हम लोग कहाँ खड़े हैं? 3rd year is over. We are at beginning of 4th year. And this has to be paid at beginning of 4th year. So can I say this is to be paid today only? Second one is to be paid at the end, at the first year end, second year beginning. This is first year beginning only. This second year beginning. This 3rd year beginning. This 4th year beginning. This is 5th year beginning. So now this is the amount to be paid. First year beginning, second year beginning, 3rd year beginning, 4th year beginning, 5th year beginning. Find out the present value. That's the new lease liability. Okay, so check over here. Now what I need to pay? Now I need to pay. This is 1 lakh 4, 1 lakh 4, and they have written 114,400. They have taken a rounded off, like 120 became 125. So 5 rupee increase on 120. 5 rupee increase on 120, percentage wise 4.16%. They have taken 4% approx. Percentage wise 4.16%. They have taken a 4% approximate increase. So now I have to pay this. Okay, where are we standing? We are standing at beginning of 4th year. And this is to be paid at beginning of 4th year. So can I say this to be paid today only? So PVIF is 1. Achha, one more thing. Whenever you are having a remeasurement, यहाँ पे remeasurement happened because the renewal term changed. The renewal term earlier we did not took, now we have to took. So if you see, this falls under A point, reassessment of lease term. And if it is A or B, now the new discount rate is to be used. If it is A or B, new discount rate. The new discount rate is now, question is given, new discount rate is now 6%. The discounting is now not based on 5%. This is at 6% rate, the discounting done. Now this is the new lease liability 490. In your books it was 195. In your books it was 195. It should be 490. Difference, lease liability goes up. Opposite, add it in ROU asset. No gain loss comes. Opposite, it gets added in ROU asset. So in your books ROU asset was basically 181. Usme ROU asset mein also this will get added. To entry is ROU asset to lease liability. Are you clear? It's a very good question, important one from exam angle. So due to remeasurement, there is no gain loss coming. Opposite effect is just in ROU asset, and remeasurement comes when it was there in the contract, renewal option, terminal option, option to purchase. Earlier we thought it will not be exercised. Now we feel it will be exercised. Or earlier we thought it will be exercised. Now we feel it will not be exercised. That's remeasurement. Your estimate changed. Contract didn't change, estimate changed. But if I come to modification, there's a change in the contract only. The contract changes. Under remeasurement, contract doesn't change, estimate changed. And remeasurement mein there's no gain loss, it's just opposite effect in ROU asset. But in modification, what to do? Okay, if modification increases the scope, okay, you already taken 5,000 square feet, you're taking another 3,000 square feet on rent. So can I say there's increase in scope? And what they are charging for another 3,000 is the related standalone price. What they are charging for another 3,000 is the respective standalone price. Then that is to be accounted separately. Don't touch the current lease agreement. And don't touch the current lease liability, current ROU asset, nothing. That will be accounted separately. So modification increases scope, and what we are paying for that extra 3,000 square feet is a standalone price. It will be accounted separately. Leave it. Like here, additional 3,000 square feet. and the consideration is commensurate with the current market rate for 3000 square feet, it will be accounted separately. Now, if it is not a separate lease, like modification doesn't increase the scope, suppose it decreases the scope, or scope remains same, square feet is same, life is same, square feet same, life is same, just rentals are changed. Square feet same, right, life is same, rentals are changed. So can I say then it is some other modification? Okay, if it decreases the scope, okay, imagine out of 5000 square feet, you give back 2500 square feet. Out of 5000 square feet, you give back 2500 square feet. So can I say half property given back? So half lease liability goes away, half ROU asset goes away, difference goes in P&L. Okay, so if decrease in scope is there, property half given back, half lease liability goes away, half ROU asset goes away, difference goes in P&L. Did you understood? This is how we need to do it. Okay, other modification, other, there's no decrease in scope, but imagine like just the rentals are changed. All other modification, you remeasure, you find out the liability again, always using new rate. If it's a modification, the new liability is always based on the new rate. Check kahan gaya, ye raha. So remeasure the lease liability using revised discount rate. Under remeasurement, contract is not changed, estimate was changed. 2 cases mein new rate, baki 3 mein old rate. But under modification, always new rate. Modification is always new. And modification mein there's a change in the contract. ठीक है. So now for other lease modification, find out the new lease liability now. If liability goes up or down, opposite effect in ROU asset, no gain loss. So gain loss will come only when there's a decrease in scope. Gain loss will come only when there's a decrease in scope. Decrease in scope hai half asset given back. So half ROU asset you remove, half lease liability remove, difference goes in P&L. But other modifications are there. Simple, remeasure lease liability based on new rate, difference will be adjusted in ROU asset. Did you understood? Check question. Check the question. Okay. You have 5000 square meter. There are some annual lease payment. Rate is 6%. 7th year mein you amend the lease. Contract may change. Extend 4 years. Earlier extension was not there. Now you are extending. Okay, and the annual lease payment are unchanged. And the lessee's borrowing cost now is 7%. Now the thing is, yahan pe, it is not increasing the scope by having additional asset. If you check yahan pe, word written was, is it increase in scope by adding additional ROU asset? Did you took new property on lease like 5000 plus extra 3000? No. So it doesn't fall here. It is not to be accounted separately. Separately account nahi hoga. Now, is it a decrease in scope? No, it's not a decrease in scope. It's a other modification. All other modification, remeasure the lease liability based on new rate. Opposite effect will go in ROU asset. So very simple. How to solve some? First, find out what is the liability in your books today. So earlier you were having 1 lakh for how many years? 10 years, discounted at 6%. So day 1, there was some lease liability. 1 lakh for 10 years, discounted at 6%. Okay, now how many years are already over? Beginning of 7th. So can I say 6 years over? So interest accrued, we paid, interest accrued, we paid, interest accrued, we paid, interest accrued, we paid. So find out what's the liability in books today. Wo ho gaya? Now second is you need to find new liability. How to find new liability? What I have to pay now onwards? You are at beginning of 7th year. Now you are extending it by 4 more years. So can I say this is 7th year? Till 14th year it will run. So 7th year, 8, 9, 10, 11, 12, 13, 14. Now I have to pay 1 lakh till basically 14th year end. Today we are at 7th year. Today we are at 7th year. So whatever I have to pay at the end of 7th year, use the PBI for first year. But now at new rate. So for finding a new liability, now you're using new rate. So first we find this was the liability, last note. Okay, this note, working note number 2, this was the liability 6% wala, 10 years, day 1. Day 1. Then 6 years gone, interest accrued, we paid something. This is the liability today. The original liability today. Now finding new one. 7th year onwards till 14th year I'll pay 1 lakh. This is discounted at new rate. This should be the liability in books. It should be 597. It is 364. It should be 597. It is 364. Liability going up. This is other modification. No gain loss will come. Opposite effect will come in ROU asset. The entry is there's an increase in lease liability this much. ROU asset goes up. Khatam. ROU asset goes up. Now check next question. Next question. There's a lease of 10 years, 5,000 square feet, 50,000 payable end of each year. So first find out lease liability day 1 pay. So we have to pay 50,000 for 10 years and the rate at that time was 6%. So lease liability day 1. Lease liability initial value 50,000 for 10 years, 6% day 1. Yeah, day 1 lease liability. Fine. When did we modify the things? Beginning of 6th year modification happened. So do one thing. We found lease liability day 1. Find out the lease liability end of 5th year. Okay, this was day 1. Day 1 was 367. Okay, 367 was day 1. Interest accrues we pay. But यहाँ पे check out are they at beginning of year, end of the year. Okay, end of the year. So interest accrues we pay, interest accrues we pay, interest accrues we pay, and you have after 5 years, this is the balance. So lease liability today is 210. Lease liability today is 210. Now fine, check what question says. Lease liability today we got. They amend the lease, they reduce the space to 2500. Oh, we are reducing space. It's a decrease in scope. Okay, half space gone, half lease liability goes, half ROU asset goes, difference goes in P&L. So check. In your book, lease liability today is 210, half lease liability will go. In your book, ROU asset today is 183, half ROU asset goes. So 50% lease liability go, 50% ROU asset go, 50% ROU asset goes, 50% lease liability go, and the difference will be gain or loss in your P&L. ये हो गया? Now, there's one more thing. The fixed payment for the remaining years. Now, पहले 50,000 था, तो for remaining, can I say now it has to be half gone, 25 होना चाहिए, but 25 you made as 30. Oh, 25 you made as 30. So can I say now there is other modification also. So first one, there is a decrease in scope, half lease liability gone, half ROU asset gone, difference went in P&L. वो खत्म. Now, for the remaining period, it's not 25, the rental is increased to 30. There's some other modification to find out the new lease liability based on new rate. Find out the new lease liability based on new rate. And now, whatever is increase, decrease in lease liability, that opposite effect goes in ROU asset. This is other modification. So this sum has two things. Decrease in scope is also there. Other modification is also there. For decrease in scope, half lease liability goes, half ROU asset goes, difference goes in P&L. Now, for other modification, I'll find the new lease liability based on new rate, and then old lease liability, new lease liability, difference, opposite effect, ROU asset. Are you clear? Are you clear? Okay, next question. We have a lease liability 10 year, 5,000 square feet, beginning of 6th year. They amend. What do they amend? To reduce the lease payment from 1 lakh to 95. Okay, the lease payments are reduced from 1 lakh to 95. Lease payments are reduced from 1 lakh to 95. So this is not decrease in scope. This is other modification. Other modification, I'll find out the new lease liability. So first find lease liability day 1. Then you find lease liability today. Then you find what should be the lease liability. and the difference will be adjusted in ROU asset. Okay, now Guru Reddy has a question that, sir, instead of 2500 square feet given back, we gave back 3000 square feet. Instead of 2500 square feet given back, how much we gave back? 3000. So can I say, Guru, you gave back 60%? 5 may say 3 given back. So 60% ROU asset goes away, 60% lease liability goes away. Difference will go in P&L. Are you clear, Guru? Okay, this is done. Now going to lesser accounting. So this is lessee we did. Now we go to lesser. Okay, now in the books of lesser, lessee's book, it doesn't matter finance lease, operating lease, ऐसा कुछ था ही नहीं. In lessee's book, it was not like that. In lessee's book, all lease are recorded. First, we have ROU asset to lease liability. On lease liability, so whatever I have to pay, uska present value was lease liability, interest accrues, we pay something, closing, that way continues. And ROU asset was depreciated. But in the books of lesser, accounting will depend on whether it's an operating lease or a finance lease. Operating lease is a lease which is basically risk and reward relating to ownership is not transferred. Finance lease is a lease where risk and reward relating to ownership is transferred. Operating lease is generally short term, finance lease is generally long term. Finance lease के अंदर at inception date, the present value of lease payment substantially will cover all of the fair value of asset. So whatever you're going to get na, uska present value substantially covers the fair value of asset on day one. So this is basically list of examples when we say it is a finance lease. One, ownership transfers at the end, option to purchase at lower rate at the end, lease term is covering a major life of asset, present value of lease payment covers substantially all of fair value of asset on day one. Asset is of specialized nature, it will not be useful later on. So these are some examples where I say it's a finance lease. Okay, now pay attention. Pay attention. So I need to first of all classify whether it's an operating lease or a finance lease. Accounting will depend on whether it's an operating lease or finance lease. Now accounting for finance lease. Accounting for finance lease. Now they've written some 2-3 terms. Gross investment in lease, net investment in lease, unearned finance income. Which are the 3 words? Gross investment in lease, net investment in lease, unearned finance income. Okay, what is a gross investment in lease? Think from lesser angle. Whatever I will be receiving, whatever will be receiving, can I say I'll be receiving lease payment? Now lease payment includes guaranteed residual value. It doesn't include UGRV. So lease payment plus the UGRV which I am expecting, what I'll be receiving, that is called as gross investment in lease. Uska present value is the net investment in lease and the difference is the unearned financial income. So whatever I'll be getting including UGRV, so lease payments plus the UGRV is your gross investment in lease, present value of it is net investment in lease. Okay, so if it's a finance lease, if you give asset on finance lease, you will remove the asset from book. If you're giving asset on finance lease, you remove asset from your book and now you will have a finance lease receivable account. Finance lease receivable account will be at the present value of what you are going to get. So it is the present value of your lease payment plus the UGRV. Lease payment includes GRV, UGRV was not included, wo bhi aa gaya. So it is you account lease receivable to asset at net investment in lease. So you recorded at present value. Can I say now interest will accrue, we receive something, closing. Interest will accrue, we receive something, closing. This is how subsequently measurement will happen. We record finance income, we receive the payment, it becomes closing. Clear with this? Okay. Now there's a question which is a simpler one. I'm not going into this. Let's move ahead directly to change in unguaranteed residual value. If UGRV mein changes are happening, what they are telling. If UGRV mein changes are happening, if there has been a reduction in UGRV, you revise the income allocation over the lease term. You revise the income allocation over the lease term and recognize the reduction immediately. Now, sir, how is it? Check the question. Check question. They say you revise the income allocation and recognize the reduction immediately. What is the meaning of this? This is a question. It's a finance lease. You're going to get 5,000 every year for 5 years. GRV nil. UGRV was 4,000. UGRV was 4,000. And the net investment in lease is 20. Net investment in lease. Present value of lease payment plus the UGRV is 20. Now if you remember, day 1, finance lease receivable is at net investment in lease. I'll book first at 20,000. Then interest accrues, we receive something closing. So interest accrue, we receive something closing. Interest accrue, we receive something closing. This is in a way that last mein 4 bachega. Last mein you will have 4,000 which is pending, which will be sold and then received. Which will be sold and then received. Okay? So you are getting 5,5,555 and last mein by selling you will get that 4,000. But suppose in the question, if at the end of 3rd year, the UGRV is changed to 3. So now I feel after 5 years, I'll not get 4. Now I feel after 5 years, I'll not get 4. I'll get after 5 years, 3,000. Okay, when is the change done? 3rd year mein. When is the change done? 3rd. So 3rd year mein change is done. 3rd year end. So 3rd year mein change is done. Now UGRV has gone down by 1,000 rupee. But what 1,000 was to be received after 2 more years. The 1,000 was to be received after 2 more years. So what is the present value of 1,000? Yahan pe if you see 2 more years ke baad 1,000, the present year of 1,000 is coming 790. So 790 you record it right now as a loss. Okay, this was your interest income. Ye income tha. Ye loss aa raha hai. Deduct from this income. So in this 3rd year, there is an income 1844 and there is a UGRV reduced, the loss is coming 790. In 3rd year, you understood, deduct in 3rd year only. The 3rd year may from this 709 is deducted, there is a revised income of 3rd year. And because of that, closing balance changes, your income allocation of subsequent year also changes. Closing balance changes, your income allocation of subsequent year also changes. So it is recorded immediately and your income allocation is getting changed. Are you clear? Are you clear? This is accounting for finance lease. We removed asset from book. Asset chala gaya. What did we have? Asset is removed from book. We recorded a finance lease receivable. Okay. Now coming to operating lease. If it's an operating lease, the lessor will continue with the asset in the books. So asset will continue in the books. Okay, so sir, what about the lease income, the rental income? Rental income should be booked either on SLM basis or any other appropriate base. Either SLM or any other systematic basis over the lease term. Now, suppose they are going to give me rent first, second, third, fourth, fifth year. This is 100 rupee, 105, 110, 115, 120. So it doesn't mean that first year you record rent income 100, second year 105, third year 110. No. Total it. Total is coming 20, 15, 20, 30. This is 550. 550 divided by 510. So every year income will be 110. Every year you follow SLM or other systematic basis. So if I follow SLM यहाँ पे systematic basis is the way they use उसके basis पे. So I'll book 110 as income every year. So if you see यहाँ पे, the income will be every year same. But first year we did not got 110, we got 100. So 10 will be deferred rent receivable. That will be there, rent receivable आ जाएगा. Next year again income is 110. We receive 105. So 5 will come over here. Third year income 110, we receive 110. Fourth year, income 110, we received 115. 5 deferred rent receivable is reversed. And last year, 110, we receive 120. 10 deferred rent receivable gets reversed. This is how we are required to have for operating lease. I hope you're clear. Done. Now, manufacturer, dealer, lessor. Okay, who is the lessor over here? The manufacturer. Manufacturer is a lessor. Now I told you, if I am a lessor, I give my asset under finance lease. Remember I told you I remove the asset from my book. But here for you, the asset is your goods. You are a manufacturer. So for Maruti Suzuki, car is not an asset. It's not a PPE. Can I say for Maruti Suzuki, car is an inventory? Car is an inventory. So for Maruti Suzuki, car is basically an inventory. Now when Maruti Suzuki gives car on finance lease, so what Maruti Suzuki will do? Can I say they will write finance lease receivable debit to, they should not write car, they should write sales. Finance lease receivable debit to sales. And the car will go away from inventory. Car will go away from inventory. It will go in COGS. So second entry is COGS debit to inventory. Yes, no? So one year book the sales and opposite is COGS to inventory. This is the entry which is done. But now think, finance lease receivable debit, this is at net investment in lease. ये कौन सी वैल्यू पे है? नेट इन्वेस्टमेंट इन लीज. नेट इन्वेस्टमेंट इन लीज इज नथिंग बट व्हाट? नेट इन्वेस्टमेंट इन लीज क्या था? वॉट एवर आई हैव टू रिसीव इंक्लूडिंग यूजीआरवी उसका प्रेजेंट वैल्यू. वॉट एवर आई हैव टू रिसीव इंक्लूडिंग यूजीआरवी उसका प्रेजेंट वैल्यू. बट द प्रॉब्लम इज दे से यू कैन नॉट इंक्लूड सेल्स, you cannot include UGRV in sales. So finance lease receivable, if I just go over here, the net investment in lease, this is whatever I have to receive including UGRV uska present value. But in sales, I can't take UGRV, it's unguaranteed. तो sales में वो नहीं ले सकता हूं. तो sales में only the lease payment का present value. तो problem is this is 111, this is 103. Can I say these two are not matching only? These two are not matching only. If I go back to a journal entry, imagine if I book this as 100 and cost 80, both the journal entry tally. But suppose in first journal entry, I write over here 100 and sales I write 90. Can I say this is not getting tallied? Why? In your finance lease receivable, you have recorded whatever you have to receive including UGRV, uska present value. But in sales, you have recorded not the UGRV. UGRV जो मिलने वाला है that you can't include in sales, so you have included only the lease payment का present value. So UGRV's present value is the difference. What is the difference here? 10 rupee. UGRV's present value. So what do you do for that? You deduct the UGRV's present value from cost. So rather than including in sales, opposite ICI does is what? They deduct it from cost. तो cost में से that much amount will get deducted. तो now when I combine this entry will get tallied. तो दोनों entry को combine कर लो. दोनों entry को combine करो. 100 debit. This will be 70 debit. This is 90 credit and this is 80 credit. Check करो 170, 170. तो sales will not be at the same amount as net investment in lease. UGRV they say we can't include in sales. So present value of UGRV amount is the difference. Present value of UGRV we did not include in sales. The opposite we deduct it from COGS. Check the solution. तो यहाँ पे this is revenue के अंदर it's the present value of lease payment. Okay, UGRV का present value was not taken, so we deduct it from COGS. Did you understand? I hope this is clear. This was the only point. यहाँ पे we write sales and COGS to property की जगह better word will be inventory. If it's a manufacturer dealer, better word will be inventory. Okay, the only thing is in revenue we did not took present value of UGRV, so we deducted it from cost. That's it. Okay, this concept is over. Come to the next one. A lease modification for a lesser is not important from exam angle, skip it. Lease modification from lesser's angle is not relevant from exam angle, skip it. Come to sublease. Come to sublease. Now what is this sublease? Pay attention. This is A limited has leased to B limited and B limited leases to C limited. First one is called as a head lease. Second one is called as a sublease. Now accounting for B is important. A and C may accounting remain same. A, C may accounting is not different. A is a lesser, they will account like lesser. C is a lessee, they will account like lessee. But B is a lessee for A and lesser for C. B is a lessee for A, but lesser for C. How to account in B's book? Okay, first of all, when you took an asset on lease, so can I say first of all they will write ROU asset debit to lease liability. I'm talking about B Limited's book. When B took the asset on lease from A, when you are a lessee, there's no operating lease, finance lease, always ROU asset to lease liability. But now when you're giving it on lease to C, when you're giving to C, if B to C is finance lease, agar B to C is a finance lease, can I say asset goes away from your book? Asset goes away from your book. Now, asset is which one from in your book? ROU asset goes away and you will have a finance lease receivable debit to ROU asset. You have a finance lease receivable debit to ROU asset. Did you understood this? But if B2C is an operating lease, then ROU asset, lease liability, both will continue in the books. If B2C is a operating lease, then in B's book, ROU asset will continue, it will not go away. Okay. Now, Abhijit has a question, sir, is COVID point relevant for operating lease modification? Dear, I'll come to that COVID point later. COVID point wala is coming up, that is not skipped. I'll come to that. This is basically for your sublease. Now come to sale and lease back. A sells the car to B, or A sells the machine to B, and then we take it on lease from B. Okay, so can I say machine went out and machine came back? Machine went out and machine came back. Now, if control is really past, then you book a sale and then you book a lease may taken separately. If control is really past, sale is booked and then it comes back, it is booked separately. But if control is not past, then you don't book a sale only. If control is not passed only, don't book a sale. So, sir, money which you got, treat it as a loan. So, we sell and then we take it back on lease from them only. If control was passed, sale is also booked and then taken on lease is separately booked. But if control was not passed, no sales booked, directly it is just a loan agreement. Now, suppose control is passed. So, can I say I'll book a sale? Now, thing is, I book a sale, asset goes out and I take it back on lease. So, can I say ROU asset comes back? What is coming back? ROU asset is coming back. So, asset is coming back. If asset is coming back, now normally ROU asset is at which value? Remember we find out the lease liability, whatever I have to pay uska present value, and ROU asset generally comes at same value unless you have done some payment before or there's some lease incentive. So ROU asset will be generally at the same value as lease liability. Whatever I have to pay uska present value as lease liability, same value as ROU asset. But here they say that ROU asset will continue at the previous carrying amount for the right which is retained. ROU asset will be based on, so यहाँ पे first sale happens. We are selling the asset goes out, then it comes back. The first entry was actually kind of bank debit to say asset. And then asset went out, then ROU asset comes in, ROU asset to lease liability. Now normally we have this lease liability, ROU asset same, but they say that the ROU asset should be booked based on the previous carrying amount of the asset retained. तो जितना asset retain हुआ ना, उतनी जो carrying amount थी, you keep it at that value. And यहाँ पे जो profit or loss on sale है ना, profit or loss on sale is only for the portion transferred. The gain loss is only for the portion transferred. Some portion came back, don't record gain loss on that. Some portion is came back, don't record gain loss on that. Gain loss will only be on the portion which is transferred. Okay, this is fine. I'll come back. There's a sum on this. Now, one more thing. Sometimes whenever there's a sale and lease back, the sale amount is not many times the fair value. I sold you at a lesser rate so that बाद में you charge lesser lease rental. So I sold you not at 100, I sold you at 80. Now why I'll sell at 80? You are charging lesser lease rental separately बाद में. So indirectly I'll book a sale at 100 only. So below market terms. So I receive bank 80. Sales will be 100 only. Remaining is kind of a prepaid rent which you already paid. So if it is a below market term, 100 ki jagah I am selling you at 80. Why I'll sell at 80 yaar? Because it is getting compensated by lesser lease payment. Lesser lease payment बाद में मुझे देना है. So when I am making entry, bank debit is 80, but to sales is 100. Right? To sales is 100. 20 will be kind of prepaid lease rentals. Okay. Now if I am selling at a higher amount, 100 ki jagah 120. Tell me why anybody will pay 120? Instead of 100, why anybody will pay 120? Nobody will pay. It will be compensated by higher lease payments. It will be compensated by higher lease payment. So do one thing now. You are paying me 120, bank 120. To sales is only 100. Bank 120, to sales is only 100. Extra which I got from you, I'll treat it as a loan. Extra which I got from you, I'll treat it as a loan. And now when you're paying me lease rental, in that lease rental, something is towards the loan payment. And balance is the lease rental. Because when you are paying me more, I'll pay you more lease rental. Though more lease rental means something is towards loan and only the balance is towards lease rentals. Okay, so whenever it is a below market term, it's kind of prepayment of lease. Whenever it's a above market term, it's an additional financing. Okay, now check the question. Check the question over here. You sell a building to another entity for cash 30 lakhs. You sold a building to another entity for cash how much? 30 lakh. Building is carried at cost 15 lakh in your book. Fine. And you enter into a contract with the buyer to lease it back for 20 years and you have to pay annually 2 lakhs. Okay, the 20 years ke liye you leased, annually you are paying 2 lakhs. ठीक है, sold, leased back. ठीक है, sold for how much rupees? 30 lakhs. Now, fair value of building on the date of sale is 27. Now, tell me one thing. If fair value is 27, why someone will pay me 30? If fair value is 27, why someone will pay me 30? Can I say nobody will pay me extra? Nobody will pay me extra. They paid me 3 lakh extra. Why? Because it will be compensated by higher lease payment. So, day one, when you are paying me 30, I'll not record sale as 30. Sale is 27. Extra. Extra what I got 3 is treated as a loan. Extra which I got, I'll treat it as a loan. And one more thing, now when you're paying me 2 lakh every month or 2 lakh every year, इसमें something is towards lease and something is towards the loan payment. Something is towards lease, something is towards loan payment. Fine. Okay, buyer classifies the lease as operating lease. How the transactions are to be recorded in the books of seller, lessor and buyer. Buyer ko bhul jao abhi. I'm just talking about the seller who sold and then leased it back. Okay, so first of all, 3 lakh extra which I'm getting is treated as a kind of loan taken. Now, 2 lakh I have to pay for 20 years. So what I'm paying is 1494. Present value. Present value 1494. Okay, what is the present value of loan? Loan 3 lakh na aaj. See, 2 lakh what I am paying is for loan also. 2 lakh what I am paying is for loan plus the lease rental. Okay, so whatever I am paying, uska present value is 1494. Usme se 3 lakh is loan. So 1194 is for the lease rentals. So out of 1494, 3 lakh is loan. 1194 is for the lease rental. If I want to find lease rental every year, 1194 divided by 7.4694. 1194 divided by 7.4694. So lease rental is 159852. So simple words 159850. Okay, Abhijit says, sir, shouldn't we take present value of 3 lakh? Dear, loan today is 3 lakh. What I was paying in future, uska present value will be 3 lakh na. Whatever I was paying in future, उसका प्रेजेंट वैल्यू विल बी 3 लाख. तो इन दिस 2 लाख समथिंग आई वाज पेइंग फॉर लोन, तो प्रेजेंट वैल्यू कितना होगा? 3 लाख होगा. तो व्हेन आई एम टेकिंग दिस इज प्रेजेंट वैल्यू ना, तो इसके अंदर 3 लाख इज द लोन. आर यू क्लियर अभिजीत? This itself is the present value. Loan itself is 3 lakh na. Loan with interest is more. Today's value of loan is 3 lakh. So now out of basically this 3 lakh was loan, and what I am paying for the lease rental is 1194. That is 1194 is present value. If I want to understand lease rental yearly, to divide by 7.4694, so lease rental is 159850. Out of 2 lakh lease rental 159850, balance 4150 is towards loan every time. Out of 2 lakh which you are paying, 159850 is for lease rental, balance 4150 is for loan. ठीक है. Now your carrying amount is 15 lakh, उसका fair value is 27. उसका fair value 27. ठीक है. Now how much you are paying for the lease liability or lease rental? Can I say 159850? You will pay 159850 for 20 years, whose present value is 11.94. You will pay 159850 for how many years? 20 years, whose present value is 11.94. So lease liability in your books will be 11.94. So this is lease liability in books 1194, and this is the loan in your book 3 lakh. Lease liability 1194, loan in your book is 3 lakh. Did you understood this? Okay, you are getting currently 30 lakhs. You're getting currently 30 lakh, and building goes away, book value 15. Building goes away, book value 15. Now ROU asset comes. Normally lease liability 1194. Can I say ROU asset will also come at 1194? Normally lease liability 1194, ROU asset 1194, but they have clearly said ROU asset will come at the previous carrying amount of proportion retained. Previous carrying amount of what? The proportion retained. So can I say carrying amount 15 lakh, so fair value tha 27. This is carrying amount, this fair value. Carrying amount 15 lakh, fair value was 27. Okay, fair value 1194. तो carrying amount कितना? Find out. Carrying amount 15, fair value 27. Fair value of ROU asset is 1194. I want to keep it at previous carrying amount. So carrying amount is how much? 11.94 into 15 by 27. Are you getting 6.63? So ROU asset will not be 1194. 1194 is का fair value. I want to keep it at previous carrying amount. So it is 6.63. And now the profit. Profit I'll record only for the portion transferred. Okay, if I ask you out of carrying amount 15, can I say 663 is retained? Out of carrying amount 15, 663 is retained. So how much carrying amount is transferred? 15 minus 6.63. So carrying amount transferred is 8.37. Okay, carrying amount transferred 15, profit was 12. Carrying amount अगर पूरा 15 तो profit 12. कैसे 12? Fair value 27. If carrying amount transferred was 15, profit was 12, but out of 15, 6.63 is retained. So carrying amount transferred is 8.37. उस पे profit 8.37 into 12 by 15. Are you getting 6.69? So ROU asset is kept at the previous carrying amount, and profit is recognized only for the portion transferred. Carrying amount 15, usme profit was 12. 27 was the total value, but out of 15, 6.63 is retained, balance carrying amount transferred, so profit on that is 6.69. I hope you are clear. The journal entry will get tallied. Done. This is over. Now, this is rent concession arising due to COVID. Due to COVID, can I say many times the rentals were reduced? Now, rentals were reduced. Contract में नहीं था, but rentals reduced. Can I say it's a modification? not there in contract, rentals reduced, it's a modification, but they gave some exemption. So gave some exemption, don't treat it as modification. When? And this is only for lessee. You may not elect to assess as modification if all the following are present. The revised rent is the same or less. Revised जो rent हुआ ना वो same है या less है. Second, the rent payment only till 30th June 21 are affected. तो जो आपका reduction है ना, reduction was allowed only till June 21 and other terms are not changed. Okay, the revised rent is less or substantially same. अभी कम किया, बाद में increase किया. So this 3 months you pay less, later 3 months you pay more. So can I say substantially same or it is less? Second, reduction is only till 30th June. Reduction is till 30th June. Increase can be after 30th June also. And there's no other substantive change. If these three things are matched, then lessee may not record as modification. He can follow some other simple treatment. Whatever I pay now, I record that way. Okay. And this is only for lessee. So check over here. Rental was 1 lakh per month due to pandemic. Defer kiya April to June 20 wala. And January, February, March you have to pay more, 110. So currently you pay less, future में you are paying more. अभी 1 lakh कम pay करो, तब 110 ज़्यादा pay करो. 1 lakh you pay less now, that time you pay 110 more. तो can I say अभी मत करो, later pay करो, and now you say sir 1 lakh became 110, but वो interest. So can I say actually the payments are substantially same? Payments are substantially same, yes. Second, the reduction is only till June 21, yeah, reduction is till June 20 actually. And third, no other substantial changes, yes, so they can apply the practical expedient. Did you understood? And last one, the transition approach. Last one, transition approach. Okay, what is transition? Shifting from old standard to new standard. Shifting from old to new, that's called transition. I assume it is AS 19 to IND AS 116. Okay, I have a question for you. Under AS 19, can I say in books of lessee, if it's an operating lease, asset was not recorded. If it was an operating lease, asset was not recorded. But if it was a finance lease, asset was recorded. Now imagine it was an operating lease. So can I say in AS 19, lessee had not recorded asset? But under IND AS 116, what we have to do? We have to record ROU asset, we have to record lease liability. So how do I transit? So there are two options. One is a full retrospective approach. Second is a modified retrospective approach. Full retrospective approach means the IND AS 116 has been followed from very beginning. ऐसा मान लो IND AS 116 has been followed from very beginning. So imagine IND AS 116 is applied on 1/4/19. Suppose this came on 1/4/19. Problem is, if it comes on 1/4/19, IND AS 116, can I say previous year figure should also be as per IND AS? So 1/4/19 it started. So this is 1920. Previous year is what? 1819. Previous year is what? 1819. Previous year also has to be as per what? As per IND AS 116. Now do one thing. If IND AS 116 was followed from very beginning, what will be the ROU asset and lease liability at previous year beginning? What will be the ROU asset and lease liability at what? Previous year beginning. So previous year beginning mein, what will be ROU asset, lease liability? You start with that. So we'll start with previous year beginning. So there will be 3 columns in your balance sheet: current year end, previous year beginning. So if basically this new thing was followed from very beginning, check example over here. There's a 3-year lease beginning from 1/4/17. Annual lease payment are 2 lakh, March 18, 1920. Okay. The company has started adopting IND AS on 1/4/19. 1/4/19. So can I say it's 1920? Previous year is 1819. What is previous year beginning? 1/4/18. What is the previous year beginning? 1/4/18. So do one thing. I'm not telling to apply Ind AS from 1/4/18. I'm not telling to apply Ind AS from 1/4/18. Apply Ind AS from beginning only. You took a space on 1/4/17. So 1/4/17 onwards, if Ind AS was applied. 1/4/17 onwards, if Ind AS was applied, this was a lease liability on 1/4/17. This was a lease liability on 1/4/17. Okay, 1/4/17, that was a lease liability 480. Interest accrued, we paid 2 lakh closing. So can I say this is the lease liability on March 18? So March 18, can I say previous year beginning 1/4/18? Previous year beginning, this is the lease liability. Same way, previous year beginning, this is ROU asset. So previous year beginning lease liability, previous year beginning ROU asset. Earlier it was operating lease. In your books you don't have any of it. आपकी books में तो कुछ भी नहीं है. Bring this two figures. तो previous year beginning this lease liability books में आया, this ROU asset आया. Difference you adjust in retained earnings. तो previous year beginning you bring ROU asset, you bring lease liability, and difference goes in retained earnings. And then you account normally. So you are bringing it from which year? Previous year. But it doesn't mean your account, this doesn't mean that you followed from previous year. You have basically found this figures. You have basically found this figure as if the Ind AS 116 was followed from very beginning. If Ind AS 116 was followed from very beginning, what are the figures of lease liability, ROU asset at previous year beginning? We start from there. So this we introduce in book, difference we take it in retained earnings. Full retrospective approach. Did you understood full retrospective? Second one, the modified retrospective approach. Second one is the modified retrospective approach. Now in modified retrospective approach, what happens? In modified retrospective approach, you have to start from initial application. You have to start from initial application. Like Ind AS 116, if you see the question, Ind AS 116 is started from 1/4/19. It started from 1/4/19 ko. I'll not bring ROU asset and lease liability beginning of previous year. Previous year figures are not changed. I'll bring ROU asset and lease liability today, 1/4/19 ko. I'll bring lease liability and ROU asset in my books today. Now sir, what value? Simple kar dete, simple. Today is 1/4/19. Okay, today is 1/4/19. Whatever payments are pending, uska present value is lease liability today. Whatever payments are pending, uska present value is the lease liability. Okay, you had to make payment for March 18, March 19, March 20. Okay, 1/4/19. Can I say only one payment is pending? As at 1/4/19, only one payment is pending. So if I just go down, as at 1/4/19, only one payment of 2 lakh is pending, which will be in next year, March 20 ko, first year end mein. Today is 1/4/19, March 20 wala payment, only one pending. So 181,820. Whatever is payable now onwards, I'm not going back. Whatever is payable now onwards, uska present value, this is the lease liability. And you are bringing in your books on 1/4/19, not 1/4/18. So 1/4/19, the lease liability is this. Okay, now ROU asset. Now ROU asset, two options. Two options. Just check question. So lease liability we understood. Now ROU asset. So lease liability is done. Whatever present value of the remaining lease payment today, 1/4/19 ko. Now ROU asset, there are two options, A and B. How ROU asset will come? One option is B wala is the same. So whatever lease liability came, same is ROU asset, done. So Ashwath, B option is that. B option is whatever lease liability came, same ROU asset, done. But A option is if the Ind AS 116 was applied from beginning, or 1/4/17 say you took on lease, if the Ind AS 116 was applied from beginning, but take the discount rate going on today. If the Ind AS 116 was applied since the commencement date using discount rate of today, what will be the ROU asset today? Okay, so if day 1 say Day 1 से Ind AS 116 was followed, but discount rate today wala. So what will be the ROU asset today that you take it? So for lease liability, whatever I have to pay from now onwards, uska present value. ROU asset, if Ind AS 116 was followed from 1417, what will be the value of ROU asset? What will be the value of ROU asset on 1419? Bring that. And now difference between lease liability and ROU asset goes in retained earnings. So one, you find ROU asset as if the Ind AS 116 was followed from very beginning using the current rate. So using a 10% rate, current rate. So 497, usme now 2 years you give depreciation. So now it will be 165787. So ROU asset comes at 165787, lease liability was 181, difference goes in retained earnings. So this entry comes in 19, not previous year beginning, this year say. But second wala, this modified retrospective mein one more option. What you do, you keep the ROU asset same as lease liability. What practically everybody followed was the modified retrospective approach. Lease liability I'll bring at whatever I have to pay uska present value. Lease liability I'll have whatever I have to pay uska present value. ROU asset they kept the same value, no adjustment in retained earnings. Option 2 is better, the simplest one. Then this was your Ind AS 116, and now we are left with Ind AS 109, which is your financial instrument. We do one thing, we are taking a break again. We do one thing, we are taking a break, then we are again starting. Okay, how much time break? It's 7:10. We are meeting back after 20 minutes. It's 7:10. We are meeting back after 20 minutes. We are meeting back at 7:30. 7:30 we are meeting back. We'll finish off this and then we'll go to Ind AS 101. Chalo, 7:30 we are meeting back. Till then, enjoy your break. Okay, now let's go to Ind AS 109. Come back, chalo. We are done today with Ind AS 115, Ind AS 116, and we also did Ind AS 108. 109 and 101, the last two standards are remaining. So our marathon, this took around 25 hours. Yeah, the total it will be taking around 25 hours. It's a very detailed marathon. So it's not a superficial revision what you have done. We have done an extreme detailed revision. This is pakka going to help you out. And if basically you are benefited, you also please share it with all your friends so that other people are also benefited out of it. And one more thing, again I'm announcing, I have launched a new batch for CA Final FR. That new batch for CA Final FR is based on the latest ICA material, covering all your RTPs till November 2022. Your suggested answers till May 22, and that batch is a high quality studio recording, a similar quality what you are seeing right now. And the subscription is available subject wise as well. So no need to take up a subscription for entire group. You can just have a subscription for that one subject only of FR or one subject of audit, any subject which you like. Prices are really very competitive and you can get a special discount by using a code CA Niket. Chalo, let's go to chapter number 12. Now your chapter number 12 is having 7 units. Out of 7 units, the last 2 units are not relevant from exam purpose, the disclosure and the hedge accounting. So we will not be doing that in class. Never a sum on hedge accounting is asked till now, and ICI material also, there is no question given on hedge accounting. And disclosure again is not relevant for exam purpose. So starting with the first one, that is your scope and definition. Starting with unit number 1, chapter number 12, scope and definition. What do you mean by the word financial instrument? Financial instrument is a contract which give rise to financial asset to one party and financial liability or equity to another party. So it's any contract which is giving a rise to financial asset to one party and financial liability or equity instrument to other party. And see, it's a contract. If something is not a contractual thing, it doesn't come over here. So any legal liabilities are there, income tax, etc. They are legal liability. They are not contractual. They will not come over here. Next one, what do you mean by the word financial asset? Financial asset is any asset which is either cash in any currency or investment in equity or a contractual right to receive cash or other financial asset from someone, or we have a contractual right to exchange financial assets or financial liability under a circumstances which are favorable to us. So we can exchange financial asset or financial liability with someone under circumstances which are favorable to us. So can I say that the right to exchange which is available currently, which is a favorable one, it is a financial asset for you. How to account for it, we'll come to it later. Okay. Now what is a financial liability? Financial liability is a contractual obligation to deliver cash or other financial asset to another entity. It's a contractual obligation. Or it's a contractual obligation to exchange financial asset or financial liability under the terms which are unfavorable to the entity. If I have a contractual right to exchange financial asset, financial liability, and the terms are favorable, it was financial asset. If I have a contractual obligation to exchange financial asset, financial liability under the terms which are unfavorable, it's a financial liability. Okay. Now, there's one more thing given under financial liability, a contract which will or may be settled in your own equity instrument. There's a contract which will or may be settled in your own equity instrument if the amount to be paid or the number of shares to be given, any of them is not fixed. I'm giving my own equity instrument, but the amount to be paid or the number of shares to be given, any one of them, if it is not fixed, then it will be a liability. It will come under equity only when fixed for fixed test is satisfied. What is fixed for fixed test? The number of shares and the amount to be paid has to be fixed. Both the things are fixed, then it will come under your equity instrument. If fixed for fixed test is not satisfied, then it will come under your liability. So imagine I purchase goods from you and I am required to give you variable number of shares. So can I say I have to give you my own equity instrument? But if I have to give you a variable number of equity shares, then it is not a part of equity instrument. It will be covered under financial liability. Okay. What is equity instrument? That is giving a residual interest in the asset of the company. And for a equity instrument, there should not be any contractual obligation to deliver cash or cash equivalent. And if you are settling by your own equity instrument, fixed for fixed test has to be satisfied. Fine. Okay. Now come down to preference shares. How do we classify the preference shares? So I need to check out uske characteristic. If they are a redeemable preference shares, redeemable at a specified date, it's a financial liability. Redeemable at holder of option, at the option of holder. Whenever that guy wants, whenever the holder wants, I have to pay money. Still, it's a financial liability. Redeemable at the option of issuer. I can redeem whenever I want. Then it is classified as equity because you do not have a present obligation to transfer the financial asset. But at the time when you decide I want to pay off, it will be reclassified as financial liability. So if it is redeemable on a specified date, liability. If it is redeemable at option of holder, liability. If it is redeemable at your option, you pay whenever you want, then it is equity. But the day when you decide you want to pay off, it becomes liability. Next is irredeemable. Irredeemable preference shares. Irredeemable preference shares will be covered under your equity. Irredeemable preference shares is covered under your equity. Now suppose the dividend. If dividend on preference shares is mandatorily payable, that dividend part will be liability because principal is irredeemable. But if dividend is to be paid mandatorily, that much portion will be liability. But if dividend is also at your discretion, then in that case, entirely it will be equity. Okay, next. Now, there's a carve in, carve out में what is given over here. Now, tell me one thing. There's a foreign currency convertible bond. There's a foreign currency convertible bond wherein I'll be giving my own equity shares. There's a foreign currency convertible bond. I have to give my own equity shares. Now, if the exercise price is given in terms of dollar, it's a foreign currency bond. I'm going to give them my shares. If exercise price is given in terms of dollar, in India, we say fixed for fixed test is satisfied. In India, we say fixed for fixed test is satisfied because you are giving fixed number of shares, fixed amount you got. Foreign currency convertible bond, you got a fixed amount, you're going to give a fixed number of shares. So fixed for fixed test is satisfied. But abroad mein, in case of your IAS 32, they say if at all the exercise price is in dollars, then in that case fixed for fixed test is not satisfied because the dollar ka rate keeps on fluctuating. So in India, if it's a foreign currency convertible bond, FCCB, I got a specified money, fixed money I got, and I have to give them fixed number of shares. Okay, the exercise price is given in terms of dollar, still fixed for fixed test is satisfied in India. IAS 32, that fixed for fixed test is not satisfied because the exercise price is in dollars, foreign currency mein, so uska rate keeps on fluctuating. This is what they are telling. So this as per IFRS, it's a liability. As per India, it will be equity. As per Ind AS 32, it will be equity. Then coming to this illustration 1, we have a bond with a face value USD 100, foreign currency convertible bond. This is convertible into 1000 equity shares. Okay, can I say today you got USD 100? Today you got USD 100 and then you have to give them 1000 shares. Okay, today I got USD 100. Okay, USD ka rate keeps on fluctuating, but I don't see that. I got fixed amount USD 100 and I have to give fixed shares. It will be classified as equity in India, but it will be classified as what? Liability in IAS. Okay. Now, how do we account for a compound financial instrument? What do we first of all mean by a compound financial instrument? It's a financial instrument which has a characteristic of liability also, which has a characteristic of equity also, both, which have a feature of both liability as well as equity. Simplest example, optionally convertible debenture. Not compulsory, optionally. If optionally convertible debentures are there, optionally convertible, can I say they can go for cash also, they can go for shares also. Now what they will go for, whether they'll go for shares, whether they'll go for cash, I don't know. I don't know. So I cannot treat entirely as equity, I cannot treat entirely as basically liability. It is a compound financial instrument. In a compound financial instrument, you have to bifurcate the liability component, equity component. Liability component will appear under your liabilities, equity component will appear under your other equity. Now first, they say equity is a residual interest. So do I find liability first or do I find equity first? They say equity is a residual interest. Okay, so we will find the fair value of liability component. How do I find the fair value of liability component? Ashwath, we'll find the fair value of liability component. How do I find the fair value of liability component? Whatever we have to pay, assume they will go for cash. Assume they will go for cash, so we have to pay interest. Whatever we have to pay. If our debentures are 5%, so we have to pay 5, 5, 5, 5, 5 and 105. Discount it by a rate of the debentures which do not have a conversion option. See, if I am giving debenture with a conversion option, I give extra benefit to them. I'll give a lesser rate of interest. So debenture without conversion option will have a higher rate of interest. So I am paying 5, 5, 5, 5 and 105 discounted by the normal debenture ka rate. Normal debenture rate is 8%. You discount that, the present value will come say less than 100, it comes 90. So 90 is the liability, balance 10 becomes the equity component. So first we calculate the fair value of liability component, equity is assigned the residual amount. How to find the fair value of liability component? It is the present value of the discounted cash flows what you are required to pay, ignoring the possibility of conversion, assuming they'll go for cash, and the discount rate is the market rate of a similar liability which do not have a conversion option. Okay, check this question. 8% convertible loan, 6 lakh, redeemable at par, Alternatively, they may go for shares. ठीक है. Equivalent loan without conversion option is 10%. See, I am giving 8. See, I gave you conversion option, na? I gave you some extra benefit. So I'll charge also, na? So I'm giving lesser interest. Now what I have to pay? I have to pay on 6 lakh 8%. I have to pay on 6 lakh 8%. I have to pay 48, 48, 48 and last mein 648. Discount it by 10%. So present value is 560. 560 is the liability component. Out of 6 lakh, 560 liability, balance becomes equity component. Okay, I have a question. So day one, whenever I split the compound instrument into liability and equity, is there any gain loss coming? Day one, when I split the compound financial instrument into liability and equity, is there any gain loss coming? No. No gain loss comes. Something is liability component, balance is equity component. No gain loss. So entry on day one, bank debit to liability to equity. That's it. Now on the liability, interest will accrue at that 8%. On the liability, interest accrues. Interest to liability and then we pay liability to bank. Interest to liability, liability to bank. Interest to liability, liability to bank. Every year that will continue. Okay. Next one, this is question asked in November 19 exam. You have a convertible debentures. They are redeemable at 10% premium. We don't care about it. We don't care about it. It automatically gets adjusted in that interest which is there. So effective interest rate will go up if they are redeemable at premium. Effective interest rate will go up. Okay. Now check, they are convertible into equity to the extent of 50%. And 50% to be paid in cash. So now when I am calculating liability component, I have to take only 50% principal because 100% is not to be paid in cash. 50% will be converted into equity mandatorily. And for 50% I have to pay cash and plus I have to pay interest. Plus I have to pay interest. Now ours are 6%. Okay, so 5 lakh into 10, 50 lakh. 50 lakh ka 6%. Interest is 3 lakh. Interest is 3 lakh. 3 lakh I have to pay for 4 years. We discounted by the normal market rate 10%. 3 lakh I have to pay for 4 years. Discounted by normal market rate. Fine. Principal may take half. Now I have to pay 50 lakh ka half, 25 lakh. But I have to pay not 25 plus 10%. Redeemable at 10% premium. So 50 lakh ka half is 25. Uska plus 10%. That's why it is 1.1. Discount it at 10% and they are to be paid at the end of 4th year. They are to be paid at the end of 4th year. So this is for the principal which I have to pay in future. This is for the interest which I have to pay in future. This becomes your total liability component. The only point was half is convertible into equity mandatorily. Remaining half principal will be paid. So this is the liability component. Balance becomes your equity component. Next, conversion of compound financial instrument. Conversion. See, we have a compound financial instrument. They may go for shares, they may go for cash. We have in our book liability component also, equity component also. If they go for cash at the end, if they go for what? Cash at the end, liability component will be paid. If they go for cash, liability component will be paid. Equity component will be transferred to retained earnings, not required. Liability component will be paid and the equity component will be transferred to retained earnings. Okay, if at all they are going for shares, what do we do? So now liability goes away, equity will come in. Original equity component remains in equity, but it is transferred from one line item to another. Now, if you just recall your share-based payment, I told you, वहाँ पे भी था ना share-based payment with cash alternative. So if I interpret this line, if they go for shares, liability component convert into equity share capital. Liability component convert into equity share capital, and the equity component still you transfer to retained earnings. So actually this journal entry is wrong. I'll just change it. I write down above. So liability component to equity share capital, liability component will get converted into equity share capital, and your equity component will still go to retained earnings. Okay, so if they go for cash, liability component paid, equity component goes to retained earning. If they go for cash. If they go for shares, liability component gets converted into capital, equity component will get converted into retained earnings. See the line written. The original equity component remains as equity, although it may be transferred from one line item of equity to another line item. Although it may be transferred from one line item of equity to another line item. And there's no gain loss coming on conversion. There's no gain loss coming on conversion. Okay, question number 4 is actually simple. Last में they are converted. Okay, now यहाँ पे if you see this line, they are writing that original equity component remains under equity. It's transferred from one equity item to another equity item. So it is from there to basically we convert into what? Retained earnings. वो भी part of equity है. But the sum which they have solved over here, यहाँ पे there's a confusion done. What they have done confusion? So liability component goes into equity share capital. Equity component also gets converted into capital. So they've actually solved in this way. If I just go down to the entry, at the time of conversion, liability component, equity component, both are converted into equity share capital. Liability component, equity component, both are converted into equity share capital, but I'll suggest you to do what? Liability component 9201, take it in equity share capital. Equity component 1149, transfer to retained earnings. Liability component transfer to equity share capital. Equity component transfer to retained earning. This is what ICI has done it. In your chapter of share-based payment, वहाँ पे this sum is there, similar, वहाँ पे they've done in that way. So better you follow that thing. Next, early settlement of compound financial instrument. Okay, now this is important. If compound financial instrument is settled early. Now, I have a question for you. Day 1. For compound financial instrument, can I say we bifurcated something for liability, something for equity? So when I'm settling it, if that compound financial instrument is settled in between, I need to again bifurcate how much is for liability, how much is for equity. So day 1, it was bifurcated, something for liability, something for equity. So later when I'm settling also, I need to bifurcate how much for liability, how much for equity. So first of all, now you're paying something right now. You're settling it. Suppose out of 4 years, you're settling in 3rd year. So can I say 4th year as such was pending? 4th year as such was pending. What should be the liability today? तो जो 4th year का payment है उसका present value. Whatever is 4th year's present payment, उसका present value. So that much is the payment for liability. Balance is the payment for equity. So again, I'll find first the payment for liability, then the payment for equity. The issuer starts by allocating the settlement price to the remaining liability. So what is the liability remaining? Using discount rate based on today. Okay, using discount rate based on today. Okay, so today I'm settling now. Today I'm settling whatever was pending. Okay, I'm settling today, but agar I had not settled, there was some liability pending. Discount it. उसको डिस्काउंट करके लेके आओ today's value पे based on today's discount rate. So 1 year was pending, 1 year का present value, that is towards the liability. So out of your total payment, that is towards liability, balance is towards equity. Why this is to be done? Reason. So when you are settling, something is for liability component, something for equity component. Now there was some liability component, we paid something for liability component, difference will go in P&L. Okay, there was something in equity component, we paid something for equity component, difference will go in equity. If it was a liability, usme payment less more done goes in P&L. If it was a equity, payment less more done, it will go in equity only. That's why this is to be done. Check the question. Day 1, it was 10 lakh. Liability component 924, equity component 75939. Day 1. Liability component 924, equity component is this. Now on liability component, interest accrues, we pay something, interest accrues, we pay something. So these are the balance of liability every year end. Okay. And normally I would have paid 1060 at the end. But we went for early redemption and we prepay 11 lakh. Kab pay kiya? 30th June 03. Now June 03 I prepaid how much rupees? 11 lakh. We are at June 03. Normally, can I say only 1060 was pending in next year? 1060 was pending in next year. June 03 है, June 04 में 1060. तो 1060 का present value at today's discount rate. Check 1 year wala interest rate today can be at 5%. D could have issued 1 year non-convertible instrument at 5%. So 1060 you discount it. Okay, so 1 divided by 1.05 into 10,60,000. So can I say it comes 1,009,523? 1,009,523. Okay, so out of 11 lakh, 1,009,523 is for liability, balance is for equity. So 1,009,523 is liability, balance out of 11 lakh, equity is 90477. So whatever was pending to be paid, uska present value at today's discount rate. That much is for the liability, balance is for the equity. Now, in your books, what is the liability in your books? In your books, what is the liability? June 04. June 04 liability 972. June 04 liability 972. You are paying 1009. Liability 972. You are paying 1009. You are paying more. Extra goes in P&L. So check entry. Liability 972. We paid 1009. Difference went in P&L. Now, how much did we pay for equity? 90,000. How much did we pay for equity? 90. Now, how much was equity in book? 75. Equity is 75, but we paid 90. Equity is 75, we paid 90. Extra what you paid will go in equity only. Equity is 75, we paid 90. Difference goes in equity. Are you clear? Okay. If I amend the terms of convertible instrument, if I amend the terms in order to induce them to go for conversion, if I'm amending the terms to induce them to go for conversion, uske karan whatever fair value changes, that goes directly in P&L. The difference, original fair value and now the fair value based on this change wala thing, the difference will go directly in P&L. We don't have sabandas, this thing is given. Okay, interest dividend losses. Interest dividend losses. Now pay attention. If an instrument is classified as a liability, the interest dividend on it will go in P&L. So debentures are liability, interest goes in P&L. Preference share, if classified as liability, the dividend on preference share goes under finance cost. So if the instrument is a liability, dividend, interest, losses, gains on it will go in P&L. But if an instrument is equity, the dividend, interest, gains, losses on it will go in other equity directly, retained earnings. Fine. Next one, transaction cost. This point important. Next one, transaction cost. This one important. Okay, transaction cost. Transaction cost related to equity, we deduct from equity. Transaction cost related to liability, we deduct from liability. So loan, we took 50 lakhs. Processing fee, we paid 1 lakh. Loan, we took 50. Processing, we paid 1 lakh. So net loan in your books will be 49. 50 came in, 1 we paid. 49. And on 49, we are paying that interest. So we are paying that 5 lakh interest, not on 50 lakhs. We are paying 5 lakh interest, not on 50 lakh. We are paying 5 lakh interest on 49 lakh. Effective interest rate will go up. Effective interest rate will go up. So your transaction cost for equity deducted from equity, transaction cost for liability deducted from liability. If it's a compound financial instrument, can I say we bifurcate equity component, liability component? The transaction cost will be apportioned between both in that ratio. The transaction cost will be apportioned between both in that ratio. Check this question number 6, asked in May 19, November 20, 2 times. Now check, compulsorily convertible preference share. Okay, it is compulsorily convertible, so would it be liability or equity? Cash तो देना ही नहीं है, तो it is equity. But the dividend is to be paid. Dividend is payable every year, so only dividend component will come in liability. Principal is not to be paid only, it's compulsorily convertible. Principal will come under equity. Dividend is mandatory, dividend component will only come under your liability. The dividend I have to pay 10% of your face value is 150. Okay, so 10,000 into 150, face value is 150. 15 lakh, 10% is 150. So 150 I have to pay for 5 years. So 150 I have to pay for 5 years, 150, 150, 150, 150. So your liability is 502 out of 15 lakh. Equity becomes 997,176. Now why equity came more? Because principal component was not in liability. Why equity component came more? Because the principal was not under liability. Only dividend I have to pay every year. That's why it's a liability. Okay, now if you see liability component this, equity component this. If I have a transaction cost, you apportion transaction cost in this ratio. So there is a transaction cost of 30,000 rupees, 2%. We apportioned in the same ratio, and now we have the net liability and net equity. Now we have the net liability and net equity, and on this net liability, the effective interest rate will be applied. So now when I prepare a table, the liability is 492,767. Interest accrues, we pay something, closing. Interest accrues, we pay something, closing. Interest accrues, we pay something, closing. Did you understood? They are compulsorily convertible. The principal portion does not come under your liability. So when I was calculating liability, only dividends were considered. So there was a question asked from student, sir, why we have not considered yahan pe 15 lakh rupee? Because that is principal portion, it's compulsorily convertible. Next, this is done. Now scope of financial instrument, this IND AS 109. Now see, investment in equity. Investment in equity, can I say it is financial asset? If it's a financial asset, 109 should apply. But if it is investment in subsidiary associate JV, if it's investment in subsidiary associate JV, valuation will not be as per 109. Valuation will be as per IND AS 27, separate financial statement, and IND AS 110 and IND AS 28, which is on consolidated financial statements. Plus, this point we already done. Like we have a contract to buy or sell non-financial item. If I have a contract to buy or sell non-financial item, so remember inventory or PPE, I'm going to purchase, and if I'm going to give shares, inventory, PPE, I'm going to purchase and I'm going to give shares. Yaad aaya? Okay, so that is covered under share-based payment. But if that will be settled in net, inventory will not come, shares will not be given. If inventory ke rates have gone up, you pay me difference. If shares ke rate have gone up, I pay you difference in cash. Then it will be covered under 109. So if at all they are not for expected purchase, they are not for expected purchase sale, then in that case they will be covered under your IND AS 109. Did you understood? Okay, now offsetting a financial asset and a financial liability. We have one financial asset, we have one financial liability. Can I net it off? See, you should net it off only when you currently have an enforceable right to set off. Okay, same guy is my debtor, same guy is my creditor. Same guy is my debtor, same guy is my creditor. And I asked that guy that can we have a settlement in net rather than me paying and you paying? Can we have a settlement in net? He agreed. So I have a currently legally enforceable right and we intend to settle on net basis. Then only we can do it. Otherwise, we have to show them on gross basis. Done. This is unit number 1 and 2. Come to unit number 3. This is unit number 1 and 2. Come to unit number 3. Okay, unit number 3 is classification and measurement of financial asset, financial liability. Okay, coming to first financial asset. We know financial assets are classified in three categories. They're measured either at amortized cost, fair value through OCI, or fair value through P&L. Now, which one to be used when? Remember, if at all business model is to hold till maturity and the contract gives rise to cash flow which are solely the payment of principal and interest. Business model holding till maturity and the contract is giving rise to cash flow which is solely the payment of principal and interest, then we follow amortized cost. But a business model is to hold the asset, but we may sell it off in between. We may sell it off in between and the contract gives rise to cash flow which are solely for principal and interest, then we have FVT P&L. Sorry, FVT OCI. And one which doesn't fall above, that will be FVT P&L. So one is FVT amortized cost, second is FVT OCI, third is FVT P&L. Equity instrument don't fulfill that SPPI test. When I invest in equity, they don't fulfill the SPPI test. So that equity instrument will always come under FVT P&L, but there is an irrevocable option available under equity. If I have invested in equity, I have an irrevocable option. I can measure them at fair value through OCI. Are you clear? We have done this in the chapter of consolidated financial statements also earlier. Okay, business model test, that is fine. Contractual, that is fine. This we already discussed, so this is okay. This is not relevant from exam purpose. Now come to financial asset initial measurement. Okay, how are the financial asset measured on day one? On day one, your financial asset, except your trade receivable, they are measured at the fair value. So all your financial assets are measured at which value? Fair value. And normally the fair value will be the transaction price. You bought investments from market, you would have bought it at fair value only. So they are to be valued on day one at fair value, not fair value less cost to sale. If you remember IND AS 41, biological assets day one pay fair value less cost to sale. This is not fair value less cost to sale. This is fair value. So they are to be measured at fair value. Normally the fair value will be the transaction price, but sometimes the transactions are at off market terms. Sometimes the transactions are at what terms? Off market. I gave a loan to my employee at subsidized rate. I gave a loan to my employee at what rate? Subsidized rate. The 100 rupee loan I have given, market rate is 10%. I gave it 6%. So now whatever I'll be getting, how to find fair value? Whatever I'll be getting, 6666106. We'll be getting 6666106. Discount it by the normal rate of interest 10%. So 6666 and 106 I'll be getting discount by the normal rate 10%. So present value is coming, say for example 92. So 92 is asset, remaining 8 treat it as a prepaid salary. Remaining 8 you treat it as a prepaid salary. Did you understand? So if they are at off market terms, we need to find out fair value. How to find the fair value? It's the present value of all the future cash which you are going to get, discounted using the prevailing market rate. So I'll be getting 106. Discounting will be at 10%. Fine. Now, whenever it was off market terms and you found present value is coming 92, but you have given them 100 rupee, what do I do with the difference? Okay, if the fair value was based on level 1 input or observable data, that is level 2. If the fair valuation was based on level 1 and level 2, the difference will go in P&L immediately. Otherwise, if it was not level 1, level 2, then in that case, what do? You recognize the difference between the fair value and transaction price as an asset, if it qualifies as an asset, or it is amortized to P&L. So if I am taking the difference over here as prepaid salary, that prepaid salary will be amortized to P&L over the period, 5 years. Okay. Next is transaction cost. See, when you buy investment, can I say there will be some transaction cost? You're buying shares, the brokerage, that's a transaction cost. How should I account for transaction cost? If financial asset or financial liability is carried at FVT P&L, if financial asset or financial liability is carried at what? FVT P&L, the transaction cost goes in P&L. Acha, so if I have an investment in equity, which is carried at FVT P&L, the brokerage which I pay on investment is not added to investment, it will go in P&L. So if financial asset, financial liability is carried at FVT P&L, the transaction cost goes in P&L. But if financial asset, financial liability is carried at amortized cost or FVT OCI, then the transaction cost is added to the asset, deducted from the liability. It is added to the asset, investment mein add karo, liability mein deduct karo, automatically it gets spread over the life, kind of. So if financial asset, financial liability carried at FVT P&L, it goes in P&L. If they are carried at amortized cost or FVT OCI, then they are added to asset, deducted from liability. Subsequent measurement depends on classification. If it is a amortized cost, so can I say interest will accrue? So day one they are fair value. Subsequently interest accrued, we receive something closing. Interest accrued, we receive something closing. Achha, if they are measured at fair value, FVT OCI, if at all they are at FVT OCI, now tell me one thing. Under FVT OCI also, the SPPI test is fulfilled. The business model is basically not to hold till maturity, we may sell off. And the contractual cash flows are such, it gives rise to payment only for principal and interest. Now the thing is, whenever you're valuing at FVT OCI also, still interest will accrue, we receive something, and then closing comes, and then the closing is fair valued. Every year interest will accrue, we receive something, closing, and then the closing is fair valued. Okay, now someone asked me, sir, closing fair value. So now interest will be on the fair value wala thing? No. If closing fair value, now whether interest will be on fair value wala thing? No, interest will be as per the original table. Interest will be as per the original table. Achha, one more thing, yesterday someone asked me, remember what long-term interest tha in associate? Equity ke saath long-term interest. If that long-term interest was written off, so how interest is accruing on that? That interest will continue as per the original table only. So here also original table, there also original table. Even if it is FVT OCI, interest accrues, we receive something, closing, and then the closing is fair valued. Clear? Okay. If it is FVT OCI, difference fair value ka will go in OCI. If it is FVT P&L, the difference of fair value will go in P&L. Now check this question. We have given an interest-free security deposit. Interest-free. So I gave 10 lakh. Can I say after 5 years I'll get back 10 lakh only? After 5 years I'll get back 10 lakh only. So after 5 years I'm going to get back 10 lakh. What is the present value of it? The present value of it is 567, 427. That's the fair value of asset. So यहाँ पे when you are giving security deposit 10 lakh, I can't record asset 10 lakh. The fair value is not 10 lakh, fair value is 567 because I'll be getting back 10 after 5 years. So today's value is only 567. To show asset 567, extra what you paid, you treat it as prepaid rent. This was a security deposit for rental period, rental purpose, lease. So treat it as a prepaid rent. Okay, so day one security deposit is 567. Prepaid rent is 432 and to bank is 10 lakh. Now on your security deposit, you've taken present value, na? Interest will accrue. Every year on your security deposit, interest accrues. And the prepaid rent will go to P&L on SLM basis. Prepaid rent will go to P&L on SM basis. So यहाँ पे interest accrued, तो security deposit to interest. Again security deposit to interest income. Security deposit to interest income. After 5 years, that 567 will become 10 lakh. And then 10 lakh we receive back. ठीक है, यहाँ पे this will go to P&L and after 5 years it becomes 10 lakh, we receive back 10 lakh. Okay, this next question we already discussed. It was asked in November 2020. Pay attention. As a staff welfare measure, we give loan to employee 5%. Market rate is 10. We lend 16 lakh. How it is paid? How it is paid? It is repaid in 5 equal installment for principal plus the interest. Okay, the 5 equal installment is for principal. I gave 16 lakh divided by 5. So he will repay every year 3,20,000 plus interest. What he will repay? 320 plus interest, 320 plus interest, 320 plus interest. That is how he will repay. So we are getting what? we are getting 320 plus the interest. So this is what we will be getting in future, uska present value at a normal market rate. So we are be getting 320 plus interest, ye total ho gaya, uska present value at a normal market rate. This is the liability, or this is basically the fair value of asset, loan given na. So this is a fair value of asset. So 1406 is fair value of asset, but sir we give 16 lakh. 1406 is the fair value of asset, but sir we give 16 lakh, extra will be treated as a prepaid salary. So staff loan is 1406, extra is a prepaid salary and to bank. Now on that staff loan, interest will accrue at a normal market rate and prepaid salary will go to P&L on a SLM basis. Clear? Next, there's a redeemable preference shares. A has issued to holding company. The subsidiary issued redeemable preference shares to holding. So simple words. Can I say holding company has invested in redeemable preference shares of parent? Holding company has invested in redeemable preference shares of parent. Now if you see the dividend rate is nil, it's 0.00001%. Ignore. So I paid you 10, not 10, it's 1 CR. Can I say I'll get back also 1 CR? I paid you 1 CR, after 5 years I'll get back 1 CR. So actually the fair value of investment is not 1 CR, it's less. I'll be getting after 5 years 1 CR. The fair value of investment is coming as 56,74,000. Okay, so now how will I account? I cannot show investment in preference shares 1 CR. I have to show investment in preference share 56 lakh. But to bank is 1 CR. Investment in preference shares. You got preference shares is 56,74,000. But to bank is what? 1 CR. Difference will be treated as investment in subsidiary. So parent giving benefit to subsidiary treated as investment in subsidiary. Yes, no? Parent giving benefit to subsidiary is treated as investment in subsidiary. Fine, this is done. Next, question number 5 is important. The prepayment. Question number 5 is important. Prepayment. Okay, we have given a loan to employee. We have given a subsidized loan to employee. Okay. Loan amount is 10 lakh. Interest is 4% on 4 lakh and remaining 6% by 7 lakh. Start date is 1101, 5 years. Prepayment is allowed, full, partial, you can prepay. Okay. The principal amount will be recovered in 5 equal installment. In 5 equal installment, what is recovered? Principal. So out of 10 lakh, can I say I'll repay 2 lakh, 2 lakh, 2 lakh, 2 lakh, 2 lakh. So 2 lakh plus interest, 2 lakh plus interest, 2 lakh plus interest, 2 lakh plus interest. Okay. So first year he will repay 2 lakh plus interest. Now he is repaying at the end. The full 10 lakh loan was pending. He is repaying at the end, full 10 lakh loan was pending. 4 lakh ke upar interest is at 4%, remaining 6 lakh pe interest is at 7%. But our first year end he repaid 2 lakh principal. Can I say next year principal pending is 8 lakh? Next year principal pending is 8 lakh. So now interest 8 lakh ke upar. On first 4 lakh 4%, next 4 lakh 6%. So they have given this in question only. They have given this in question only. This is how we'll repay the principal and this is how the interest comes. This is how the interest comes. Now see, first year he repaid at the end. So can I say full 10 lakh was pending? 4 lakh ka 4% 16 and 6 lakh ka 7% 42. Now next year only 8 is pending. Next year 8 is pending. 4 lakh ka 4% 16 and another 4 lakh ka 7% is 28. Then 4 lakh is pending. Pehle 10 pending tha, fir 8, now 6 is pending. Now 6 lakh pending. 4 lakhs 4% 16 and 2 lakhs 7% is 14. So this is how they have given the table also. This is how the payments are going to come. Now if someone asks me how you are going to get money, so can I say first year I am going to get 2 lakh plus 42 plus 16. Can I say 258? Second year I'll get 2 lakh plus 28 plus 16. Third year I'll get 2 lakh plus 14 plus 16. Fourth year I'll get 2 lakh plus 16. Fifth year I'll get 2 lakh plus 8. So this is what I'll be getting discounted by a normal market rate that becomes your asset. So what you are going to get is this discount by normal market rate 843 will be the loan in your books. The loan in your books will not be 10 lakh, 843. An extra is treated as a prepaid salary. So loan to employee 843, to cash is 10 lakh, prepaid salary is 156. Prepaid salary is 156, clear? Now going to the prepayment. Check what happened. This is how you are supposed to give. But he prepays 2 lakh on 31st December 02. Okay, 31st December 02, he prepays 2 lakh. Okay, can I say at this stage, yahan pe? Okay, so normal 2 lakh plus interest he paid. Every year he was paying 2 lakh plus interest. He paid extra 2 lakh in December 02. So actually December 02 mein, this interest 2816 he paid. Instead of principal 2 lakh, he paid 4 lakh principal. Instead of principal 2 lakh, he paid 4 lakh. So now principal 2 gone, 4 gone. Now principal remaining is only 4. 2 and 4, 6 gone. 4 hi bacha. 4 bacha. Now we will pay next time 2 lakh plus interest, next time 2 lakh plus interest. So instead of 5 years, the total term is now reduced to 4 years. Okay, now question. How to account for that prepayment of 2 lakh? How to account for prepayment of 2 lakh? Day one when I gave him 10 lakh. Can I say something was towards loan and something was prepaid salary? Day one when I give him, something was loan, something was prepaid salary. So now if he's giving me back 2 lakh, again I have to bifurcate. So out of that 2 lakh which I am receiving, how much is towards loan and how much is towards the prepaid salary? Now sir, loan kaise find karo? Do one thing. After he prepays this, can I say now this much is pending? After he prepays, next 2 years mein, 2 lakh plus 16, 216 and 2 lakh plus 8, 2 lakh 8,000. So 216 and 28 are pending. 216 and 28 are pending. Do one thing. Find out the present value. New rate is not given. Take the old one. New rate is not there. The old one only. So now next year 216. Uske baad 208. Next year 216. Uske baad 208. Next year is 216. Uske baad 208. So present value is 358. Okay. So now can I say liability should be 358? I'm going to get that in next 2 years. If I'm going to get that in next 2 years, uska present value should be the liability in books. So liability should be 358. Acha, before prepayment, what was the liability? Let's see. Your table is there. We start with 843. At December 2, it was 525. It was 525. See, you started loan with 843. Interest accrued, we received something. Again, interest accrued, we received normal. Ignore the prepayment. Ignoring prepayment, can I say liability was 525? So after that 2 years, liability was 525. Now, what should be the liability after prepayment? Prepayment kar diya, the next 2 years, whatever I'll be receiving, uska present value. Not liability, word should be asset. Correct. Not liability, the word should be asset. Loan given hai na. So asset is 525. Asset is 525 loan. What should be the loan after prepayment? Prepayment ke baad 2 more installments are pending. The present value of 2 installments. So it is 525. It should be 358. So it is 525. It should be 358. So bring it to 358. So 166 which we have received is for the loan. I repeat, 166 which we have received is for what? Loan. So for loan, I have got 166 and out of 2 lakh, 166 is for loan. Can I say balance is for that prepaid salary? Did you understood? So loan in your books today is 525. After prepayment, what should be the loan? Prepayment kar dega, uske baad the loan should be 358 because whatever is pending, uska present value. Whatever is pending, uska present value. The loan should be 358. It is 525. The 166 is received for loan and the balance amount out of 2 lakh is received for prepaid salary. So check cash 2 lakh. To loan is 166 and balance is for prepaid salary. Balance is for prepaid salary. Now can I say loan balance changed? Now interest will accrue, we receive something. Again interest will accrue, we receive something, it will get 0. We brought it to that 3,58,000. Now in your prepaid salary, can I say prepaid salary may we were transferring to P&L, we transferred first year, second year, and now balance was there, and now some adjustment comes. After adjustments, now the remaining amount is to be transferred over the remaining 2 years. Now not remaining 3, because third year mein it becomes nil na everything. So 2002 mein he repaid, prepaid, and then 3, 4, 5 wala installment is gone na. So now the prepaid salary is to be written off over the remaining 2 years. Any doubts? Anybody with this? Very, very important question. Very, very important question. Okay, going ahead. This is done. Now we are done with financial asset. Now we go to financial liability. Financial liabilities are always measured at which value? Fair value. Okay, now question from Ujjwal. Sir, which discount rate do we use for prepayment? Current rate or old rate? Ujjwal, if you just see this question, in this question they have not given only the new rate. We don't have the new rate. That's why basically यहाँ पे old rate is continued. Otherwise, sir, which rate to be taken? So what should be the liability now? I can take it based on the current rate also. So current rate लेके this should be the liability. Current rate लेके remaining 2 years है, not liability, remaining 2 years है, उसका present value, this should be the asset right now. So you can take current rate if it is given. Okay, Ujjwal. Now, financial liabilities. Financial liabilities are measured at which value? Fair value. Subsequently, only 2 options, either amortized cost or FVT P&L. There is no FVT OCI. Remember, in your financial liability, there is no FVT OCI except there is a financial liability designated as FVT P&L and the change comes due to own credit risk. याद आया? That's it. ठीक है. So either amortized cost में interest accrues, we pay something, closing. Interest accrues, we pay something, closing. And second is P&L. P&L कब लेंगे? When it's held for trading, or there's some accounting mismatch, or there's a contingent consideration and a business combination. Business combination में we record contingent consideration equation date fair value. We record it actual, and then उसको remeasure करेंगे. The difference goes in P&L, all that things. Now, how do we account for a financial guarantee? This is important. How do we account for a financial guarantee? Now tell me, if I give guarantee for someone, should I give it for free? अगर मैं किसी को guarantee दे रहा हूँ, I give a guarantee for someone, should I give it for free? नहीं. I should charge for that guarantee, na? Guarantee commission. We charge the guarantee commission. So what happens over here is, we charge the bank debit to financial guarantee. Bank debit to financial guarantee. It should be taken to P&L over the life of guarantee. If guarantee is for 3 years, this income is also for 3 years. It should go to P&L over a period of 3 years. If you are not charged, that's your problem. तो करना चाहिए था बैंक टू फाइनेंशियल गारंटी. अगर आप चार्ज नहीं कर रहे हो, then it will be P&L to financial guarantee. तो आपने चार्ज नहीं किया, that's your lookout, that's your loss. P&L to financial guarantee, and financial guarantee will also go to P&L over a period of the guarantee, whatever is the guarantee period. ठीक है, the bank to financial guarantee should go to P&L over the life of guarantee. Subsequently, so this financial guarantee is there. This financial guarantee is a liability. It's kind of income received in advance. This is an income received in advance wala thing. It's a liability. If it is measured at FVT P&L, fine. So if a financial guarantee is designated as FVT P&L, the difference in fair value will go in P&L. But if it is not designated as P&L, FVT P&L, so what will happen? If it is not designated as FVT P&L, so kind of what to do? So now, what should be the closing guarantee amount? First year end, second year end, third year end. What should be the closing guarantee amount? So out of that guarantee, something would have gone in P&L. Balance. So balance of guarantee or the loss expected because of guarantee, whichever is higher. So subsequently it is measured at higher of the loss which we are expecting or the amount initially recognized less whatever we have transferred to P&L, the balance. Imagine I gave a guarantee for someone, fair value is 90 rupees. I gave a guarantee for someone, fair value 90, to bank financial guarantee 90. 90 will go to P&L over 3 years. So when I say first year 30 gone, so now guarantee should remain 60. 30 gone, 60. But if I expect a loss of 500 coming, because of that guarantee 500 loss will come, then you show the liability not at 60, then you show the liability at 500. So it is higher off the loss allowance which you are expecting or the balance what should remain in that financial guarantee, whichever is higher. Okay, now check this question. You gave a guaranteed 10 lakh loan of a subsidiary. Subsidiary ka 10 lakh tha. Loan you gave a guarantee. And because of it, the bank charged 8%. If guarantee was not given, bank would have charged 11%. Okay, you gave a guarantee, bank charged 8% interest. If you had not given guarantee, bank would have charged how many percent interest? 11. So can I say because of your guarantee, they are having 3% lesser interest? So I can find the fair value like that. Okay, so now 3 years, hai na? Okay, so normally interest would have been 80,000. 10 lakh ka 8%. 80,000. This is what they are paying. If guarantee was not given, can I say interest would have been 110? The interest would have been 110, but now they're having 80. So can I say savings in interest is every year 30, 30, 30? So uska present value is the fair value of guarantee. So savings in interest is 30, 30, 30. Uska present value at 11%, the normal rate. So fair value of guarantee on day one is 73320. Did you understand? Because of guarantee, benefit is 30, 30, 30. Uska present value. That's the fair value of guarantee day one. So fair value of guarantee, I should have charged, but I'm not charging. It's my subsidiary. Treat it as an investment in subsidiary. The investment in subsidiary debit to financial guarantee. And can I say financial guarantee will go to P&L over 3 years? Financial guarantee will go to P&L over 3 years. Now, normally what I explained you was simple. 73320 divided by 3. Divided by 3 mat karo. ICA doesn't do that. Don't do divided by 3. So how it will go? To pay attention. 73320, uspe interest accrues, 30 goes in P&L. It's kind of interest accrues, 30 goes in P&L that way. Entry is not real mein interest accrues. Because real mein this is not a loan. But they are telling like on 73320 interest accrues 30 received closing. Interest accrued 30 paid closing. Interest accrued 30 paid closing. ठीक है? So if I ask you what should be the liability at the end of first year? If I ask you what should be the liability at the end of first year, can I say it is 51385? Interest accrued, we received 30 and closing. Interest accrued, we received 30 and closing. That way they are doing it. So don't do 73320 divided by 3 mat karna. Don't do that way. Follow what ICI is doing. So 51,385 should be the liability, or if loss expected is more, can I say dono mein se whichever is higher? Now let's see how much is loss expected in first year end. There's a probability of 1% default. Okay, 10 lakh ka 1%. Can I say 10,000? 10 lakh ka 1%, 10,000. Okay, so liability should be 51,000 or 10,000, whichever is higher. So liability should be 51. Okay, if I ask you what is the liability in your books on day one? Day one is 73, bring it to 51. तो interest accrued we received उसका कोई entry नहीं है, वो notional दिखा रहे हैं. So now 73 I have to bring it to 51. That much you take it in P&L. The financial guarantee debit to P&L is this. Did you understand? 73 becoming 51, ये 22 हो गया. 219 is kind of 22. Now coming to second year. Now second year end, can I say guarantee should be 27,000? Balance liability. Balance should be 27, or the loss, let's see the loss now. Second year, now there's a 3% probability. So 10 lakhs, 3% is what? 30,000. So it should be 30,000 or 27,000, whichever is higher. So can I say now the guarantee should be 30,000? Now guarantee should be 30. Okay, after first year, guarantee was 51385. It was 51385. Should I bring it to 27? No. 51385, you bring it to how much? 51385, you bring it to 30,000. So 21935 will come. 51385, you bring it to 30. So 21385, not 985, 21385 will come up. Did you understood? 51,385 I have to bring to 30 now. So it is 21385 goes to P&L. Any doubts? Okay, going to the next question which is there. This is a simpler one. Fine. This is just a bifurcation. Okay, uske baad wala question. This was already done in our IND AS 21. IND AS 21 mein. Okay, now Ujjwal has a question, how we record the financial guarantee given? Do we also record the financial guarantee third party has given us? Okay, someone gave a guarantee for our loan. Dear, if someone gives a guarantee for your loan, it is treated as a part of transaction charges. Loan lene ke liye, you have to get a guarantee from someone. It's a transaction charges deducted from that loan. And automatically effective interest rate goes up. Are you clear, Ujjwal? So there's a difference between I give a guarantee and I get a guarantee. Okay, next is, this question was done under your IND AS 21. I'm not doing again. So we invested in a bond pay interest accrued, we received closing, and closing was fair value. The same question, same figure was done yesterday. This is to be done on your own. And the next point is loan between group companies. Loan between the group companies. ठीक है. Parent giving loan to subsidiary. Parent giving loan to subsidiary. Now suppose the loan is repayable on demand. I gave a loan of 10 lakh, repayable on demand. Okay, it's an interest-free loan, first of all. Interest I'm not charging, but it's repayable on demand. So can I say I can demand tomorrow also? I can demand in 1 week also. I can demand in 1 month also. So now the fair value of loan is assumed to be at least equal to the loan amount. So loan amount 10 lakh hai. If it is repayable on demand, the fair value is also 10 lakh. If loan is 10 lakh, if it is repayable on demand, then in that case, uska fair value is also 10 lakh. So day one, you recorded 10 lakh only. Okay. Second, assume, I'm just taking one more example, fixed maturity 3 years. Okay. So interest free loan I have given for 3 years. Fixed maturity. Yahan pe likha hai no fixed. I'll come to this. Suppose there's a fixed maturity, how much? 3 years. So pehle wale mein repayable on demand. I can demand tomorrow also. So fair value is assumed to be equal to whatever is the loan amount. So 10 lakh only. But suppose 3 years. Suppose they say 3 years, yahan pe we are giving an interest free. So can I say now the fair value of loan is the present value? I will get back 10 lakh only after 3 years. The present value of 10 lakh is the loan amount. Remaining will be treated as investment in subsidiary. Did you understood? Remaining will be treated as investment in subsidiary. Acha. Now, if at all they can repay whenever they want. Acha, they can repay whenever they want, then I have to expect when they will repay. And if I feel they'll repay after 5 years, so they'll repay after 5 years 10 lakh. So 10 lakh 5 years ke baad I'll get the present value is the asset in the book, remaining is investment in subsidiary. So whenever I want, I can get the money, fair value is 10 lakh. If they'll give me after 3 years, the fair value is present value of 10 lakh, which will come after 3 years. If they can repay whenever they want, I have to expect when they will repay. And if I'm expecting they'll repay after 5 years, the fair value is the present value of 10 lakh coming after 5 years. TK, check this question number 9. Interest-free loan is 10 lakh. If it is repayable on demand, the fair value is also 10 lakh. If it is repayable after 3 years, the fair value is 10 lakh, receivable after 3 years at normal market rate 810. The loan will be 810, remaining will appear as investment in subsidiary. And third, they can repay whenever they want. So I have to assume, I have to expect when they will repay. And if I expect they'll repay after 5 years, so loan in your book will be the present value of amount coming after 5 years. So accounting is same as the second one. Are you clear with this? Next is impairment of financial asset. Okay, you have a financial asset. You need to test the financial asset for impairment except it is fair valued through P&L. Except it is fair valued through P&L, so already done. So there is no impairment testing required. The impairment of financial asset. Now the thing is, there are some contractual cash flows which are due. जो due हुआ है, that's an asset. जो due हो गया, that's an asset. The contractual cash flows due, but the cash flows which I'm expecting to receive, I expect to receive less, then the difference becomes the impairment loss. Due is 100, but I'm expecting to receive only 80, 20 rupees impairment loss. So I have to book that 20 rupee loss. ठीक है. Now how to find out that impairment loss ka amount. How to find out impairment loss amount. There are two words, 12-month, pay attention, 12-month ECL, lifetime ECL. ECL is expected credit loss. What is ECL? Expected credit loss. Now what is 12-month ECL? 12-month ECL is, we just consider the probability of default in next 12 months. We just consider the probability of default in next 12 months. If default happens in next 12 months, what will be the loss coming? That's 12 months ECL. But under lifetime ECL, we consider the probability of default over a lifetime. We consider a probability of default over a lifetime. Lifetime mein whenever he will default, okay, what will be the loss coming? So 12-month ECL mein the probability of default is considered only for the next 12 months. Based on that, the provision is, this impairment loss is found. Under lifetime ECL, the probability of loss over the lifetime is considered. Okay, so can I say in lifetime ECL, the impairment loss will come more? In 12-month ECL, it will be less. So sir, which one to use when? If it is a trade receivable, lease receivable or a contract asset, use lifetime ECL. Trade receivable, lease receivable, contract asset, so it is a lifetime ECL. Okay, if it is not this, other asset. But if there is a significant increase in credit risk, again use lifetime ECL. But if there is no significant increase in credit risk, then you can use the 12-month ECL. If it is not a trade receivable, lease receivable, contract asset, and there is no significant increase in credit risk, then you use 12-month ECL. Otherwise, you have to use lifetime ECL. And sir, what is a significant increase in credit risk? I told you, if it is overdue for more than 90 days. So not 90 days, 30 days. If something is overdue for more than 30 days, it is always treated as significant increase in credit risk unless opposite can be proved. Now, pay attention. See, there are some assets which do not have a significant increase in credit risk. There are some assets which have a significant increase in credit risk. And there are some assets where there is an objective evidence of impairment. Remember credit impaired? Credit impaired was the word which was written. So one, where there is no significant increase in credit. Second, there is a significant increase in credit. Third, objective evidence of impairment. Now, the thing is, if these are my assets, imagine it was investment in bonds, investment in debentures, they are also my asset. So now us pe interest accrues. So someone asked me that, sir, out of 100, if we have done a provision for 20, impairment loss 20 recorded, so can I say now asset is 80? Out of 100, impairment loss 20 recorded, 80 asset. So should now interest be accrued on 80? Should now interest be accrued on 80? Okay, if there was no increase in credit risk, interest will accrue on gross basis. Interest revenue will be on gross basis. If there is a significant increase in credit risk, still gross basis. But if it is credit impaired, then the interest will be on net basis. So if there is no significant increase in credit risk, or if there is a significant increase in credit risk also, gross basis, if there is objective evidence of impairment, then it will be on net basis. Okay, this is done, this is done. Now there's one more thing given. Whenever you are trying to find out the expected credit loss, you have to have an unbiased approach, probability weighted amount. Unbiased approach, probability weighted amount, plus you try to see the time value of money, and you should have a reasonable supportable information. You should have a reasonable supportable information based on which you are making provision, but that information should be available without undue cost. See, I want to make provision for debtor. So don't appoint a detective to really understand how debtor is doing. So I appointed thousands of detectives to understand each of my debtor how they are doing. No. That way you cannot do it. It should be without undue cost. The information should be available. So that detail may you no need to go. Fine. There are practical expedient. Practical expedient, you may use a kind of provision matrix. What is a provision matrix? Aging wala. If debtor is more than this much old, I'll make this much provision. Debtor is more than this much old, this much provision. The practical expedient they have allowed you. Example is provision matrix. Okay. Now, there's a question over here. Due to COVID, yaad hai? Bank has given a loan to you. Bank has given a loan to you, so it is an asset for a bank. Now, moratorium was given. Moratorium was given. If moratorium was given, so can I say all loans became overdue for more than 30 days? Or 6 months moratorium tha. It became overdue for more than 30 days. So does it mean that all have a significant increase in credit risk? No. I told you that significant increase is 30 days, but you also have to see contrary can be proved or not. But यहाँ पे everybody was given moratorium on a general basis. So don't take everyone under significant increase in credit risk. Next, this is fine. This is a very simple matrix wala thing. This is also fine. Achha. Now this question, you have lent 2 crore to your supplier. You have lent 2 crore to your supplier. It's a loan given to you. And the loan cost is 10 lakh. Okay, the 2 crore I gave. 2 crore I gave, and the cost of basically this asset was 10. So can I say now asset basically appears at 2.10 in our books, and I'm going to get back is 2.4 in March 19, and the effective interest rate is 6.9. So in my book the loan on day 1 is 210. First year 6.9% interest is accrued. So after first year end 210 tha plus 6.9%. After first year end the loan will become 224.49. So pehle din fair value is this, first day year interest accrued. Now the carrying amount is 224. They are going to pay after 2 years. We gave in 17, they will pay in 19. So 18 May first year and interest accrued. We have not received anything. Interest will come next future May they are going to pay. Now what happened? February 18, there is some information that there is a poor condition of supplier. Supplier condition is poor. And now we feel he will be able to pay next year only 2.2. If he will be able to pay next year 2.2, so can I say I'll get 2.2? What is the present value of 2.2 today? I'll be getting 2.2 next year. I'll be getting 2.2 next year. Uska today's value is 209. Not 209, 205. So in my book, asset is 224, but I'll be able to get is only 205. Remaining is nothing but your impairment loss. First year end in your books 210 plus interest accrued, this is a value. Now we expect 220 only will come after 2 years. So now first year is already over. Next year we are expecting 220. So uska present value is 205. So today the asset has to be 205. We are having asset is 224. There is an impairment loss. Then next unit. Next unit, unit number 4. Come on. We'll finish off everything by 9:30. Yes, Bharat, impairment loss we recognized on asset. The asset was 224, we have to bring it to 205. and that loss impairment wala will go in P&L. Okay, now next one is recognition, derecognition of financial instrument. Recognition, so when I should, see, we saw what value, now comes when I should record the financial asset, when I should record financial liability, and when I should remove them. Okay, so we should record the financial asset, financial liability when and only when we become a party to the contractual provision. When and only when we become party to contractual provision. Now, there's a topic called as regular way purchase sale. What is a regular way purchase sale? You're purchasing, selling a financial asset under a contract where the delivery is within a time frame as decided by regulation or contract. You're buying a financial asset where the delivery will come under some time frame established by the regulation. For example, if I buy the shares from market, stock exchange, okay, would the shares come in my demat account same day? If I buy shares from the stock exchange, would the shares come in my demat account on same day? No, we have a T+2 system. What is a T+2? Transaction plus 2 days. If you buy a share today on Monday, Wednesday evening they come in your demat account. Wednesday evening they'll be coming in our demat account. So now, sir, how do we account? Do we record investments today, or do we record when it comes in my demat account after 2 days? Do I record investment in my book today only? Do I record when it comes in my demat account after 2 days? There are two options. One is called as a trade date accounting. Second is called as a settlement date accounting. Whichever you want, you can follow. It's up to you. Now check this example. We enter into a contract to purchase financial asset for 10 lakh, which is the fair value on trade date. So trade date ka fair value is 10 lakh. ठीक है. So if I am following a trade date accounting, can I say day 1? If you remember day 1, the assets come at fair value. It will be recorded at 10 lakh. Financial asset debit 2. You are liable to pay them. You also have to pay after 2 days. So financial asset debit 2, liability. ठीक है. Whether the asset is carried at amortized cost, FVT, P&L, FVT, OCI, day 1 it will come same. If it is amortized cost, we don't have to see the fair value changes. But imagine on 4th settlement date, the fair value is 10.5. If it is FVT, P&L, the investment will go up and the fair value difference I'll take in P&L. If it is FVT, OCI, investment will go up and the fair value change I'll take it in OCI. Did you understand? Amortized cost mein the fair value changes are not taken. So first we recorded fair value on the date of transaction, day 1 ko, and then under FVT P&L fair value change went in P&L, under FVT OCI fair value change went in OCI, and now 4th ko we are paying that 10 lakh rupee liability to cash. This is fine. But now if you are following a settlement date accounting, what is the settlement date? 4th. So directly entry will come on 4th. And if entry comes on 4th, someone asked me that, sir, should we record at the fair value on 4th? So your financial assets are to be recognized at fair value. Correct. You should record at fair value on 4th. But if it was to be carried at amortized cost, then in that case, you continue with the value, fair value of trade date only. Check above, one line is given. Check above, when settlement accounting is applied and it is carried at amortized cost, the change in fair value is not recognized. So can I say I'll continue still at 10 lakh? So under your settlement date accounting, if it is amortized cost, the change in fair value is not considered. So you record directly on 4th, but you will record financial asset to bank 10 lakh. But only under amortized cost, the fair value was not considered. Under FVT OCI, FVT P&L, you will directly record 1050 today. You are paying 10, and extra 50 will go in P&L or OCI. You will directly record at 1050. पहले क्या था, we recorded at 10 and then we did a fair value change 50. यहाँ पे we record at 1050 directly on 4th. 10 we are paying, 50 goes to P&L or OCI. And amortized cost pay, the fair value changes are not considered even under settlement accounting. So don't record at 1050, record at 10 only. So both method will give you same answer. Next is derecognition of financial asset. Tell me, when should I remove the financial asset from book? कब remove कर देंगे? When the contractual right to the cash flow expires or you have transferred the financial asset. The contractual right to the cash flow is over. I was to get interest only for 5 years. Interest accrued, we received, interest accrued, we received, interest accrued, we received, interest accrued, we received. Now asset has to go away. We received all money. Or second, we have sold off the asset to someone, we transferred it. Any of them can be taken. When do I say it is transferred? When do I say it is retained? That's not relevant from exam purpose. Leave it. Now, what is the accounting treatment for transfer? So whenever you transferred, so can I say that asset is gone? Profit, loss, gain, loss on transfer will always go in P&L. I repeat, gain, loss on transfer of financial asset will go in P&L, even if it was carried at FVTOCI. Even if it was carried at FVTOCI, settlement gain loss will go in P&L. The difference between carrying amount and consideration received goes in P&L even if it was carried at FVTOCI. Even if it was carried at FVTOCI, it will settlement gain loss goes in P&L. Achha, settlement gain loss went in P&L. Now one more thing. If it was equity instrument through OCI, so can I say earlier we were fair valuing every year? If it was equity instrument through OCI, earlier we were fair valuing every year. Individual effect, yearly impact came in OCI. Accumulated impact would have been lying where? Accumulated impact would have been lying where? Other equity. Now if that equity shares are sold off, so can I say that accumulated impact I need to remove from there? If it is item reclassified to P&L, take it in P&L. If it's item not reclassified to P&L, it will go directly in retained earnings. Clear? Okay. Now we have a debt instrument, fair value is 1000. It gives interest 5%. Effective interest rate is also 5%. 5% accrue, we receive 5%. 5% accrued, we receive 5%. So again, value will remain 1000 only. 1000 tha, 50 accrued, we received 50. The same. Fine. Now the fair value at the end is 950. Okay, fair value at the end is 950. And there's also some significant increase in credit risk. 12-month ECL is 30. So my question is, if this is an item which is FVTOCI, my question over here is, first do we do impairment testing or first do we do fair value? First do we do impairment testing or first is fair value? First is always impairment testing. The impairment testing, you book a loss of 30. Now asset became 970. And upon fair valuation, 970 became 950, then extra 20 will be recorded. The impairment goes in P&L, and then the fair valuation, it's FVTOCI, it will go in OCI. And to your investment is 50 rupees. The first impairment, then your fair valuation. Next, transfer which do not qualify for recognition is fine. Acha, iske andar. This is as such not relevant. Leave it. Chalo, I'll move ahead. Derecognition of financial liability. Yahan pe this is important. There's one good topic over here. Derecognition of financial liability. Okay, when I should remove the liability from books? Only when it is extinguished. When I should remove from liability from books? When it is extinguished. Okay, so if liability is extinguished, liability goes away, we paid something, difference will go in P&L. Liability goes away, we paid something, difference will go in P&L. Now, next point. If there is an exchange between between an existing borrower and lender of a debt instrument with another one. So, this debentures are gone, new debentures came in. So, can I say it's an exchange between existing borrower lender of the debt instrument, or this loan gone, new loan came in? So if it is like that, but they are with substantially different terms. So this loan gone, new loan came. So how do I account? Terms have changed. Terms have changed. So now two options. Either there will be extinguishment accounting or there will be modification accounting. क्या होगा? या तो extinguishment या तो modification. Now sir, which one to follow when? Which one to follow when? For that we have 10% test. Which test? For that we have 10% test. If the terms are substantially different, then we follow extinguishment test, extinguishment accounting. But if terms are not substantively different, then we follow modification accounting. So if at all 10% test is met, extinguishment accounting, 10% test not met, modification accounting. Now what will happen if it's extinguishment accounting? If it's extinguishment accounting, old liability completely goes away, new liability comes in. That's extinguishment. Old goes away, new comes in. Okay, if it's a modification, if the 10% test is not fulfilled, we account it like just a modification. So then in that case, liability 100, we have to make 110. So we just increase by 10. 100 था, उसको 15 करना है, तो increase by 5. Increase by just 5. उसमें क्या था? Old liability 100 goes, new one will come in. Extinguishment में old goes away, new comes in. Modification में just the change is recognized. Just the change is recognized. Did you understand? Now, so whether it's extinguishment accounting, whether it's a modification, depends on whether the terms have substantially changed or not. Whether the terms have substantially changed or not, it depends on 10% test. If 10% test is met, extinguishment accounting. If 10% test is not met, then modification accounting. Now, sir, how to do 10% test? So what do you do is, you have the liability in your books as per the original terms. You have the liability in your books as per the original terms. Now, you find out the liability as per the new terms, including any fee to be paid, वो सब ले लेना. So you find out the liability as per the new terms with the original discount rate. Okay, so you already have a liability in your books. ठीक है. Now terms are changed. You find the new liability based on original discount rate, but you also consider the fees to be paid, etc., all that things. And now the old liability and the new liability figure which you found, if the difference is 10% or more, then 10% test is fulfilled. Did you understood? So for 10% test, the new liability should be found out using which discount rate? The original one. And for doing 10% test, the expense relating to this term changing expenses, they are also considered over there. So if we already have a liability, now based on new terms, you find out a new liability, but based on original discount rate. And also consider the expense related to that term changing in that thing. And now the new liability comes. If old and new liability ka difference is 10% or more, 10% test is met. Okay, if 10% test is met, we follow which accounting? Extinguishment. Extinguishment mein old liability goes, new will come in, but new liability coming in will be at fair value. Fair value will be based on the new discount rate. So for doing 10% test, we use the old discount rate. For doing 10% test, the liability was found using old discount rate. But when we are actually accounting, old liability goes, new liability comes at fair value. This will be based on the new discount rate and the expense will go in P&L. So for 10% test, expense was considered while finding liability. But if 10% test is met, for doing 10% test, expense were considered there. But if 10% test is met under extinguishment accounting, the expense will go in P&L. So check. So if 10% test is passed, extinguishment accounting, old liability goes away, new one will come at fair value. Fair value is based on today's market rate. This today's market rate. Expense will go in P&L. Any incremental cost of fees goes in P&L, and whatever is the difference coming old and new liability mein, the difference will also go in P&L, and now we have to calculate a new effective interest rate for the new liability. Did you understood? Okay, again I'm telling, if the terms are changed, so I need to see substantial change or not. Whether it's substantial or not, 10% test. For doing 10% test, you have a liability in book. Based on new terms, find a new liability using old rate. And expense are also included in liability. Okay? And then you see if the difference between old and new liability is 10% or more, extinguishment accounting. If the 10% is fulfilled, extinguishment accounting. Extinguishment accounting, old liability goes away. Old liability debit. New liability comes in, new liability credit. But new liability will be based on the fair value, based on new discount rate. So 10% test ke liye old rate, but while accounting, they will come based on new rate. Okay, this is gain loss on derecognition. Transaction cost goes to P&L. Okay, now if 10% test is not met, example you can just see on your own, that's fine. If 10% test is not met, we follow modification accounting. 10% test failed. If 10% test is not met, we follow what? Modification accounting. So modification accounting mein what do I do? So first the 10% test, how to do we already seen. Now in modification accounting, they have given you two options. In modification accounting, they have given you two options. What two options? The liability you have in your book, new liability as per original terms, new liability at original rate, new liability at original discount rate, you find out. New liability at original discount rate, ignore fees, fees will go in P&L. Fees will go in P&L. For 10% test, fees was considered while finding liability. Yahan pe, if modification accounting is done, old liability, okay, new liability, new terms, but old rate wala, old discount rate wala, the difference between two will go in P&L, and the transaction cost will also go in P&L. Or second option is very simple. What does second option say? Whatever you are paying for change in terms, you paid 10,000 for change in terms, entry, liability to bank. You paid 10,000 for change in terms, liability to bank, and now find a new EIR. Simple. You paid 10,000 for change in terms, liability to bank. Liability went down, effective interest rate will change. That's it. So one option is you find old, you find new liability based on original discount rate, difference you take it in basically P&L. The difference loss on modification went in P&L, and the expense also goes in P&L. Second was very simple. For modification I paid 50, liability to bank 50, finished. Kuch nahi karna, liability to bank 50, and now you just find out new EIR. This is basically the thing. Now debt for equity swap. Debt for equity swap. Many time you might have seen that for a liability you give your equity shares. To settle a liability, what are you giving? Equity. That's called debt for equity swap. In that case, the equity should be recognized at the fair value of equity. Equity should be recognized at which value? Fair value. So equity is at fair value of equity, liability goes away, difference will go in P&L. Okay, check over here. 90 crore liability, 2/3 liability goes away, and we are giving shares. Okay, the 2/3 liability goes away, 60 liability goes away, shares are coming up 70%. Our net assets are 80, so 80 into 70%. Can I say shares ka fair value is 56? So liability goes away 60. Liability goes away 60, shares comes at 56, 4 rupee will be the gain in P&L. Did you understand? 4 will be the gain in P&L. Now there's one more question. For 1/3 debt, what happened? Bank agreed for moratorium and decrease in interest rate. Can I say this 1/3 way terms are changed? For 1/3 May, the terms are changed. So I need to see modification accounting or extinguishment accounting. The present value of cash flow as per the original EIR is 25. Okay, original EIR say now the cash flow is 25. So for 10% test, I had to use the original EIR. वो 25 ये 30, liability 1/3 is 30, books में 30, for 10% test I calculated 25, तो difference is more than 10%. If difference is more than 10%, extinguishment accounting, old liability 30 goes away, new liability will come in at fair value. The fair value of new liability is 28. The old liability 30 goes, new 28 comes, 2 will go in SOPL. So there are two things over here, debt for equity bhi tha, and there was a basically change in terms also for the remaining 1/3. Done. This unit, come to the last unit of chapter number 12. Come to the last unit of your chapter number 12. Derivative, embedded derivative. Okay, first of all, what do you mean by the word derivative? What do you mean by the word derivative? Derivative is a financial instrument which meets all the following condition. All the following. Uska value is derived from somewhere. Value is derived from somewhere. Like suppose option. If I give you ESOPs, so can I say option ka value will depend on share price? If share goes up, up. If share price goes up, तो ऑप्शन का भी आपके राइट का भी वैल्यू विल गो अप. इमेजिन यू हैव अ राइट टू बाय 20 रुपी, मार्केट में रेट इज 100 गोइंग ऑन, यू हैव अ राइट टू बाय 20, तो कहने से राइट इज वर्थ 80 रुपी. बट इफ मार्केट में शेयर प्राइस गोज अप, योर राइट का वैल्यू विल आल्सो गो अप. तो द थिंग इज द वैल्यू चेंजेस इन रिस्पॉन्स टू अ स्पेसिफाइड वेरिएबल. सेकंड, इट रिक्वायर्स नो और लिटिल इनिशियल इन्वेस्टमेंट and it will be settled at future date. Okay, and it will be settled at future date. Suppose I enter into a contract to buy shares from you in future. I enter into a contract, forward contract, to buy shares from you in future. Forward. Did I pay anything right now? No. No. Okay. It is settled in future? Yes. And the value will depend on, if share price goes up, it is beneficial. Share price goes down, it will be loss. The value will depend on the value of shares. So that forward contract, future contract, swaps, they all come under your actually derivative. Now, whether it's a derivative or not, that is not the relevant thing for exam purpose. Just go down, coming to the word embedded derivative. Just go down, coming to the word embedded derivative. So for derivative, three criteria. Value depends on some underlying asset. Second, it requires little or no initial investment. Or third one, it will be settled in future date. All three has to be satisfied. Now, embedded derivative. Embedded derivative is, there is a non-derivative host contract. There is a non-derivative host contract. Imagine debentures. You got full money, you issued debenture. You got full money, you issued debenture, or you paid full money, you bought debenture. So can I say it requires full investment? It requires full investment. So debentures, when I issue, they are not derivative because we have got the money. So criteria, little or no initial investment, that is not fulfilled. That is not fulfilled. So it is actually a non-derivative. But uske andar one derivative is added. Imagine convertible debenture. If I add a conversion option in the debenture, can I say now the value of debenture will fluctuate based on the price of shares? Share price goes up, ye debenture ka value will also go up. Share price goes down, this debenture ka value will also go down. So it was a non-derivative host instrument in that the derivative feature was added. That's called embedded derivative. So now question comes, should I account for that host instrument and the derivative feature separately? तो क्या मुझे दोनों को अलग करके account करना है? So should I separate that component? The embedded derivative is a component of a hybrid contract in which you have a non-derivative host and some cash flows of the combined instrument vary in a way like a derivative. In a way like a derivative. So now whether derivative should be separated or not, I have to see certain criteria. Okay, first, if economic characteristics and risk of the host instrument and the derivative instruments are different. Economic characteristic and risk of host instrument and your derivative instrument are different, then you should segregate it. Now tell me, normal debenture में risk is pretty less, but when it is a convertible one, can I say risk will become very high? Share price going up and down, value will go up and down. तो यहाँ पे better is to segregate. Second, if there can be a similar thing which can be a separate derivative also. So there can be a separate derivative contract just to have option to buy shares in future. Can that be a separate derivative contract altogether? Yeah. So we can have a forward contract wherein you just have a right to buy the shares in future. And third, I have to see whether the hybrid contract is measured at FVTPNL. See, if the hybrid contract is measured at FVTPNL, no need to segregate. Why no need to segregate? Because if hybrid contract is measured at FVTPNL and you segregate, the host will be FVTPNL and derivative is anyways FVTPNL. Derivatives are always FVTPNL. तो अगर मैंने combined को FVTPNL किया है, then it's fine. But imagine if host is FVTOCI. If host is FVTOCI, so now the thing is combined is FVTOCI will be wrong. Combined FVTOCI will be wrong because host will go in FVTOCI, derivative will go in FVTPNL. But if combined is already FVTPNL, no need to segregate. Okay, so when do I need to segregate the derivative element in case of embedded derivative? The risk and economic characteristic of host and the derivative wala portion is different. Second, such a thing can be basically a separate altogether a financial instrument also. And third, if at all I have to see is if the combined instrument is FVTPNL, no need to segregate. If a combined instrument is FVTPNL, no need to segregate. It's not like all three criteria to be fulfilled. If risk and economic characteristic are different, oh, segregate kar lo. Don't see other things. But if it is everything FVTPNL, no need to segregate. So see the things and then you decide. So step 1, whether it is hybrid instrument is FVTPNL, yes, no need to segregate. Step 2, whether such type of thing can be a separate financial instrument, yes, then you go to step 3. And step 3, does it have a separate characteristic? Yes. Does it have a separate characteristic? Yes. So you segregate. यहाँ पे they've written, do have characteristic which are same as host. If they have a characteristic same as host, no need to segregate. So this is okay, not much relevant exam angle. Coming directly to prepaid option in debt instrument. यहाँ पे sums are important. This theory is okay. Now prepaid option in debt instrument. I have issued debentures. Can I say it's a debt instrument? Now I have an option to prepay the debenture whenever I want. I have option to prepay what? The debenture whenever I want. Okay, so first year end, second year end, third year end, fourth year end, fifth year end. If I want to prepay the debenture allowed. So prepayment option is a derivative feature which is added. The normal debenture, it doesn't happen. यहाँ पे prepayment option is there. So whether I should segregate and account it. So remember they told you, if at all economic characteristic and risk are closely related, no need to segregate. If economic characteristic and risk are closely related, no need to segregate. How do I understand economic characteristic and risk are closely related or not? So they are telling the carrying amount of debenture at every point of time, first year end, second year end, third year end, fourth year, and the prepayment option if you're exercising and you're paying. If that both things, the first year end ka carrying value, and if you go for prepayment, how much do you pay? If that two are kind of approximately equal, then they are closely related. तो carrying amount भी उतना ही है, payment कर रहे हो approximately equal. Approximately equal is how much they have not given. Generally 98% or more. So book में value 100 and I pay 98, 99, 100 or 101 or 102. So I can say they are closely, approximately equal. So book में value, carrying amount and how much you are paying. If they are approximately equal, then they are closely related. No need to segregate. ठीक है. Now check this question. You have option to prepay at 1st April every year. You have option to prepay 1st April every year. So do one thing first. Leave prepayment. You just find out the carrying amount of debenture every year beginning. So over here, interest is 12% and there's a bullet repayment at the end of term. Interest is 12% and bullet repayment at the end of term. Without prepayment option, the rate is 11. Okay, I am paying 12. and last May 112. Discounted by 11%. So liability becomes 104.22. So day one liability 104.22. Interest will accrue 11%. We are paying 12. Again, interest will accrue 11%. We are paying 12. Again, interest will accrue based on 11, we are paying 12. Okay, so these are the liabilities at the end of each year. First year end, second year end, third year end, fourth year end, fifth year end. Okay, these are the liabilities at the end of each year. Now, if you go for prepayment, how much you have to pay? Check. If you go for prepayment, 3% penalty. Okay, so loan is 100 plus 3. Can I say I have to pay 103? If I go for prepayment, I have to pay 103. So carrying amount first year end 103.68. So second year beginning 103.68. If I pay, I have to pay 103. Approximately equal. यहाँ पे 103.39 I have to pay 103. यहाँ पे 102.43 I have to pay 103. यहाँ पे 101.7 I have to pay 103. यहाँ पे 100.9 I have to pay 103. So difference if I see यहाँ पे 2.1% came. Each point of time, every point of time, carrying amount and what you pay, if they are approximately equal, then they are closely related. Now difference 2.1%. Chalega ki nahi? Is it closely equal or not? It's up to you. So assuming the difference of more than 2% is not approximately equal. Assuming difference of more than 2% is not approximately equal, we need to segregate the embedded derivative. Did you understood? This is the assumption. If you assume that up to 3% chalega, then no need to segregate. Now, last 2-3 questions, these are very important. Last 2-3 questions are very important. Please pay proper attention. Now, this foreign currency derivative embedded in a contract for purchase or sale of non-financial item. Okay, foreign currency derivative embedded. You have entered into a contract. Pay attention. You have entered into a contract to buy or sell non-financial item, PPE, inventory. You entered into a contract to buy or sell non-financial item at a future date. Not today. If you are buying today, so accounting is IND AS 21. If you bought PPE today in foreign currency, IND AS 21. You have a contract to buy. You have a contract to buy PPE at a future date in foreign currency. So can I say the payment which you have to do will also differ based on exchange rate going up down? So payment is not just based on the price of the item. The payment will also differ based on foreign exchange going up and down. So if, pay attention, if the PPE is purchased today, only, this standard doesn't come, IND AS 21 comes. But I have a contract to buy PPE in future in foreign currency, then this comes up. So now in that contract, certain value will depend on foreign currency going up and down. Okay, so normally the price of PPE depends on price going up and down. But yahan pe it will also depend on exchange rate going up and down. Two things are there. The amount to be received or paid will depend on the exchange rate at the future. So now, how do I account for this? So you assume there are two separate contracts. ये assume करना है, real में नहीं है, assume करना है. ठीक है, imagine you have to purchase PPE in foreign currency. आपको क्या करना था? There is a contract to buy PPE in foreign currency. ठीक है? How do I account? One, assume It is contract to buy PP in INR. Assume it is contract to buy PPE in INR. So PP will come in, INR goes out, correct? But tell me, really, do you have to give INR or do you have to give dollars? Really, do you have to give INR or do you have to give dollars? Dollars. So assume you have entered in forward contract to sell dollars. So you have entered into a forward contract to sell dollar. So what will happen is INR will be in and USD will be out. Oh, pay attention. So if you have a contract to buy some non-monetary item at a future date in a foreign currency, how accounting will be done? Assume the contract is to buy the PP in foreign currency. So accounting will be done as if the contract is to buy the PP in INR. So PP comes in, INR goes out. But reality is I don't have to give INR, I have to give dollars now. I don't have to give INR, I have to give dollars. Now see, we have not entered into any forward contract for dollars. So don't think we have done any hedging wala thing. People think that, sir, when I have to buy PP, I have to pay in dollars. If I have to pay in dollars, I have to enter into a forward contract for buying dollars. This is not hedging. So don't think in that way. Yahan pe simple. First you assume the contract is to buy PP in INR. But reality is not in INR, I have to pay dollars. So you assume you have entered into another contract for selling dollar. So where you will give dollar, you will get INR. So indirectly this INR out, INR in get cancelled. Indirectly INR out, INR in gets cancelled, and now it is PP in and USD out. Accounting will be in this way. Accounting will be in this way. If you understand it simply, easy rahega. If you can complicate n number of times. So first of all, you assume the contract is to buy the PP in INR only. The PP will come in, INR will go out. And second, you assume reality INR will not go out, dollar will go out. Na? So now you assume you have another contract wherein you are selling dollars. There's another contract where you are selling dollars. So we are selling dollars, the dollar will go out, INR will come in. Okay. Now, what rate this entry will happen? What rate this entry will happen? See, contract is to buy PP after 6 months. Contract is to buy PP after 6 months. So what is the forward rate for 6 months on date of contract? So what is the forward rate for 6 months today? So this entry will come at the forward rate for 6 months. So today I enter into contract, I'll buy PP after 6 months. So forward rate for 6 months which is going on, that rate say entry will happen, but entry will not happen today. Entry will happen when PP comes. The entry will happen after 6 months only, but it will be based on the date when you entered contract, what was the 6 months forward. Okay. Now, you have entered into a forward contract to sell dollar. So, I have entered into a forward contract. I assume the forward contract is done at the same price, whatever is going on for 6 months forward. 6 months forward is available at 70. I have entered into a contract to sell at 70 only. 6 months forward contract is available at 17 market. I have entered into a forward contract to sell at 70 only. Now, this I have to mark to market. This I have to mark to market. Kaise hoga? Let me just check the question. It will be more simpler for you. Check. ABG Private Limited is a company engaged in contract to buy solar panels from UAE. Delivery due in 6 months. So am I buying today or it will be bought in future? Future. If I'm buying today, it doesn't fall here only, it goes in Ind AS 21. Okay, price is $50 million. ठीक है. The obligation to settle is in dollars. Obligation to settle is in dollars. So I'm buying a PP. I'll account as if PP is bought in INR, and there's another contract where I'm selling dollars. There's another forward contract entered to sell dollars. ठीक है. Spot rate today is 60. 6 months forward rate is 65. 6 months forward rate is 65. And spot rate June May after 6 months is 66. Okay, now pay attention. So one, I'll record the solar panels in my book. The solar panels, and basically I'll be recording. It will be based on the date when you entered contract, you'll be getting after 6 months. What is the 6 months forward rate? 6 months forward rate is 65. The solar panels will be recorded in your books at 65, not today, in June only. So when I go to June, just check over here. When I go to June, here are June. When I go to June, solar panel to trade payable or inventory to trade payable is 50 multiplied by 65. 6 months forward rate. ये हो जाएगा. Done. But this will come on 30th June only when you are actually getting the solar panels. It will be accounted at what rate? 6 months forward rate on the date when you entered into contract. You have to buy after 6 months, so 6 month का forward rate ले लो. ठीक है? Now, you also assume you have not to pay actually INR. You actually have to pay dollar, na? So you assume you have entered into forward contract to sell dollar. You entered into forward contract to sell dollar. Day 1, 6 months forward rate was 65. Assume I have also entered into a contract to give you at 65. Okay, I will give you dollar at 65 after 6 months. Going on rate in market for such thing is also 65. Is the contract favorable to me, unfavorable to me? I will give you dollar after 6 months at 65. Market में उसका rate is also, मतलब such transaction rate 65. So can I say today the transaction is neither favorable nor unfavorable? Market rate of such thing is also 65. I say I'll also give you at 65. I'll give you at 65. Now suppose at the end price became 66. Oh, price became 66, but can I say I have to give you at 65? Price became 66, I have to give you at 65. So can I say there's a loss of 1 rupee to me? Loss of 1 rupee to me. So I'll book the loss. Loss on derivative to derivative liability. 1 rupee loss. 50 million pay 1 rupee is basically 5 crores. Rupees are in crores. 50 million pay 1 rupee. So I had a contract to give you dollar at 65 after 6 months. After 6 months the rate is 66. रेट 66 है, बट आई हैव टू गिव यू एट 65. मेरे लिए लॉस हो गया 1 रुपी. ठीक है, दिस लॉस बुक्ड. नाउ दैट इन्वेंट्री सोलर पैनल बुक्ड. डन. नाउ वन थिंग व्हाट डू, दिस डेरिवेटिव लायबिलिटी यू ट्रांसफर टू ट्रेड पेएबल्स. So that derivative liability you transfer to trade payables. Derivative liability debit, trade payable is credit. And now you pay. Now you pay the trade payable. So now you'll pay trade payable 325 and 5. Trade payable to bank is 330. 330 is based on 66, the rate going on today. Okay, so I accounted as if I had a contract to buy this solar panels in INR. What rate पे convert करेंगे? Forward rate 6 months वाला जो था ना, on the date when you entered into contract. Then second, you have entered into a contract to sell dollar at 65, but year end पे मतलब 6 months end पे the rate is 66. Rate 66, I have to give at 65, 1 rupee loss. Loss is booked. Derivative liability transferred to trade payable paid off. Check next question. Check next question. We have entered into a contract for USD 1 lakh sale contract. USD 1 lakh sale contract. We'll sell equipment, not today, in June. We'll sell equipment in June. Assume the contract is to sell equipment in INR only. Assume the contract is to sell equipment in what rate? INR. And sir, what कौन सा rate लेंगे INR के लिए? तो 6 months forward rate. What is the 6 months forward rate on 1st January? 55. तो 10 lakh into 55. 10 lakh into 55. That rate you will record the sales. If I just go down ये trade receivable to sales 10 lakh into 55. Are you getting it? 10 lakh into 55. For 6 months forward rate pay, it will be booked. Now, but actually, so I assume the sale is in INR, but actually I won't be getting INR. Actually, I won't be getting INR. What I'll be getting? USD. So assume you have entered into a forward contract to purchase dollar. Assume you have entered into a forward contract to purchase dollar, जिसमें आपको dollar मिलेंगे. So one is you assume the sales is in INR, but actually we are not getting INR, we are getting dollar. So assume you entered into a forward contract to buy dollar. Okay, so I have entered into a forward contract to buy dollar after 6 months at 55. And currently after 6 months wala rate going on is also 65. It's not 65, 55. I'm going to buy dollar at 55, and such kind of thing available in market is also 55. So there is no, it is not favorable, not unfavorable, no asset, no liability. Okay, now one thing. Okay, the June, May, I am buying dollar at 55. Now March end, 3-month forward rate. What is 3-month forward rate at March end? March end पे 3-month forward is कहने से June वाला. March end पे 3-month forward is June वाला. So I have a contract to buy dollar at 55 on 30th June. Such a thing is now available in market at 45. I have a contract to buy at 55. I have a contract to buy at 55, but such a thing is now available in market at 45. So profit or loss? I have a contract to buy at 55, but now such a thing is available in market at 45. So loss हो गया 10. So check P&L to derivative liability 10. ठीक है? And actually when that date came, actually when that 30th June came, तो यहाँ पे year end rate was given, we have to bring to that way. तो year end पे 3 months forward, June वाला. So we have a contract to buy at 55, such June wala at year end is available at 45. And last May, it became 60. I have a contract to buy at 55. 60 ho gaya, still I'll get at 45. So can I say, I'll get at 55. Can I say 5 benefit? Net 5 benefit. So you book the 10 loss, you reverse 10 loss and you book 5 ka benefit. You reverse 10 loss and you book 5 benefit. So 5 asset is booked. 10 apne jo liability book ki thi, that reverse, and net 15 comes in your P&L. Net 15 comes in your P&L. Okay. Now derivative asset 5 lakh is there. You transfer the derivative asset to trade receivable and then you receive from the trade receivable. So trade receivable to derivative asset and then you receive from the trade receivable. So very simple. If I have a contract to buy something in foreign currency at a later date, to assume the buying will happen in INR, but you are going to pay dollar, to assume you have entered into a forward contract to sell dollars. If you have a contract to sell the goods in foreign currency in future, अगर आपका contract है to sell non-financial item in future, assume the sale is in INR only, but I'll be getting dollar. Assume you have a contract to purchase dollar in foreign currency. This is how you need to do. Bharat is telling, sir, what's the logic? Dear, I cannot explain right now. For that, you have to attend the regular classes. Otherwise, kabhi khatam hi nahi hoga. Okay, now the last question of this chapter, check out. You agreed to purchase $20,000. See, यहाँ पे there's a contract to really purchase $20,000. Earlier, there was no contract to purchase $20,000. Now, really there's a contract to purchase $20,000. So last May we'll get $20,000. ठीक है, there's a contract to purchase $20,000 at what rate? 68. ठीक है. Now we have to mark to market. All the derivative things are always marked to market and they go in P&L. For this purpose, what they have given question, it will be marked to market on a quarterly basis. Question is given, and they have given you mark to market fair value. Mark to market fair value means if you mark to market closing rate पे आओ तो आपको profit है या loss है. Okay, तो mark to market March में there's a 25 profit, sorry 25 loss. So can I say I have to book a liability 25? So P&L to derivative liability 25. Already mark to market figures are given. Then 15. Okay, June end में there's a 15 loss only. We have booked 25 loss. Reverse 10. Reverse 10. Liability reverse 10. Now September में positive 12. Okay, we are having 15 negative. Remove 15 negative. Bring positive 12. Remove 15 negative. तो आपका जो 15 negative removed, positive 12 comes, profit becomes 27. And now last में 66. Okay, last में 66, but you will purchase at what rate? 68. Rate is 66. I'll purchase at 68. I'll pay cash 68. INR I'll pay 68. I'll give 68 and I'll get $1. So I'll get $20,000. I'll pay 20,000 into 68. So now last में really dollar comes, $20,000 comes. They will come at today's rate 66, but I'm paying 68. Dollar comes and they will come at today's rate. I'm paying 68. Our derivative live asset which was there 12. The derivative asset you remove it, difference is profit or loss. यहाँ पे really the contract is to buy dollars. Earlier वो contract नहीं था to buy dollar, it was just accounted in that way. Are you clear? Are you clear? This is done. This was our IND AS 109. Let's go fast to IND AS 101. कहाँ है 101, 101, 101? Let's go fast to IND AS 101. 10 minutes, just 10 more minutes. Thank you so much, yeah, for handling me this much time. Okay, now chapter number 6, first time adoption. First time adoption comes into picture whenever you are transiting to IND AS for the first time. Now whenever you move on to IND AS, can I say your accounting policies change? AS में different था, IND AS में different है. So how do I do over here? This is for the first time when you follow IND AS. ठीक है. Now the general principle is whenever you're shifting to IND AS, you need to think as if the IND AS were followed from very beginning. What will be the treatment? Retrospective effect comes as if the IND AS were followed from very beginning. But because of first time adoption, they've given you certain exemption and exceptions. They've given you certain what? Exemptions and exception. Exemptions are voluntary, exceptions are mandatory. ठीक है. Now general principle, there are 4 general principle. 1, you should recognize all assets and liabilities which are required as per IND AS. Like I tell you simple, under your IND AS 116, lessee records ROU asset. Can I say AS 19 में it was not recorded? तो operating lease था, AS 19 में ROU asset not recorded. But under IND AS 116 it is to be recorded, तो आप record करो. Second, don't recognize asset or liability which IND AS does not permit. AS में permitted था, if IND AS doesn't permit, don't record it. Reclassify the item. For example, under AS, investment property comes under investments. Investment property comes under investment. Under IND AS, it comes on face. There was a question asked on this. Give examples. ये जो example है ना, वो पूछा था 4 का. And apply IND AS in measuring all the recognized assets and liabilities. The general principle is now when you are recording as per IND AS, the measurement should be as per IND AS. ठीक है. Now there was this question. There is a government company. They've got some grant in nature of promoters contribution. They got some grant which is in nature of what? Promoters contribution. And under AS, it goes in capital reserve. Can I continue the same under IND AS? No. Because general principle say you have to reclassify the item. You have to basically ensure you're following IND AS. So now you cannot go in capital reserve. ठीक है. Now coming to mandatory exceptions. Mandatory exceptions. Now first, estimate. Tell me one thing. Under IND AS, if I need some estimate, and a similar estimate was done earlier under AS also. AS mein estimate was done. Upon shifting in IND AS, we also need estimate. So should I do it again? So first I have to see previous gap mein whether estimate was done. Yes. Acha, if there is an error, do it again. If there is no error, you can use the previous estimate, but you can adjust it based on requirement of IND AS. You can just adjust it based on the requirement of IND AS. Point 2 is fine, leave it. Point 3. Okay, when I am measuring financial asset, financial liability, remember financial asset can be at amortized cost, FBT OCI, FBT PNL. It depends on what business model and the contractual cash flow. Now that business model I have to look of which date. बिजनेस मॉडल मुझे कब देखना था? द डे व्हेन द एसेट कम्स. The day when the asset comes. Now, day when asset came, it was not Ind AS only. So the business model, whether it's to hold or to sell, you can check off today's date of transition. So normally I have to check the classification depends on features on initial recognition, day one pay, but now I can use the features of today and decide whether amortized cost, etc. etc. ठीक है? Okay. Next. A government loan. If you remember, government gave you a loan at less than market rate. Agar government gave you a loan at less than market rate, what will happen? Whatever I have to pay, discounted by normal rate, that becomes the government loan. Balance is government grant. But the thing is, already those government loans which you have received earlier, you are not recording it as government grant. So this you apply prospectively. So for those government loans which are already received at a subsidized rate, okay, the loans are going on, no need to find out the grant amount in that. Earlier you are not recorded government grant, chalega. Now also don't record government grant. If you are not recorded earlier, no need to record the government grant. Fine, just a minute. No need to record the government grant. The only thing is, now there is some value in your books. Previous carrying amount, whatever is the previous gap carrying amount, same amount the loan continues. So old standard mein jo aapke the value, same value se it continues. Now after certain years you have to pay the money. Whatever you have to pay, so based on that you calculate IRR. Based on that you have to calculate the effective interest rate. Next comes optional exemption. Okay, wo tha mandatory. Now coming to optional. Now tell me, under your guidance note of employee share-based payment, remember you are allowed to follow intrinsic value or the fair value, but under Ind AS 102 it's only fair value. So suppose earlier you are following intrinsic value, yahan pe you have to follow what? Fair value. So what to do? For the options which are already wasted, you can continue whatever expense was booked. No need to go back and see if fair value was there, what would have happened. No. For already wasted one, you can continue what is done, but for unwasted one, you have to bring them to the fair value. To check this question, out of 75 option have wasted, 125 will waste in future. So for this 75 options which are wasted, you can continue with the old cost based on intrinsic value. You want to shift, you can shift because you're optional hai. So for 75 that are wasted, one option you apply Ind AS 2 or you don't apply Ind AS 2, you continue what was done. But for 125 which will waste, you have to follow Ind AS 102. Next, deemed cost of PP, intangible asset, ROU asset. Okay, the PP, intangible, ROU. How do we have the value coming as per Ind AS on day one? If the Ind AS was followed from very beginning, what will be the value today? Or second option, what is the fair value today? Third option, there was some revaluation done under old standard. Old standard mein revalue kiya tha, so I can continue that value with some adjustment. Previous gap mein revaluation tha, I can continue that value with some adjustment. Or fourth, the previous gap carrying amount, I can take it. I can take what? Previous gap ka carrying amount. So whatever is book value, I can start under Ind AS with the same value. But when you're taking a previous gap carrying amount, it will be for all PPs. It will be for all PPs. PP le rahe ho to all PP. Intangible le rahe ho, all intangible. It will be for all PPs together. So either if Ind AS 116 was applied from very beginning, what will be the value? You start with that, or you start with the fair value today, or you start with, if revaluation was done as per old standard, you continue with that value after adjustment. And fourth, you can continue directly the previous gap carrying amount. Next, under your AS 11, there was foreign currency translation reserve. Under your AS 11, there was foreign currency translation reserve. Your option to make it zero when you're shifting to Ind AS. So when you're shifting to Ind AS, whatever was your foreign currency translation reserve, you can set it as zero and transfer it to retained earnings. You can set it as 0. So IND AS mein it starts with 0 FCTR. So that's the option. If you want to continue same, you continue, or else you can make it 0. Fourth point, you can leave it not relevant. Fifth, investment in subsidiary associate JV. Now remember, investment in subsidiary associate JV appears either at cost or as per IND AS 109. Now earlier in old standard, it was only cost. Now if I want to have as per IND AS 109, so day 1 pay, if IND AS 109, IND AS was followed from very beginning, what will be the value? You can take that, or you can take today's fair value, or you can take whatever is the value as per old standard, start with that. Whatever is the value as per old standard. So deemed cost is either the fair value or the previous gap carrying amount. Next, compound financial instrument. Remember, compound financial instrument was split into equity and liability. Now, AS mein it was not there only. There's no concept of compound financial instrument. So they are telling, see, when we apply IND AS, we have to think, what if the IND AS were applied from very beginning, day 1 say, company came up 20 years back, the 20 year back say IND AS were applied. That we need to do. Now, so if at all we had some compound financial liability, compound financial instrument, we have to bifurcate. But if liability is already over, then don't bifurcate. If liability is not outstanding, don't bifurcate, chalega. Option. If you still want to bifurcate and do it, chalo. But otherwise, no need to bifurcate. TK, this question is fine. Now, joint arrangement. Now, imagine if it's a JV. If it's a JV, there was accounting standard 27, you are following proportionate consolidation. And under your IND AS 28, you have equity method. So, pehle kya tha? Proportionate consolidation. Proportionate consolidation means your share of assets, liabilities you have included in your book. So, in your CFS for JV, in accounting standard, we are having our share of assets, liability we include, plus goodwill capital also comes. But under IND AS equity method, our share of assets, liability don't come, investment come. So whatever was our share of assets, liability, goodwill, capital reserve, you remove, same value, investment comes in. Our share of assets, liabilities, goodwill, capital reserve goes out, same value, investment in JV will come in. There is no gain loss. This is only for CFS. So check what will happen is our share of assets, liabilities which was there is going away, and what will come in is the investment will come in. Fine. Then the last question. And see, whenever first time adopt kar rahe ho, because of that the values are changed, that adjustment goes in retained earnings. First time when you are adopting IND AS, you are taking someone's fair value, that difference goes in retained earnings. So company opted to fair value the land, book value was 10, now fair value is 10, existing gap mein 4.5. So can I say 5.5 going up, I need to add to retained earnings. Okay, you have done a provision for proposed dividend. Dear, provision for proposed dividend should not be there. Reverse it. So 60 reverse karo, 0.18 reverse karo. When I reverse it, retained earning goes up. So here also plus retained earnings mein, here also plus retained earnings. You fair valued the investment, increase plus in retained earnings. Okay, equity was 80, redeemable preference share 25. Redeemable preference share will go in liability now. Equity capital will be 80. Reserve surplus before was 95, 40 general reserve, 5 capital reserve, 40 and 5, 45, remaining 50 was retained earnings. ठीक है, preference shares are liability. You are required to show the total equity now. Total equity में, can I say if equity share capital comes, preference goes away. General reserve, capital reserve is same. Retained earning was 50. ठीक है. Increase in land 5.5, proposed dividend which we have recorded wrongly, removed, increase in investment. So this becomes your answer. This becomes your answer, and then there's a reconciliation. पहले क्या था, अब क्या है? That reconciliation is there. Done. This is the subject of your FR. We are fully done. Now, one or two things which you need to take care. First of all, this is a very important tip. Someone asked me, sir, give some tips for exams. If you want if you want that you're able to complete your paper, if you want you're able to write it properly, please write down 1 or 2 mock tests. If you write down mock tests, then in that case, your speed will come well. You're able to understand where you are weak or not. So my recommendation, 1 mock test for each subject, you should be writing it. And see, your Unacademy had basically came out with an evaluated test series for you all people, which is for free. So make sure you write 1 mock test for each of the subject. It's always advisable. Second thing, when you start your FR paper, question 1 is mandatory. So see, you have to attend question 1, and question 1 is generally big one. So my recommendation will be, whenever question paper comes na, don't see question 1. Start with question 2, 3, 4, 5 that you see. And out of the 2, 3, 4, 5, they are small ones. Whichever you know better, start with that. Rather than starting with question 1, so many people got a paper, they just read question 1 only for 15 minutes. They started with question 1, 45 minutes, 1 hour gone, balance sheet didn't tally. And the sweating starts. So better is start with small question. 1 to anyways you have to attend, na, leave it. 2, 3, 4, 5 you try to read, usme se, whichever you feel more comfortable, start with that question. Third thing, it's very important to have a proper diet of yours during this exam day. Exam days pe please proper khaiye. It should not be like you ignore your food. You don't have to eat heavy. You should not be malnourished also. So eat less food but more number of times. If you eat more, you feel sleepy. So less food khao, more number of times khao. Eat more of fresh fruits, juices, salads, etc. Rotis, rice, whatever you're eating, I'll recommend you to eat half of the quantity of what you're eating. So automatically you'll feel kind of energetic. Then, if at all, whenever you're feeling low, what you should do? You try to have something which can motivate you. See, for me, there were 2 songs of movie Lakshya. When I was studying movie Lakshya, it came. I used to listen 2 songs of that movie on a daily basis. That used to pump me up. There was a song, Lakshya to har hal mein pana hai. Yeah, Lakshya to har hal mein pana hai. When I used to listen that song, automatically goosebumps were coming. And again, I'll focus on my studies. So please make sure there's something there to motivate you on a daily basis. Based on that, you're moving ahead. And lastly, you need to believe in yourself. Believe in yourself, and remember, starters are many, finishers are few. You've reached to this level, you need to finish off the things in a style. Yeah, you reached to this level, you just finish off the things in a style. That's it from my side for FR. All the best for your exams, rock your exams, and then come out with the flying colors. Now, sir, about auditing, are we having again marathon for auditing? Auditing marathon was planned on this coming Saturday, Sunday, but due to Diwali, there is some issue. I repeat, it was planned on the Saturday, Sunday, face-to-face was planned, but now we won't be able to have an auditing marathon face-to-face on this Saturday, Sunday. So now what I have decided is, during your 2 days of auditing, after your SFM paper, your 2 days, now continuously 2 days, I'll take that marathon. Exam day, you study audit with me. Repeat, exam day, you study audit with me. So we'll be doing audit ka marathon, but not today, during that 2 examination days. And wherein we'll be covering again everything like we covered in our FR paper. So audit marathon, are we having it on next Saturday, Sunday? Answer is no. We'll have during that examination day. So SFM khatam hota hai na, 5 o'clock will come back. Evening 6:30, marathon starts. So SFM, you finished your paper, evening 6:30 I'll start, and then next day full I'll be taking the full preparation of auditing you're doing together with me. It will be a live online, same way like this. Okay, anything else you want to ask? Tell me, else study well, and I'll see you then. Chalo. Bye-bye Guru, bye Ashwath, bye Abhijit, bye-bye Shreyash, bye Parth. Okay, Ramesh has a question, sir. Will you be taking a lecture on the current RTP November 22? Answer is yes. That I'll be taking it within few days only, like 2-3 days, or probably this Saturday, Sunday. So this Saturday, Sunday, I'll cover up the RTP of FR as well as the audit. Wo ho jayega. Yes, RTP, I'll be covering it up. Anything else? Done? Chalo, all the best, study well, rock your examination. Let's crack it. Bye-bye, take care.